Good morning, everybody. My name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, I'm very excited to share this next piece of content with you. I've gathered a handful of personalities that I'm very excited to dive into their perspectives and forecasts for the year because we're a quarter of the way through 2021 already somehow. Now, dialing it back to December and January, I probably interviewed close to 100 investment gurus with the intention of dissecting their perspectives, their opinions, and their forecasts for the year so that I could allocate capital accordingly. Now, 3 months in, a lot has changed, and so I felt that it would be timely to bring back some of my favorite personalities to revisit these forecasts, determine where we were right, where we were wrong, and how we need to adjust. And so today, I'll be joined by a handful of personalities. Some I've had on before, some are brand new, but I'm excited to share every single one. So today we have Steven Van Metre, the president of Steven Van Metre Financial. Now, Steven is one of these analysts who's been very bearish on gold. He's calling for $1,300 gold. And I tend to have way too many gold bugs on the show. And so it's always refreshing to hear a contrarian's viewpoints. And I dive into this with Steven today. Willem Middelkoop, founder of the Commodity Discovery Fund, one of the true pioneers when it comes to discovery investing in the resource sector. Warren Gilman, chairman and CEO of Queens Road Capital, a legend in the business, used to manage the money of one of the wealthiest individuals on the planet, Mr. Li Ka-shing in China. Warren's now running his own company with Queens Road Capital, and I was very keen to determine where he's putting his money. Lynn Alden, crowd favorite, founder of Lynn Alden Investment Strategies. Daniella Cambone, editor-at-large and anchor at Stansberry Research. Peter Schiff, CEO of WRPSF Capital. Rick Rule, president and CEO of Sprott US Holdings. David Morgan, founder of the Morgan Report. And Jeff Clark, senior precious metals analyst at goldsilver.com. I'm also going to be joined by a small handful of investment opportunities that I believe are timed perfectly for this softening in the precious metals prices that we are experiencing. So I always enjoy putting this together. Thank you so much for stopping by. I'll be in the live chat. Drop me a line and enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Lynn Alden of Lynn Alden Investment Strategies. Lynn, welcome back. It's good to see you.
Glad to be back. Thanks for having me.
Yeah, well, I wanted to spend this time sort of revisiting your forecast for 2021, right? All analysts put out their forecasts in December and January for the upcoming year. You did a phenomenal one on a Real Vision TV that was just published at the end of February, but I know it was recorded in December. And so lots has changed, right? It's been a pretty crazy year, very, very busy. And I'm curious about what may have changed in that you covered, your thoughts on the US dollar, interest rates, inflation, commodities, the emerging markets trade, real estate, gold, Bitcoin, a whole variety of things. We only have about 20 minutes. We won't get into all of it with as much depth. But first of all, everybody should watch that on Real Vision TV. It's excellent. But I want some updates from you today. And so maybe let's start with the US dollar. You had a very bearish outlook in 2020. Obviously, that paid off. And now, if I understand correctly, you're pulling back on that a little bit because you're seeing that trade become a bit crowded. Is that correct?
Yeah, pretty much. Starting in late 2020, I started to become less decisive about that, at least in the intermediate term. So I still have a longer term view that we're probably in a more structural dollar bearish cycle. But during that process, you're going to probably have counter rallies along the way. And so whenever it gets too crowded, too consensus, it's easy to have a surprise that pushes it up. And so far, that's what we've seen here in early 2021, still getting used to that, is that we're having somewhat of a rally in the dollar. Now, with the FOMC, press release today, we did get a little bit of a pullback in the dollar due to Powell kind of pushing back, being a little bit dovish. It's possible that can start a reversal, but until we see some kind of major hurdles crossed, I don't really have a ton of conviction in the near term about the direction of the dollar. And so, I'm kind of focusing on other topics of the moment and kind of just waiting until the market gives me more signals on that.
Got it. Yeah. I mean, I know you mentioned 3 to 6 months uncertainty. Any hurdles come to mind, Lynn? What would you be looking out for to go one way or the other that'll increase or decrease your conviction?
Well, a couple of things. One is just price levels. We'll see if it starts breaking firmly above, say 92 on the dollar index, and we're seeing some weakness in Europe related to the vaccines, related to their various policies, and because the dollar basket is very euro heavy, that weighs on it, and so that's a pair that I'm a little bit less convicted on. The main thing I'm watching though is yields, and so as we get higher inflation expectations here in the United States, we have other central banks that are kind of taking the turn of being more dovish, and so they are. Some of them are doing yield curve control. Some of them are doing kind of indirect yield curve control, where they're more explicitly saying that they're not going to let long end rates rise too much. Whereas the Fed has purposely been a little bit, more kind of balanced on that, and not really showing at least any concern about the long end of the curve until the market probably forces them to. And that's kind of something we've seen out of this Fed, is that they've been very reactive rather than proactive. And so rather than trying to get ahead of things, they wait until the market kind of has a pain point and then tells them what to do. And so they're kind of moving forward with that and saying that they're remaining very dovish on the short end of the curve. They're keeping their QE in place, but they're not really overly concerned about the long end of the curve right now. And that can keep somewhat of a little bit of a floor on the dollar.
Does that concern you, Lynn, that reactive nature versus the proactive planning from the Fed?
Not exactly, because it's all about essentially market manipulation. And so instead of kind of getting ahead and manipulating ahead of time, they're at least kind of letting the market poke around a little bit before they come in and quash it. So I guess it depends on what your view is on that. If you have a certain outlook, you'd rather them just kind of rip the Band-Aid off and do what you want them to do. But if you're kind of just watching market forces play out, in that sense, you want a Fed with a lighter touch. And it's all relative, right? Because they're still holding rates at zero. They're still doing, billions and billions of QE per month. And so it's, what exactly is tight versus getting ahead of it it's a relative game. You're basically comparing it to other central banks, and you're comparing it to the massive amount of fiscal spending that's happening and how much of it they're going to have to monetize and how much they're going to have to control rates.
Okay. Last question on the dollar. Just a month ago, I had Peter Schiff and Brent Johnson back on the show, and they were debating, the dollar for 2021, renewing a bet they made in 2020. So they've got a 1 ounce gold coin riding right now on whether the dollar will be higher or lower. I guess it would be like January. It was the final week of January. They hosted this. I have to recheck the exact date. But anyways, it was around 92, and it was the 4th week of January. Any prediction? Obviously, Brent's betting the dollar is going to rise. Who's going to take home that gold coin in 2021?
I'd have to lean bearish on that. But again, until we have more signal, that's not one of my higher conviction areas. I was more conviction last year. And I still think longer term, we're going to see a dollar weakening cycle. But it's always possible that 2021 ends up being a kind of a neutral year, or, mildly up, mildly down. If I had to pick one, I would say probably neutral to down.
Got it. Okay. Now you mentioned higher inflation expectations. You're expecting the Fed to hold rates at zero. Is that correct or not? Yeah. Okay.
Yes. Yeah. Then they've indicated them as well, but the market's beginning to test that theory, and they're basically kind of pricing in some rate hikes happening in a year or two. And Powell today pushed back against that, and basically they don't plan to raise rates until they have persistent inflation over 2% as the way they measure it. So people can debate about what is the correct way to measure inflation, but we know that basically what the Fed is using is their model, and so. Overall, they seem pretty intent on staying dovish for as long as possible. And there's going to be a couple of tests along the way. And so one of the big ones to look out for is that in quarter two, specifically April and May, the inflation numbers there, and they'll be reported in May and June. But the reason those are significant is if you look at what CPI did, it took a really big dip back in April and May, because that was kind of the heart of the shutdowns and the big disinflationary period. And so when you do year over year comparisons, those are really low base effects. And so there's a decent chance we're going to get a CPI print that's over 3% in April or May, probably both. And so, but Powell already referred to that. He also already said they're going to call that transient. And so you might have a mismatch between what the bond market's doing and what the Fed's looking at. And so, we'll see if things get a little bit disorderly around that time. But the Fed's already aware of that, talking about that. And so it's something that's kind of the next time period that I'm monitoring.
Okay. Thanks for that. Now, just to touch on that. So, we're expecting inflation to run hot. We're expecting the Fed to continue to suppress rates, creating this negative real rate scenario, which is typically a great setup for gold, if that's the consensus, are you surprised that gold hasn't performed better since August? It's been a very soft market.
Not really. It's been, I guess, slightly weaker than I would have expected, but overall, it's pretty much doing what I'd expect from the 10-year doing what it's doing. And so a lot of people focus on the shorter end of the curve, but because gold is generally a longer duration asset, it's best to compare it to other long duration assets, such as the 10-year Treasury or longer. And so if you look at the real rate in the 10-year, ever since August of 2020, we've had nominal rates rising faster than inflation expectations. And so you've had a rising of real yields that are still negative, but less negative than they were at their bottom in August 2020. And so even though if you look at, say, earlier in the curve, like the 5-year, you're getting kind of a wider, kind of a more negative rates. If you look further out at the 10-year, that's where you're kind of getting some solidity there. Now, I do think that as we go forward a little bit, we'll get, inflation expectations probably catching up to that. And we might have seen kind of a rollover where gold kind of finds a bottom, real rates find a top. We have to see a little bit, more conviction on that. Right now, it's kind of a potential turning point that I'm kind of monitoring, that we might see a little bit of a decoupling here and gold kind of find its legs a little bit. But kind of the ultimate long-term thing is the potential for yield curve control or things like that. But the Fed's unlikely to move on that until things get disorderly enough that the market's essentially demanding it. Until then, they're basically keeping the short end tight. They're letting the long end rise. And so gold's kind of in a mixed condition because the gold really kind of focuses more on that long end.
Got it. Okay. Now I have to ask, because it's a common conversation these days, specifically from gold bugs more so, that Bitcoin is eating gold's lunch right now, right? As the asset, the role that gold used to play, a lot of that dough is now moving towards Bitcoin. Do you have any thoughts on that, Lynn? Does that resonate with you, or do you think that's missing the point?
I think around the margins, it stole a little bit of the narrative. But if you look at, if I just looked at what gold, if Bitcoin didn't exist, and I'm just looking at what gold is doing compared to 10-year yields, nothing stands out as unusual. Now, it might be on the weaker side slightly of what I'd expect. Maybe it's $100 lower than I think it should be. But overall, it's roughly following what I would expect from money supply growth and from those 10-year real yields. And so, it's possible that Bitcoin is responsible for the fact that it's on the weaker side of what I'd expect rather than, say on the stronger side or kind of average. But overall, it's not really doing anything enough that I would call it deviant from how I'd expect gold to be behaving in this 10-year environment. Now, overall, real yields rose a little bit quicker than I would have guessed, say 6 months ago. And so gold's been slightly weaker than I would have guessed 6 months ago. But comparing those two measures together, it's making sense as gold relative to real yields. But because we're getting such strong action in Bitcoin, and because younger investors are generally using, Bitcoin more like that gold proxy, we are probably getting some money flows that would have otherwise gone into gold and silver instead directed towards Bitcoin. But I view it as a big mix. And so some people are only one camp, only the other camp, whereas I like Bitcoin, I like gold, I like silver, I like copper, I like uranium. And I kind of just tilt them based on, what's getting out of hand. And so, for example, last summer, I was still bullish on gold, but I started rotating more and more into, some copper, some Bitcoin, things like that are a little bit more of that kind of kind of inflationary bent to them. And those have done well. But for example, copper, I think is, it's gone up pretty far, pretty fast. Mm-hmm. And so it's starting to look a little bit more interesting towards gold again. Okay.
Thanks for that. Now I want to jump into a lot of the commodities that you just mentioned. One final question on Bitcoin, though, just because I know your thesis remains fairly bullish, right, for 2021. And from my standpoint, like what I do is gauge sentiment, right? I have conversations like this for a living. I talk to a lot of retail investors, and I've seen the sentiment shift in Bitcoin, and I was waiting for this shift. I knew it was coming, and now I feel like it's here. Where I don't want to call it retail euphoria, but we're getting close. I mean, people like Lindsay Lohan, for example, are calling out now saying, if you don't own Bitcoin, you're an idiot. And those are the flags that you got to look for, right? So are you seeing those flags? Are you concerned that we're sort of reaching a frothy top or not? Does it not bother you?
So I think we're firmly bull market. I mean, it's certainly a popular trade at this point. My base case is that trade's not over yet, that Bitcoin probably still has more to go in this cycle. Potentially, for example, when we see some of those 3% CPI prints, like I mentioned, in quarter 2. I still think there are a variety of kind of catalysts ahead. That the TGA drawdown, the stimulus checks going out, the potential for 3% CPI prints, and so and looking at just a variety of on-chain indicators. Basically looking at what long-term holders are doing. You can generally see these patterns play out with Bitcoin, and so far the underlying fundamentals still look strong. And as another example, Bitcoins are still leaving exchanges, meaning that there's still kind of a net outflow where people are buying Bitcoins, putting them in cold storage. And so overall, this huge price increase hasn't yet been enough to get long-term holders to basically dig their coins out of cold storage and sell. But it started to happen to some extent. We saw some profit taking in a little bit in recent months, but nothing that yet would suggest a major tops in place. But of course, it always remains to be a possibility. We can't purely go on what fundamentals are doing, what past performance, because ultimately sentiment can dictate a lot. Another thing I'd point out is that a lot of the altcoin space has taken some of the really kind of frothy elements. And so, for example, we've seen intense euphoria around NFTs. And some of these kind of utility protocols, you could say, like some of the Ethereum competitors. And DeFi was big for the past couple of months. Now it's kind of been replaced by NFTs in sort of the narrative. But overall, I think that's where a ton of the really retail speculation is. Whereas Bitcoin, ironically, a lot of the retail people are saying that Bitcoin is not fast enough for them, that they want to go into that kind of wild west of the different types of tokens. Whereas, institutions are the ones that are still loading up on Bitcoin, as well as some of the more kind of, dedicated Bitcoin investors.
Okay. 2 more questions on this one. Purely from a speculation standpoint, 2021, are you choosing Bitcoin or Ethereum?
So that's tricky because during a Bitcoin bull run, a lot of times those other protocols actually outperform on a percentage basis during the bull market. So I don't really have a high conviction between the two during 2021. I would lean towards Bitcoin if you talk about multiple years to include, say, the bullish run and then whatever pullback we're going to get.
Right.
So that's my preference as a protocol. But during that up phase, who knows?
Okay. And I guess that answers my second question. I was wondering about time horizon. If you're looking for an exit point this year or in the next sort of 12, 18 months in regards to your Bitcoin position, but it sounds like not, right? You're holding for the long term.
Well, so I think, there's basically a difference between a strategic holding and a tactical holding. And the same thing's true for gold. So, for example, someone might have physical gold as a strategic holding that they don't really plan to sell for the foreseeable future. And then they might have gold miners or gold ETFs that they're using as a tactical play because they're bullish on a certain time period. And so I'm viewing Bitcoin similarly, where I think probably later this year is a good exit point from a tactical standpoint, or at least to basically rebalance the position and not become super overweight that position. Right. And I treat different types of Bitcoin holding differently. And so, for example, in one of my model portfolios, I already sold a small tranche of the GBTC that I hold in that portfolio just to stop that from becoming such a big chunk of the portfolio. And so we've already actually taken more profits than we put in. So the whole rest of the position is just a free riding position. And it's still a pretty big chunk of that portfolio, but it's not, I'm not letting it get too big of a percentage because a lot of people kind of follow that portfolio. For some of my other holdings, like my cold storage holdings, I don't plan to sell those, just yet. And so I kind of separate that strategic holding from kind of another portion that I'm willing to rebalance or kind of trim in certain tranches to not be overweight too much.
Okay. We're going to switch gears to commodities now. And I want to start with uranium, Lynn. So are you positioned? And if so, how right now?
So I'm bullish on uranium. I wrote a report in October 2020. That's where I then established my positions and became bullish on it. And so I played it somewhat conservatively with, I have a pretty decent chunk in the, the holding companies, the ones that just hold uranium. They were at the time they were trading at a discount to NAV. Now, even though spot uranium's gone nowhere, the discount closed and turned into a mild premium. And I'm also bullish, say Cameco. I also think the ETFs are a decent way to play it. And so overall, I'm bullish on the space, but I leave, kind of specialists to pick through the different types of junior miners and find out how to get the most explosive gains. That's kind of you need a lot of specialty to really kind of dig into those and follow those well. I'm sure you've had them on your show.
Yeah, for sure. Now, when it comes to uranium, do you factor in public perception of nuclear power into your thesis? Because the reason I ask is because for my entire life, it's been pretty negative, right? Nuclear power has been stigmatized as a dangerous power source, and it's I mean, it's an amazing technology, right? The energy produced per square foot, the zero carbon emissions. There's lots of reasons to love it. There's been some horrible mistakes made, and that's where the connotation comes from. But do you factor that sentiment into your uranium thesis, Len?
To some extent, and the reason that I don't focus on it too heavily is because a lot of the demand's coming out of Asia. Yeah. So going forward, a lot of the reactors are going to be built in China, India, South Korea, Middle East. Eastern Europe, places like that. Now, so the major tail risk I look out for is if we have like a fourth major nuclear disaster that basically pulls some of the existing reactors off the market in a big way, right? So a handful of reactors here doesn't matter, but if a major country like we had Japan pull all the reactors offline, if that were to happen to the United States or France or something like that, that would really kind of derail the bull market thesis. But overall, just from the numbers being built compared to the supply, basically regardless of what Americans and Europeans think about nuclear, just the numbers kind of suggest very long-term bullish here. Now, in terms of sentiment, it seems like it's changing in the better. And one thing I point out, if you look at India, they still have like 2/3 of their grid electricity being generated by coal, right? So people can debate about what's cleaner than what else, but I mean there's no debate that coal is pretty much the dirtiest major fuel source out there, and their usage of that is still growing, and they have some of the if you look at say air pollution in major cities, it's a pretty big problem throughout Asia, including India, and so they have a pretty big incentive to at least want to take a segment of that and put that into nuclear energy. And one thing I point out in terms of the overall environmental and safety profile is that all these different types of energy sources have risks. And nuclear is kind of like it's comparable to an airline. And so, for example, a lot of people are afraid to fly on planes. If a plane goes down, it makes world headline news for weeks. Whereas statistically, it's a far safer mode of travel than cars. We don't really think about cars too much, but that's because there's no disaster that makes like world news with cars. It's always these small things kind of building up over time. And so with coal, if you look at the studies, I mean, there's like hundreds of thousands of deaths attributed to basically the burning of coal and other sources and causing particulates to be in the air and exacerbating health conditions and causing death and illness. Whereas if you add up all the deaths associated with nuclear energy, including the long reach ones, so very few people died from the actual meltdowns, but then if you include even the high range estimates for the long-term health effects from radiation and stuff, it still comes nowhere near coal over those decades. And so overall, if you just run the numbers, it is a pretty safe and clean energy source.
Yeah, I think you brought up the most important point there, and that's that if you're not choosing nuclear, you're not choosing solar or wind, you're choosing coal. That's the reality of our energy production today. Okay, let's stick with energy then. So talking about the renewable energy transition in the US, outside of copper, Len, are you looking at, and outside of nickel, are you looking at any rare earths, lithium, cobalt, anything like this?
So I don't go too heavily into that. And I am generally strategically bullish on a variety of those. But again, kind of like say junior uranium miners, it's not an area that I pick out. But it is well known that cobalt is important for electric vehicles, and at least as they're currently kind of designed. But I've really focused pretty heavily on having a broad distribution. So I like copper, I like nickel, and I like it when a company has a cobalt mine or a cobalt stream as part of its production. And so that's kind of how I'm playing it. Is kind of a scattershot, broad approach.
Yeah, okay, that makes sense. And so then staying high level, precious and base metals, maybe call it silver, copper, nickel. Any that you're most bullish on for 2021?
So for 2021, not specifically. I think copper came really far, really fast. So I turned increasingly bullish on copper in kind of the summer, and we've had a stronger rise than I would have expected. Those positions have done really well. So I've been somewhat paring them back, even though I'm still long-term bullish. It's just a matter of kind of risk management. Right. And I wouldn't be surprised to see consolidations or corrections there. So I guess I'm not super bullish on copper in the near term. But if you're kind of really kind of focusing on, say, a 6 to 12 month outlook, technicians can probably give you a better answer than me. I'm kind of looking at more of like the multi-year outlook. But I remain very bullish on uranium, very bullish on silver and gold. pretty much most of those metals, and maybe a little bit more concerned about copper just in the intermediate term.
Okay, and final vertical I want to touch on is emerging market equities. So talk to me about timing and your outlook when it comes to emerging markets.
So one thing I do is I separate them into different markets, and so people often look at that the basket, the MSCI Emerging Market Index, and that's market weighted composition. But you have very different countries in there. Russia and India have very different demographics, very just very different markets. Then you have China compared to Chile. It just couldn't be more different in terms of what kind of companies they have, what's happening there. And so I really look at things on a country by country basis. The one thing that they mostly share in common is that they're an inverse dollar trade, because a lot of emerging markets they rely on external funding. They have dollar denominated debts, and so when the dollar is inflating, when there's basically the dollar's weakening compared to a basket of foreign currencies and weakening compared to hard assets in general, emerging markets tend to go along with that dollar bearish pro commodity trade, and there's some more than others. And so, for example, Russia, for example, has less dollar denominated debt. I mean, they've really kind of de-dollarized to a pretty good amount, but of course they're very dependent on energy prices. That's their big connection. Whereas China, on the other hand, they're more technology focused, and with them, it's kind of about monitoring, what basically the authoritarian leadership is doing in terms of, they go through these cycles where they want to grow, but then you start to get overheated, over leveraged, and it's basically well known they have a pretty big corporate debt bubble, and they always kind of try to prevent that from getting out of hand. And so they go through these periods. It's like if someone's like bodybuilding, they'll bulk up and then they'll cut back a little bit and bulk up. And China goes through these cycles where they grow and then they put on the brakes a little bit. And so you kind of watch those cycles for China. But overall, I am bullish on some of the Chinese equities. Pretty much I'm bullish across the board, except places that have a ton of dollar denominated debt. So I'm more concerned about, and I generally like to avoid that risk. I'm also actually pretty bullish on Japan, even though it's not an emerging market, partly because Japan's companies are pretty global in scope. A lot of them do work around the world, including in emerging markets. And so, for example, one of the ways that I'm kind of trading emerging markets is actually to have some of the Japanese trading companies that are involved in commodities, that are involved in infrastructure projects and all sorts of industrial projects for a variety of countries.
Okay, excellent. Look, Lynn, it's been great catching up with you. Thanks so much for making the time. I know you're crazy busy. You must be the hardest working macro analyst in the business this year. So it's been great having you back on. I appreciate it.
Yep. Thanks so much for having me.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Jonathan Weisblatt, the CEO of Rockridge Resources. Jonathan, how are you?
Doing great. Thank you very much for having me.
I'm excited to have you on and dive into this story, Canadian exploration story. So, where I want to start is with you. I've noticed a trend this year, like maybe last 12 months, Jonathan, of a few institutional money managers making the transition from institution to running a precious metals public company. And this is the transition that you recently made. I know a little bit about your background. You were an advisor to one of the largest family offices in Canada. My audience knows Sprott very well. You ran their flagship Canadian equity fund for over 4 years. I'm curious why you've recently, because you're the newly appointed CEO of Rockridge Resources, like mid-March. So what inspired you to make this transition now?
Yeah, so let me give you a little bit of background on myself. So I have been involved in institutional portfolio management for the last almost 2 decades. The first few years as a diversified sell-side analyst, 10 years managing a multi-strategy hedge fund here in Toronto, 4+ years, as you mentioned, running the Sprott Canadian Equity Fund, and the last few years, working as an advisor or as an internal portfolio manager for a very large Canadian, well-known real estate family office. So the important thing to know about my style is that I've always been a source of capital, but the investment style was always taking a concentrated position in a few high conviction companies. So really getting to know management teams, having an intimate understanding of the businesses and the strategy, always being very supportive capital as opposed to just being a passive investor. And with that being said, a little bit more than a year ago, I started to allocate capital in both my own accounts and in the accounts of my clients into precious metals for the first time in the prior 4 years, just given the market uncertainty and the current environment. As the environment wore on, as the year wore on, and the increased stimulus being created by central banks, causing fears of rising inflation, depreciation of the US dollar, I started to add various positions in base metals as well. So I started to take a very macro view of the world. And while I was doing that, while I was repositioning my portfolio, I met Rockridge and became very interested in their two flagship assets. One was Knife Lake, which I'm sure we're going to spend some time talking about today. And the other was the Rainy, the high grade gold project in Ontario.
Right.
I started to find interest in becoming more of an internal advisor and operator, as just opposed to being a source of capital. So this is the transition that I was making in my career. So as opposed to just having a collection of quality assets, under my portfolio or my umbrella, it was really my goal to really focus in and harness the quality of one asset. So I worked early on as a strategic advisor to Rockridge, getting to know the team, the assets, and the strategy in greater detail. As you know, and as I mentioned, I come from an institutional background, and the company, its assets, and its size makes it an ideal addition to more institutional grade portfolios. This was a very appealing situation for me, given my background and experience. And as an investor in the past, you're always trying to identify a sector that has an attractive investment thesis and growth angle. It's also good to identify sectors that are under the radar and undervalued. So when I started following the metal sector in late 2000 and early 2001, this was certainly the case. And once you've identified the sector, the fun part is digging into the investment opportunities. And for me, it was finding a business with very good assets and an operating team, and Rock met both of those right away. Furthermore, I would say the potential at Knife Lake was the real exciting opportunity once I started to get under the hood. With Rockridge, we have a relatively new company with two great assets. But perhaps the most exciting thing about Rock was its market valuation relative to its assets and its peer group. The upside looked tremendous, and even more so today. The company has $11 million market cap. It trades for about 2 cents on an enterprise value to total resource basis. Its closest peers in North America, copper-oriented peers, trade between 10 and 12 cents, making the upside for Rockridge shares just incredibly appealing. The company was looking to add bench strength to its capital markets leadership team. I agreed to take the CEO role, and here I am. I hope that gives you a bit of a flavor for my background and why I decided to join Rockridge.
Yeah, it does. It does. And as you said before we hit record, I think an integral part was your network in Toronto. And I know a lot of the team at Rockridge, and I've invested with a lot of the team at Rockridge, Jordan Trimble being one who's been on my show before and I've known for years and have a high level of confidence in. So I like the expansion to diversify the network and build the brand further out east, which I know you bring to the table. So let's jump into the assets a little bit. We like the jurisdiction. We're in Canada. We've got the Knife Lake, right? Yeah, in Saskatchewan. This is the copper project. You've been drilling this. There's a longer history to this project. I think it was last explored, correct me if I'm wrong, Jonathan, like 20 years ago. Is that right?
Yeah, so let me run you through the history there. So mineralization in Knife Lake was first discovered in 1968, so quite a long time ago. And The interesting part of that time frame was one of our strategic advisors, Ron Nedolitsky, was actually one of the geologists working on the property at the time. So he brings a lot of experience and a lot of
Ron's a legend. Yeah. Okay.
Yeah, and he's a legend. So that's a positive point to make. The property was extensively drilled in the 60s and the 70s. The asset back then was owned by actually not even so far back, but in 1996, the company was owned by a group called Leader Mining. Leader completed the 300 plus holes on the property. So they really zeroed in on the Knife Lake deposit. In the late 90s and early 2000s, metal prices collapsed well below where they are today. And Leader Mining was issued a cease trade order. In 2009, a group called Ursa Major International acquired Knife Lake and its surrounding properties. The company changed its name to Minova Gold, and they had very little focus in the region, and very little capital was spent on Knife Lake at the time. So back in 2017, not too far back, Knife Lake mining lease lapsed, and the area became open for staking. This is a very, very rare occurrence in the industry, specifically in Canada. And this was the first time actually in the history of Saskatchewan that a mining lease had expired. And in 2018, Eagle Plains, which is a partner of Rockridge, they're a prospect generator. They staked the area that had expired. We negotiated an option to acquire 100% of the project in 2018, 2019, and then went on to complete the inaugural drill program in 19. And we published the first 43-101 resource estimate on the project shortly thereafter. So they were going to build a mine in the 1990s. The project was orphaned before ending up in Minova Gold. Minova failed, like I mentioned, to make a small lease and tax payment, and deposit and surrounding area became open for staking. Eagle Plains staked it. We ended up doing a great deal with them, and here we are with Knife Lake. That's the history. I believe $20 million in aggregate has been spent on the asset to date.
Okay. And the secondary project is the Rainy Gold project in Ontario.
Correct.
I know it's the secondary asset, Jonathan, but anything you want to highlight on this project today?
Yeah, so we completed a drilling program in the fall of last year. We followed up on some very exciting results from the previous program. It's high grade. It's it's much earlier stage than the Knife Lake project is. So that project is currently on the back burner for now. When I say the back burner, I don't mean because we're not super excited about the opportunities there. It's just we are so focused on Knife Lake at the moment, and really working to expand the resource base, really understand the geology in the region, and really try to figure out what else is at Knife. We think there's just tremendous upside, and the resources of the company and the focus of the company really needs to be in Saskatchewan for the time being.
Okay. And that makes sense. And, once again, just to call him out, I know Jordan's got a ton of experience in Saskatchewan via Sky Harbor. Yeah. But okay, so talk to me about your cash position. Are you going to be going back to the market for capital, for more drilling? I know you've got a lot of work ahead of you.
Yeah. So we just closed a $2.5 million financing. We did a unit deal at 12.5 cents.
Yeah.
The program that we're running right now at Knife Lake will cost about $1.3 million. So we're fully funded. Okay. Cashed up and ready to go. We don't need any capital right now. I just want to emphasize that point. When we finance again, it'll be dependent on the success of the current program at Knife Lake. There's early indications coming from the program that things are very exciting. The company is getting very excited about getting some results out to the market and capturing the attention of the street for sure. So we're nearing completion of the Knife Lake earn-in. We own 100% of the gold asset, so we don't need any capital to keep going there. I guess the only other thing to mention is the mineral claims are in good standing at Knife Lake for several years. So there's no holding cost for the company right now. So in terms of the treasury, we're in great shape.
Okay, so if I can recap appropriately, we're focused again Knife Lake in Saskatchewan. We're drilling right now. Have enough cash to fulfill this program. We've got a bit of optionality in Ontario. In terms of news flow this year, what investors would look forward to, therefore, is the drilling programs in Saskatchewan, correct? And when can we expect some results?
Correct. So the focus, like I said, is Knife Lake. The program should finish over the next couple of weeks. And once results are ready to be released, which we believe should be, sometime in mid to late May, maybe through early June, we're going to get them out to the market as soon as we can. So investors can look forward to reviewing the results, also from the airborne geophysical surveys that were flown earlier in March. With those geophysics in hand, the targets refined, investors can get our drill results from KNIFE in the coming weeks. And yeah, those are the big catalysts coming up for the company.
Okay, so we're looking at late spring, early summer. All right. Okay, Jonathan, thanks so much for coming on, introducing this story to my audience. I've been curious about it. I keep a keen eye on anything coming out of that office in Vancouver. And so appreciate your time, and I'd love to revisit maybe in the summer once you've got some results to talk about.
I'd love to do so. Thank you very much.
My pleasure. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm very excited to introduce my next guest, Daniella Cambone, the editor-at-large and anchor at Stansberry Research. Longtime friend, speaker at my conferences. For ages, I touted Daniella as the best broadcast journalist in the junior mining sector. Daniella, it's great to have you on and connect.
Jay, it's my honor, and I just want to congratulate you on, you're not my competitor, but you have launched a really successful show here. I've been following it. You have great guests, and you're awesome at what you do. So congrats on the success of the show.
Thank you. No, I feel super fortunate. It's a ton of fun. And I'm sure we have a lot of war stories that we could share.
Absolutely. Yeah.
Where I want to start is, like me, you probably sit down with the largest variety of personalities in now macro finance. It's not just the mining sector anymore. It's broad spectrum finance. And when you do that, you must pick up on trends. You must pick up on hype. And you've seen a number of cycles occur, come and go. How do you determine, Daniella, when you're talking to a guest these days, whether what's catching the attention is just hype or if there's some long-term trend underneath the narrative?
Yeah, that's a really good question, Jay. And I always try and bring on guests that I feel my audience, wants to hear from and are not pushing an agenda. But of course, sifting through the noise and figuring out who's, speaking the truth or speaking from an agenda, that's one of the main roles of journalism. And how do I guess your question is, how do I know if someone's being straight up or pushing something?
Or selling something, yeah.
Or selling, I tell my audience, or what, I need to also be doing is, if you look back on the interviews and if they've been repeating the same thing, year after year, and if something doesn't pan out, right, and it was just a sweeping statement because maybe it got them views in that moment, well, then maybe that's where you need to question their track record.
Sure.
And again, doesn't mean that they're not popular people, but just take that with a grain of salt, that, if they've been saying this event is going to happen and it hasn't happened and 10 years have passed, well, maybe you just need to maybe take a step back and reevaluate that. And it's not to say that we can't be wrong and calls can't be wrong. And I always say it's not easy. Okay. It's really hard to go out there and make a call, especially when it comes, we do it. Where's gold going? Where's Bitcoin going? To stick your neck out and make that call is a lot harder than people think. So, also take that with a grain of salt. No one knows, and here we are, asking these experts, well, tell me, where do you think it's going? and they give us a number, and most of the times it's not going to pan out. So I think if someone's really off on a call, I don't think, well, they don't know what they're talking about then. I think there's a lot of factors at play. And that's why I'm not a huge fan of asking for forecasts. I do it because I know the audience, most of them, that's what they want to know, but I don't think it's fair that we have to, hold people to those forecasts forever.
I'm with you.
But and just on that note about, it's happened to me a few times, and it happened to me recently where during an interview, I'll actually have some sort of eureka moment or enlightening. And I love when that happens. I wish it were to happen more often. And, offline, I don't know if you want me to share this story. We were talking about how I had Michael Saylor on recently, who's, the CEO of MicroStrategy, famously made a huge call in Bitcoin and move into Bitcoin, a very bold move into Bitcoin. And, it's no secret. I obviously come from the gold world, and I am invested in Bitcoin. But getting me there in terms of seeing Bitcoin from a speculative asset to a vehicle of wealth preservation is something I'm having a hard time doing. And during the interview, he didn't know he was doing it, but he was walking me through that path and trying to get me over that threshold of it is wealth preservation. It is a long-term play. Bitcoin is life. Bitcoin is alive. Now, kind of loses me when Bitcoin proponents say Bitcoin solves all world problems. Bitcoin is love. That's kind of where the narrative gets lost on me. But I love that interview because it caused me to think to, step away from that interview and look at Bitcoin differently. So whenever that happens, I know, wow, that was a really good interview,
Well, yeah, he's such I don't want to call him a gift, but he's kind of a gift to the Bitcoin community because he's so articulate. If there was ever going to be a poster child for the corporate world moving towards Bitcoin, he's the guy, right? He's very eloquent, very passionate, very intelligent, very successful. He ticks all the boxes, and he's somewhat evangelical about Bitcoin. And so in terms of driving that bullish narrative, he's an excellent candidate for that. Now, from your seat, you've seen trends like this come and go. You've seen the Bitcoin trend come and go before 2016, 17, 18, right? Here it is again, different, but it's back, right? You've seen gold markets come and go. What do you look for when, so I asked this because I'm also invested in Bitcoin. I'm a precious metal investor, quite diverse in my portfolio, but I hold Bitcoin and I dollar cost averaged in. It's like, I don't know if I'd look at it as a safe haven asset class yet. We talked about this a bit, but more of a speculation. But now I'm seeing a lot of the signs that resonate with me as a top. And the retail froth. People who have never purchased a stock now calling me for Bitcoin investment advice. Lindsay Lohan on Twitter telling everyone, if you don't own Bitcoin, you're an idiot. These are the things that we should watch out for, the red flags. Now, are you seeing that? Are you seeing that shift in sentiment in the Bitcoin market now?
Yeah, I think that's a really good point. And had you asked me a month ago, I was sure Bitcoin was going over 100,000. Even 2 months ago when the euphoria was really high. Now we're obviously in some sort of consolidation period here. Right. And I know when energy's down because, like you, I live based on traffic and numbers and what content's being digested. So I kind of see it as it's happening, right? And the Bitcoin energy, for whatever reason right now, has kind of gone, right? We're not really moving anymore. So that said, I don't think this is a top. And again, this is purely just based on my gut instinct. I still wouldn't be surprised to see Bitcoin go north of 100,000. But I also wouldn't be surprised to see it have an 80% correction the next day.
Okay.
And that's how I view Bitcoin.
Okay.
Yeah. So no, I don't think we're at a top yet.
Okay. I'm with you. Now, you interview individuals like Michael Saylor.
Right.
You also interview individuals like Jim Rickards, right? And so they're the icons in the gold and the Bitcoin space and everybody in between. Now, the gold versus Bitcoin debate often becomes very binary, right? It's like you got to choose one or the other.
Yeah.
And if you choose this camp hates you. If you choose that, this camp hates you, right? And, you referenced before we hit record here, your portfolio is spread out, actually. You've got positions in each. Why is that a mistake? What are investors missing when they believe it's one or the other? And how does that impact your portfolio?
Yeah. Another good question, Jay. And I think people will be surprised because, of course, I've emerged and I'm very present in the gold world. And of course, I don't think it's any secret. I'm a big believer and proponent of holding gold. But I do believe that there is space for Bitcoin. And the way, again, this is what works for me and the way I view it is Bitcoin is a speculative asset for me. So the way I play Bitcoin is money that I'm not afraid to lose, that if I were to lose that money, it does not affect my quality of life. The money that I need long-term is in cash, gold, and silver, primarily gold. And I'm not losing sleep at night with that. So I've used this example in the past for I'm a new mom to twin boys, and whatever, they're 100% in gold. Whatever money has come in for them is all in gold because they don't need to touch that for 20, 30, 40 years. So when people are like, oh, but look at gold hasn't done anything since August. I don't need it to. I'm fine with where gold is here. Right. I actually like to buy gold below 1,200, and it kind of, hurts me to buy gold here, but I still do. So they're all in my portfolio, but they serve different functions. If that makes sense.
Yeah, of course.
So for me, long-term wealth preservation, it's gold, period.
Got it.
And yeah, I mean, obviously in cash too, but Bitcoin is just, if I can get in and, have my money grow via Bitcoin, why not? But I'm also prepared to lose all of it.
Got it. Okay. Yeah. I see it similar in my portfolio, to be honest. Now, Daniella, reflecting back on the years you've been hosting interviews, what's the most significant piece of advice that you've ever received from a guest?
Wow. That is a loaded question. That's me sifting through thousands and thousands and thousands of hours of interviews.
Who do you quote most often?
Wow. That's like asking me, choose between my children. But in my head, I mean, I look back a lot of my interviews as research for myself. And the people I always go back to are like the Frank Justras, the Jim Rickards, Rick Rule, Doug Casey has taught me so much, things that he told me 10 years ago. And I thought at the time, I don't know, that's really out there, and now I'm like, wow, he was right. I think he's such a visionary, and he's such a gift for our industry. So he's taught me a lot. Like I said, Frank Justra has taught me a lot about the role of gold. When you're talking about how Michael Saylor's really the poster child for Bitcoin. For me on the gold side, it's really like the Rickards, the Justra.
Yeah.
So, I've had so much wealth accumulation. I can't say there's one specific, but, advice, but Jim Rogers had a good one about when I was talking to him about Bitcoins about Bitcoin. And he said, the problem with bubbles is that no one really ever wins because you just don't know when to get in and out at the right time. So, he really kind of framed that up, brilliantly for me. So, I always just, like I said, I go back and I listen to a lot of these experts I speak to because I've learned so much, and I really think that all these interviews have added to my knowledge base and have made me the journalist I am today. So I can't just pick one for you, Jay. I know you want that, one.
But I'll counter that bull market quote. First of all, I love it. And I was chatting with Ronnie Stofferly. Have you had him?
Yes.
His comment about bubbles is a bubble is just a bull market that you don't have a position in. And he's a gold investor who's positioned one of his funds in Bitcoin, got a lot of hate for it. And his response was, you're calling it a bubble because you're not positioned in it. That's all, which I just thought that's a smart rebuttal. I love that.
Right.
Okay. Now you listed a lot of names that we know.
But if I could add one, I'll add one, which has caused me to reflect a lot is when Rick Rule was on and I asked him the best advice he ever got. And he said it was from his wife, who when he was so focused on, I got to make money. And we've all been there, right? Like we're hungry. We want to be successful. We want that financial freedom. But for him, his eureka moment, and this resonated with me, is he stopped focusing on wanting to make money and help others. And he said, that's when he saw the greatest wealth come in.
Interesting.
So that's lingered with me. And I love helping people, and I just thought that was really interesting. So, a lot of these things just stay in my mind, and I keep thinking about it and thinking about it. So that was fun.
More will surface tonight, I'm sure. And, Rick lives that, right? I've been a benefactor of that. He's very gracious with his time, spends a lot of time and energy reaching down to the next generation. One of the few who gave me a big kick in the ass like 12 months ago. Said, you got to start sticking your neck out, right? This isn't enough. You're not doing enough, which I loved. Okay. Now you mentioned a lot of big names that we know: Doug Casey, Jim Rickards, Jim Rogers, Frank Giustra, Rick Rule. Who's off the radar though? Who should our audience be paying attention to that is less known?
Okay. Yeah. Okay. I love this. So I've discovered some new gems. I feel like it's like mining in a way. And when I find that person, I'm like, yay, and that's something I just want to say I'm proud of that I built at Kitco, my prior life, where I have a good sense of if someone's going to be a talent. Like I'll meet them and be like, you know what? I think there's something there. And if I could help propel that person and give them a platform, that brings me so much joy. So, for example, when I first had met E.B. Tucker, who's a speaker at your show, I was like, this guy's going to be phenomenal for camera. He should have a newsletter. And I'm not saying that I am the reason to success at all, but I knew he'd be good for interviews. And in fact, he's, done extremely well.
For a guy who has zero social media presence, EB's made himself quite the name.
Yeah. So off the radar. So, and this might be not off the radar for you, but they were for me, was I just met Lawrence Leopard, who's a newsletter writer. I've had him on twice now. The audience loved him. I highly recommend people follow him. I think he resonates really well with the audience. I'm a big fan of Vince Lancy. He's really like this classic New Yorker, kind of disgruntled trader, old school, but tells it like it is. And he's the founder of Echo Bay Partners and also is a writer for Zero Hedge. But I like him because he always offers, just a different perspective, So in terms of two new people on my horizon, yeah. And actually, this week I just had Lynette Zhang on.
Interesting, yeah.
Okay. She's a chief market strategist, I believe, at ITM. I had never interviewed her. Now she has a huge following, but I just liked her matter-of-fact way of speaking. And if the times, like even if I don't agree with them, but the way they present that information and it makes me think and reflect, I'm like, hey, I'm all for that. So those are just a few names that I've been following more closely.
Okay, I appreciate that. Now, one thing you must do, and I find it myself doing this with my guests frequently, is you hear, 10, 11, 12 perspectives, and without question, you end up identifying where there's consensus, right? And that's where I end up spending the most attention, right? If I think back to last winter and early spring, every guest I had on the show, 90% of them were telling me something along the lines of, I've got a non-zero position in Bitcoin, right? They're pushing some percent of capital that direction. Now, that's all I have to see, enough times over a variety of individuals to know there's a wave of money moving that direction. So I want to put myself in front of it. Obviously, that ended up being a great trade. So this year, Daniella, does anything stand out as consensus? All the guests you've spoken to so far in 2021, where is the most bullish sentiment consolidated?
Right now, I'm feeling the heat on copper. And I'm not saying it. I'm just saying where I'm feeling the energy from the guests: copper, uranium. And I think there's a lot of hope riding on silver.
Interesting.
And I really hope for the silver investors.
Yeah.
This will pan out. So this whole like movement towards greener energy, electrification, how necessary silver will be. I hope this will be the breakout, if not this year, next year, for silver. But right now, it's like copper and uranium are feeling hot to me.
Interesting. Okay.
Yeah.
Very cool. I think that's a great place to wrap it up. Look, thanks so much for coming on. It's about time we did this.
Hey, continued success, Jay. You're killing it. And I can't wait to be back at the next VRIC.
Yes.
So it's one of the greatest conferences I attend. So I look forward to that.
Yeah. Fingers crossed this January. We'll see you back in Vancouver.
Absolutely. A lot of fun.
Okay. Thanks, Daniella.
Thanks, Jay.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined again by Serafino Iacono, the Executive Chairman of Gran Colombia Gold Corp. Serafino, it's great to see you again. Thanks for coming back on.
Thank you for inviting us again.
Yeah, it's a pleasure, and I'm excited to get an update. There's a handful of topics I want to run through with you today in the time that we have. I want to get an update on Segovia and production. I want to talk about how you position Gran Colombia, as I was saying prior to hitting record, almost like an investment bank where you've taken large positions in some of the most exciting emerging companies, from Eris, which we've talked about on the show before, Denaria Silver, a newer company my audience might not be familiar with, and of course, GoldX, which is a really exciting development. So why don't we start with Segovia, the bread and butter of Gran Colombia, and we're on pace to do 220 ounces of production, correct? Anything you want to update my audience on specifically?
Sure. Look, it's exciting times. The COVID affected us just for 3 weeks. So we are literally short 3 weeks, but we're catching up. I believe that we're going to achieve our upper part of the guidance that we have. Gold is being produced perfectly. The company is running now smooth. Maybe we can start a little bit with what we see coming this year. This year, it's going to be a very critical year for us. It's the year that we are, first of all, the Carla mine is coming into operation, so material is going to be coming out of the Carla mine. We are concentrating our efforts this year to 60,000 meters of drilling. And this drilling, it's exactly to do what we've been saying, that once we felt comfortable, we had the money, we had ourselves positioned well, concentrate on the 24 additional mine that are still shut down and ready to be developed. We have a program that it's a very aggressive program, and the program is to bring in, number one, reserves up, number two, resources up, and to continue to increase those reserves and resources. The good news also is that as we starting to drilling in areas like Vera, we announced a few weeks ago, the market sometimes just doesn't pay attention. In Vera, we announced some incredible drill holes. We're talking about areas with 50 grams, 60 grams of gold, and 400 grams to half a kilo of silver. So very, very profitable area. These are old mines that were mined in the 50s and 60s. We are now drilling, opening them up, trying to understand what they are. And this is the continuation of the rest of the area in Segovia. So very exciting year this year. It's going to be a decisive year, 21, 22. It's gonna take the company into deeper, where we have we're still finding some incredible grades. And the other exciting part is that we're going to be expanding the mine to 2,000 tons. So we're going to have a bigger capability of us processing more material and possibly taking advantage of processing some more material that normally we wouldn't process into this thing.
Okay.
And take advantage. The other exciting thing is that within the next 3 months, we're going to be putting into operation the concentration plant from the tailings. We're going to make a concentrate that's going to recover all the silver that gets left out of the recovery, the gold that gets left out of the recovery, and the zinc and lead that normally we wouldn't recover. So this thing is going to recover. It's going to be a great investment that we did. It's going to come into operation. I think within the next 2 months, we're going to start producing this concentrate.
Right.
Not only does it bring additional income into the company, and it's a substantial amount of income. We're looking somewhere between $8 and $16 million a year, additional money. But we're also doing something that is incredible. We don't have to dispose of these materials that, with heavy metals like lead and zinc. We're going to be recovering them. So the tailings that we're putting back are now much cleaner than they used to be before. So.
Got it. Okay. So there's a ton to unpack there. First of all, it's remarkable you were only put on pause for 3 weeks. That's right. And that's quite an outlier scenario for this year for companies like yourself. So a couple questions then. Fino, we're looking at a pretty aggressive 60,000 meter drill program at Segovia, but we can expect more results probably ongoing from Vera and your other properties. With your current production, are you going to have to go back to the market for capital to continue to expand these resource and reserves, or are you satisfied with what you're sitting on? You're good to go.
We're sitting. Look, the company is also in a great situation. Even with the gold prices being a little bit down, we're still making great money. You have a company that right now we're sitting on $100 million US in cash. Okay, we are paying $10 million worth of our debt. Our debt by the end of this year is going to be less than $20 million. Insignificant to what we have. The company doesn't need any money right now to do any expansion or to do any drilling. Everything is basically under control, and our dividend policy is still going to be in place. What we talked about last time, that's the most important thing. I wanted to have a sustainability capacity for us to pay that dividend, not to pay it once in a while, or if gold is up or gold is down or whatever. I want to make sure that once we said that we're going to pay that 3% dividend, that 3% dividend is sustainable. Yeah, and we believe we are.
Excellent. Okay. Now I want to dive into some of your holdings, because when I opened up, I said it's interesting how you position Gran Colombia. Let's start with Aris Gold. I believe you're holding 44% of that company. What developments should shareholders be paying the most attention to right now?
Well, look, we're very happy with the management team. Neil and his group are top of the market type of guys.
Yeah.
So they're going to take this project instead of, first of all, it frees us from concentrating on Gran Colombia. Now, we are very happy with our investment, because I know Neil's going to take this mine into production very quick. So for us, we like where we stand. We like that what's happening in Marmato. Mm-hmm. Marmato is moving along well with getting the construction going. But most important, what I like that Neil also realized the value of the Juby project in northern Canada, and is now going to be spending money to start getting a scoping study, I would imagine, or pre-feasibility going on that, so that he has a second mine pretty soon to be going up also.
Got it. Okay.
So we're very happy about that.
Yeah, and Neil Whittier, for people who aren't familiar, is a legend in the business, and the whole team at Aris. This is the team that you get the opportunity to bet on like once every 10 to 15 years.
Absolutely, and we're very on their side, and we're very confident that they're going to take this company to great levels.
I believe it. Yeah, no, it's a big piece and a growing part of my portfolio, Aris. Okay, so let's look at Denarius right now. It's a newer silver project that people might be less familiar with. Again, you're holding 36%, I believe.
Correct. What we wanted to do is look. One of our strategy has been that we had inside our company, Gran Colombia, a couple of assets that were undervalued. Aris is one of them.
Right.
Okay. And actually, we got no credit. And crazy enough, even though we own almost $200 million of Aris Gold, we still don't get any credit for that, which is the craziest thing of all. It's like it didn't exist. But to us, for our shareholder, that's a great value to have. Now, we wanted to do the same thing with the Zancudo mine. Zancudo is a joint venture that we had with IM Gold. IM Gold is drilling. They're doing their work diligently. We find some incredible results. We published some of them. We're going to be publishing more drilling that is coming into place. It's a fantastic deposit, but it's a deposit that's got more silver than gold. The same thing with Guia Antigua that was put in by Goldex because it was more silver than gold. So to give you an idea, the Zancudo project, it's got 7 grams of gold per ton. Very, very reasonable amount of gold. But it's got 0.5 kilo of silver per ton.
Right.
So it's more silver than gold. Same thing with Guia Antigua. Guia Antigua, you have 7-8 grams of gold, but you have 300 grams average of silver with up to 3 kilos of silver per ton. So we wanted to create a company that would concentrate more on the polymetallic aspect of the company. And so we said, let's put these projects and get them in there. The interesting part now is we added to this company a project in Spain that once we finish the due diligence and once we can go through the closing of the acquisition with an Australian group that had the rights of the property. Once we know and we feel comfortable that we can close, it's an interesting project. It's a project in near Sevilla, Spain, in Andalusia. It sits right next to the Mazda mine that belongs to Mubadala and Trafigura. It's a big copper producer. What's interesting about this project, it needs work to be done, probably 12 to 24 months worth of drilling and putting some scoping study. But what's interesting, it's got 20 million tons of resources with 4 grams of gold, 1 ounce of silver, 1% copper, and 2% zinc and lead. It's a fantastic polymetallic with some great gold grades, open pittable, so very easy to manage, and with a major plant 6 kilometers away already built that we can probably bring material to them and use it at the process.
Okay.
So we like that, and we like the exposure on silver. So you made a comment, that we look at sometime of our company as a sort of like an investment vehicle. It's turned out that way by accident more than anything else. I wanted to get value on some assets like Aris Gold, what we did in Denarius.
Yeah.
And then we wanted to do some smart investments that then would consolidate this company and would give this company a portfolio of projects that down the road, either we develop it ourselves or we did a smart investment for our shareholders.
Right.
One of those is Goldex.
Yes, and I want to talk about that next. And right before we do, though, I guess I'm curious, your comments about Gran Colombia is not getting credit for the value of Marmato, for example. That's why it's now in Eris. But even still, holding 44% of that company, you don't feel like Gran Colombia is getting the deserved credit for that. Do you think, what are we waiting for then? Once Neil gets Marmato to production, do you expect that to change? What are investors missing on this one, sir, if you know?
I think they're starting to come in and realize what this company is. It took us a while. Look, I took this company from being a company that was in the verge of almost bankruptcy.
That's right.
And, very difficult times. $150 million in debt, gold at $1,000 an ounce, cost of production were $1,300. Well, we managed to turn the company around. I still believe that there is a lot of people that they remember this company like it was 5 years ago.
Okay.
But they're starting to realize that it's not.
Yeah.
Why is it undervalued? Because I put it to you this way, 220,000 ounces of gold production a year. Standalone Segovia. We own a mine now through Eris Gold that we own 43% or 42%, whatever it is, that it's worth close to $200 million. So I produced 220,000 ounces of gold. I'm the largest single shareholder into a company that it's fully financed and is going to go and produce 200,000 ounces of gold by 2024 at the latest. Okay, so I have $200 million in value there. I have $100 million in cash US. I own 18% of Goldex, which today it's worth about $70 million, $80 million.
Okay,
so $280 million plus $120 million in Canadian. Now I'm talking about you're talking about $400 million right over there alone.
Mm-hmm.
Plus now we own 36% of Denarius, which is worth another $35 million, $30 million. So put altogether $400 million Canadian in value between cash and securities.
Sure.
And I have a $375 million market cap. Does that make any sense?
Right.
It doesn't make any sense. That's why I'm a buyer of my stock. And by the way, I pay a dividend on a monthly basis.
Yeah.
My debt is reduced, and we are a very disciplined company.
Yeah, well, that's how you're able to execute the turnaround. That's the story that I think people that are just tuning in now need to catch up on is the history of Gran Colombia, the turnaround story. It's the comeback kid story. Okay, so and what I see there, I guess, is security. When you talk about you issue the dividend, but a lot of companies issue dividends in a good market and then can't keep it up when times get tough. I see these assets you position in the Gran Colombia. I see security that'll protect my dividend as a shareholder. So let's talk about Goldex a little bit. 18% interest. What should investors be paying the most attention to, Serafino?
Well, look, Goldex we looked at Goldex always in the beginning for developing it, and we took a position in the company because of that reason. We made a first attempt when the Zijin came, when Guyana Goldfields was up for sale. We bid for the company because we had, and still stands to be, one of the best ideas to get those two projects going. Our project with the Zijin project, which is Guyana Goldfields. They have a plant that processes 10,000 tons a day. They are sitting around. That was the idea for me to buy into the company and to do the merger with Gran Colombia.
Right.
They have 10,000 ton a day plant. They have a pit that it's almost finished with a 16-to-1 stripping ratio. They have to go underground. Almost finished reserves. On the other side, 60 kilometers away, sits a project with 6 million ounces of gold, open pittable, with high grade, with a pit with high grade that is about 4 to 5 grams per ton, with a mine life of about 10 years that you can bring into that material. Plus a huge deposit with 6 million ounces of gold and 280,000 tons of copper in place. So this project is a perfect marriage with that other plan. It didn't work out. We stepped back and we said, let's wait and let's develop our project in in Colombia, get it, that we gave it to Neil's group. Now we want to concentrate ourselves in developing that project. We are the largest shareholder of that company, single largest shareholder with 18%. And if you put the warrants in there, we're more like 22% into the company. So we decided that we want to buy it because if there is one area that I know is the Guyana Shield. I built 3 mines in Venezuela. It's the same environment. I believe that this project is ready to be built. It's been sitting around for 10 years with trying to get developed. I think that big, ambitious projects to be done, project $2 billion project, we don't want to do a $2 billion project. We want to start with a small pit. Hopefully, we'll be able to do a deal with Zijin, with the Chinese, to use their plant and execute what I just told you that I wanted to do originally. Otherwise, we're going to build a smaller plant to process 5,000-6,000 tons a day. It will cost $375 million to build it. We already did a scoping study on the project to build a whole mine. We have a beautiful thing over here. We have Wheaton ready to write a check between $150 and $200 million into this project. So I got 2/3 of the project already financed, almost, at least 60% of the project. Gran Colombia sits in cash. And in the worst case, I will do the same thing that we did with Aris Gold. Go out, raise the rest of the money, and develop this project. And this project, within 24 months, if we do the deal with the Chinese, we can have production within less than 12 months. And we could produce 100 to 150,000 ounces out of that mine using their plant. If not, 24 to 36 months, we'll have that mine into operation with our own facilities. And that's what I want to do. And I believe that that's the next step to de-risk Colombia, because one of the biggest problems that I've had, Jay, has been everybody comes to us and says, well, you're on one country, one mine risk. And I'm trying to say to people, we're not. First of all, yes, we are one country. It's the country that I know best, and know-how and know-who is just as important as anything else, as I always say.
Yeah.
So to me, Colombia, and it's not a one-risk company. I own Aris Gold, which is a second mine, that owns also a third mine in Canada, which was my idea. Now we are diversified with Denarius to go into Spain. And we're going to be looking at other opportunity. And at the same time, with Goldex, Gran Colombia has a foot in another country that we feel very comfortable that we work. And we can take our production to 400,000 ounces a year very easily.
Right. Okay. That's the system-wide. Okay. Thanks for that explanation. Look, Serafino, it's been great having you back on and getting sort of a bigger picture of the ecosystem at Gran Colombia and all the various moving parts, because it is a bit of a complex story, right? You need to dive into it. And when you say you're undervalued, I find this often a relationship between undervalue and just a retail investor not quite understanding where the value lies yet, right? And there are many moving parts to the Gran Colombia story by design, but for good reason. And so I appreciate you coming back on and updating our audience and letting us behind the curtain again. Thank you.
Thank you for giving me the time, Jay.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Willem Middelkoop, who's the chairman of Commodity Discovery Fund, really one of the pioneers when it comes to discovery investing. Willem's also the author of, I think, 7 books, Willem, focused on the financial markets and economics, and a very respected name in the natural resource business. So it's a real privilege to have you on the show right now. Thanks so much for your time.
Well, thanks for the invitation. Great to finally meet you. Of course, I met your dad already 13 years ago. I was a visitor in 2006 at the Vancouver conferences, so I go way back.
Okay, well, hopefully we're going to be back in the physical form January 2022. Wait and see. But Willem, since I haven't had you on the show before, for anybody who's not familiar with the Commodity Discovery Fund, with what you're up to, can you give us the highlight reel? What do you spend your time doing right now?
Yeah, as you said, I think we're one of the very few full-time dedicated discovery investors worldwide. We know a few other discovery investors. Eric Sprott, of course, became famous by investing in early stage companies. Warren Irvin is somebody like us as well. But there are very few around. Actually, many resource funds exited the exploration business after the collapse of the market in 2011. I've been a private investor in this space since 2003, 2004. I've been a professional journalist for 20 years. I was a Dutch market commentator for Dutch National TV between 2001 and 2008, and I was a private investor in the resource space. And when I started to invest in gold and silver mining companies, I noticed around 2004 that small companies making large discoveries do much better. And I was a very early investor in Uranium Resources in 2006, which jumped from 30 cents to $40 within 18 months. And that really got me hooked on discovery investing. And we built a system in which we concentrate on the smallest companies responsible for the largest discoveries. And to give you an example, our fund was up 85% last year because of the gray mining, up 99%, because of a large gold discovery in the Australian Pilbara, and Greatland Gold. That was a second largest position, also a gold discovery in Australia. So we're metal agnostic, and we don't focus only on North America. We cover the whole world. So, and I think that's a large difference from most of our peers. They tend to concentrate on the North American market, and they tend to forget what Australian business is like. And Australian investors, they don't focus on the North American market, so they only focus on their national resource place.
Okay, yeah, no, thanks for that. So seeing as you're metal agnostic, what can you tell me about the fund right now and your exposure and to which commodities?
Yeah, as a discovery investor, we're metal agnostic, so we don't care whether a uranium company or a copper or gold company makes a discovery. We always follow the best discoveries. So we always have this top 50 of developing discoveries worldwide, but we try to focus our portfolio towards precious metals for 60-70%. And that's because most of the books I've been writing were about a pending credit crisis, a pending monetary reset. I'm the author of The Big Reset. And our macro point of view, our macro analysis points towards a growing role again for gold, and silver will follow. So we try to have a large weighting in the precious metals, and then we have a 20% weighting for the base metals, copper, nickel, zinc. We focus on the battery metals in that respect, and we also like uranium. So uranium is like 6-7% of our fund as well, and we invest most of our money through private placements because that's the best way, I think, to get the most value for your money, especially in the Canadian markets.
Agreed. So, following that thesis, you're seeing a growing role for gold and silver will follow. Are you therefore surprised, Willem, at the performance of gold over the last 7 months? If you look at the macro trends, they're real favorable, right? And for reasons we all know, but the metal price hasn't performed to a lot of investors' expectations. So tell me about yours.
I was especially surprised by the way gold behaved in the last 7 years, that it took 7 years to bottom out, because gold in euros, we're here in Euro country in the Netherlands, gold bottomed in euros in 2013. But the gold equities only bottomed, actually March last year, one could say. And we had this wonderful first recovery phase starting late March last year. We saw a top in the gold equities around start of August last year. We follow Elliott wave counts a lot, so we tend to trade quite a bit around our positions based on the Elliott wave counts. So we scaled down our gold investments seriously in August and September. And we diversified our portfolio into some other plays. And that has really worked out well. Because if you look at the GDX is almost flat for the year over the last 12 months.
Yeah,
we're up over 100%. And since the early August, the GDX is down 35% and we're up 10%. So it really helps when you understand that you shouldn't try to predict the price of gold from fundamental reasons. You can say there's so much money printing, gold price needs to go up, but there are always these strong corrections. And we became humble because 10 years ago, when I started the fund 12 years ago, I thought I could predict all these price movements by just doing some good fundamental research. But then during the long downturn in which many of our peers even, stopped or really lost most of their money, I learned to pay a lot of attention to the technical indicators and to the Elliott wave. Elliott wave really helps us.
Okay, I'd love you to dive into that because I'm actually not super familiar with the Elliott wave. So can you describe how this impacts your decision making and what you're looking at?
Yeah. Elliott wave is just a form of technical analysis, and actually it tells you that every strong move up has 5 phases. And the first phase is when nobody believes in it, and it's very surprising rally. That's what happened last year, April, May, June, and then you always get a big correction, can bring you down 62%. And that's when everybody starts hating the space again. And that's the phase we're in now, and nobody's bullish. Only 20% is bullish on gold. And that's when the real recovery starts all of a sudden. I think we're on the verge of that point. And then you break out of the downtrend, the downtrend we've seen since August. And then you get the strongest rally, which is the phase 3. And that's the longest and that's the strongest rally. So you can expect a stronger rally, even stronger rally than we had last year. And it will take longer as well. And that might bring gold up towards 2,500. There's a very interesting situation around silver. You must be aware of the silver short squeeze movement. I've been following silver for 20 years. I've been an investor in physical silver for 20 years. So that's something we follow, and I think we're on the verge of a break of $30 again in silver. As you might know, silver is the only commodity, only metal, which is trading at a 50% discount compared to 1980 levels. So silver has some room to run, and I'm a big fan of Eric Sprott's writings and line of thinking. And Eric Sprott always told us that once silver breaks, once the paper silver market breaks, you could have a run towards $100 silver within a few weeks or even a few days. And that's why 15% of our portfolio is silver related now. And there was only 3-4% last year.
Okay, interesting. Yeah, that's hyper bullish then when you put that in context. So 2 follow-up questions off of that, Willem. First, and it's kind of a gimme. It's easy to claim foresight and hindsight, but based on your Elliott wave theses, I was curious as well last spring, coming out of the collapse in March, how frothy the metals market became very quickly. And I had a lot of conversations on this show with individuals, and I was asking that question. I was like, all of a sudden, recreational investors who have never had exposure to precious metals are asking me for gold investing tips. And I've seen enough cycles to identify the red flags and things start to get frothy. And so I wondered if things heated up too fast, too quickly. But most of my guests said no. This is exactly as I expected. In fact, I expect it to get hotter. Obviously, we've since seen the correction. So can you tell me truthfully, back in the spring, June, July, were you anticipating a correction to be as stark and long lasting as it's been?
We expected the correction, as I said, because we scaled back our investments in the precious metal space around August.
Okay.
We thought it would take a little shorter, let's say 3-4 months. But as you might have experienced yourself, trends always take longer on the upside and the downside.
Yeah.
And especially in the metals and the precious metals, once they run, they keep running, because the run from March last year till August was an amazing run. We were up 200% from the lows, from the March lows. And then you have a correction, always takes longer than you think, always another leg down. We're on the verge of a breakout now, but we might have one more move lower. And then out of a sudden, there will be a very strong rise. And it will be a vicious rally. It might be a vicious rally, and might be that vicious that if you're not in the market, you don't dare to enter, because we will go up, 4 or 5% a day, and this can go on and on for some time, just like we had last year. And if we look at our charts and if we listen to our advisors, A.V. Gilbert is a great technical analyst in this respect. I expect a jump for a rally for GDX, 50 to 80% later this year. And it can start any minute.
Okay. Now, second question on this topic, and then we'll move on. You covered phase 1, which is the initial rally, phase 2, the correction, phase 3, the prolonged. What's phase 4 and 5 look like?
It's very important to scale back your positions after in the end of the phase 3. And phase 3 will be a 1, 2, 3, 4, 5 in itself as well. So most of the time, it's not that difficult to see, especially when the market goes up in a parabolic way. That's the time to scale back. You see that with Bitcoin as well. Once you go parabolic, then you need to take some profit. So we expect a rally for GDX and precious metals related equities of around 50 to 80%. And then you really need to take profit, because you'll have this correction, the phase 4, and that can bring you down 20 to 40%. And then you will have another strong rally, which will bring you to the top of the cycle. This won't be the end of the commodity bull market or the gold bull market, because if you look at the very long-term chart, the monthly chart, I think you could say that we have seen a generational low in commodities around 2016, 2020. Right. 2020 was a double bottom compared to early 2016. And a generational low means that you could have a decades-long bull market in commodities. And if you see all money printing worldwide, it's quite logical to expect inflation will turn up. We see the first signs of that. You might see more investors start to flee out of paper assets towards hard assets. Bitcoin is also a great example of this, flight to safe havens. Right. But it's important to time the cycles and to trade around your positions. But if you're a buy and hold type of guy and you're 40 now and you want to save money for your retirement, you don't have to trade. This is the start of a bull market, and just sit down, sit back and relax, and we'll do well.
You know what I like about this is I can find direct correlations to the sentiment indicators that I look for. I mean, I run a conference business, so I talk to people for a living. I do this for a living, right? I talk to people and not just professionals like yourself, but we have thousands of retail investors that attend our events, that have a Monday to Friday day job and also play the market. Yeah. And those conversations are the best indicator that I have. Yeah. When I sort of just watching sentiment become a bit unrealistic, right? And I like hearing the technical version of that, which is what you pay attention to, because it's off my radar, right? It's not what I focus on. So I appreciate that. So thanks for that explanation. I didn't expect to go as deep into the LA wave as we did, but
when we see markets, when we have this exhaustion gaps down, after a long correction, I always know when we're very near the bottom, because then we have over 1,000 high net worth investors. But then you have this day that I arrive, that I see my mailbox, and I have 5 mails in my mailbox about people, people panicking and wanting to exit their investments. And that's always the best indicator that the bottom is near, when people start to send me those kinds of emails.
Yeah, well, it's good, right? And it happens to the best of us. I mean, I'm no veteran, but I'm not new to this market. And, I cut my teeth in the resource business really from 2011 forward. So it was a very tough bear market, right? Which is a great time to cut your teeth in anything, right? At the bottom, because the individuals who stick around typically are there to work hard, and they're not there for a free ride or easy money. But as a consequence of that, I think I'm used to kind of riding the bottom of things. However, I look at my portfolio now, I'm very weighted in precious metals. And even, I'll still question my conviction and say, was I correct? Was I right? Did I miss something here? Right? What am I missing? It's a conversation that I think every investor goes through. So anyways, I want to move on a little bit, because you mentioned Bitcoin a couple of times. And, I'm glad that we focused this conversation on precious metals, but I do want to touch on this just because it's so timely right now. It's another asset class where I watch sentiment, right? And I watched the Bitcoin rally of 2017, and we all saw this parabolic rise, and then the crash that followed immediately after. And I attributed that to sort of a retail dollar rush into the space, right? And typically, I think a lot of that buying activity in 2017 was inspired by the fact that the price was going up. And that encourages more buyers, creates FOMO, creates more buyers who pile in because the price is going up, which isn't a great reason to buy anything, right? And that's why things crash as hard as they do. This rally in Bitcoin was led by much more conservative, long-term money, for the most part, and still is, right? Corporate treasuries, all this stuff. But now I'm seeing these red flags. I'm seeing the frothy red flags, the evangelical Twitter personalities, the celebrities like Lindsay Lohan tweeting, if you don't own Bitcoin, you're an idiot. And every ounce of me says it's time to hit the bid, but I haven't yet. I stopped.
Not yet.
So tell me, what's your stance, Willem? What are you doing? I know you hold some Bitcoin.
Yeah, and I've been following Bitcoin for a long time. In the big reset, at the end of 2013, I said that Bitcoin is digital gold. But I wasn't investing in it myself, because I always thought, I have the real thing. I've got gold and silver. So why should I buy the digital gold? And I was also of the opinion that the G20, the powerful leaders of the Western countries, they would start to fight Bitcoin at a certain point, because it's an enemy for the fiat money system. But around 2018, I became convinced that the G20 was choosing to regulate the crypto market instead of to fight the crypto market and fight Bitcoin. And once you regulate it, you accept it. And once you regulate it, it becomes an asset class. And once it's regulated, the institutional investors can enter it and add it to their portfolio. So from 2018, I started to invest personally into Bitcoin around $5,000. Because again, I was making the technical analysis. So we had a hype in 2017 and the very strong correction, which brings markets down 80 or 90%. And then I dared to enter the market. And we've been thinking about how to handle crypto within our portfolio, because we are hard asset investors. Yeah. I don't want to build another fund. I don't want to build a crypto fund, although there's huge demand for that. So from a business point of view, I really should start a crypto fund. But we decided to start adding crypto assets to our portfolio. I think we'll start later this year. We're having some legal experts, researching this topic now and advising us. We're a UCITS fund. We're a highly regulated fund, so it has to fit within all our rule book, and so we have to change our prospectus. But by only investing in listed equities which are connected to the crypto space, like ETFs and the listed miners, I think we can add digital hard assets to our standard hard asset portfolio. And if we could add around 10% of if we could change 10% of our portfolio from hard assets to physical hard assets, that would be a great diversification. And you might know that Bitcoin, once you have a rally, it's such a strong move. So you only have to be for 5% of your portfolio should be connected to that rally, and then that would work out very well for the whole portfolio. So that's the way we treat Bitcoin and crypto assets now.
Okay. Yeah, I'm with you. That makes sense and speaks to my strategy. And, I dollar cost averaged in most of last spring. Didn't ever expect to trade it. Never planned in it. Still don't. But it's there. I just wanted a horse in the race, Okay. Willem, it's been great having you on. Thanks so much for making the time. It's about time we had you on the show. So I really do appreciate it.
Thank you.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Doug Hurst, the chairman of Northern Vertex Mining Corp, among many other things that we were just talking about off camera, the founder of International Royalty Corp, founder of Newmarket Gold. I want to get into a lot of these stories. Doug, it's an honor to have you on the show. Thanks so much for coming on.
Well, it's a real pleasure, Jay. This will be a good conversation.
Good. Yeah. Well, there's a variety of places I could start, but where I thought would make the most sense is in the last 18 months, royalty companies have been the buzz, right? And there's been a ton of new listings and investors have piled in. With your background with International Royalty Corp, I just thought it made a lot of sense to start there because you're one of the pioneers in that business. And we were just going over the founding of IRC and all of this. And I'd love you to walk us through how you founded your Royalty Corp.
Sure. Well, so it was really Doug Silver and I, and Doug Silver is a great guy, good mind, and he and I found that we were throwing a whole bunch of business ideas against the wall, kind of like in college when you threw spaghetti against the wall. It's not done yet, it's not quite ready, so we threw a whole bunch of business ideas against the wall. And one day he called and said, "You know what? I think we need to start a royalty company." And he had described that he had sold a royalty on behalf of a client to Royal Gold. And so he looked at the overall royalty market and realized that there were no Canadian royalty companies listed at that point. Now, Franco and Euro Nevada had really broken the mold through the 90s, and they'd grown to become a big company with $1 billion of cash in the bank. And the fascinating thing is that Pierre and Seymour figured out that a royalty company was trading at 2 times NAV, so twice the value of a normal gold company. So for every dollar of assets that they were perceived to have, the market gave them $2 of value. So for 5 or 6 or 7 years in a row, they, between Euro and Franco and then the merged company, Franco, they raised $50 to $100 million a year of unallocated working capital. And they just threw it in the bank. I mean, there weren't enough royalties for them to buy.
Right.
What that did was that $1 billion in the bank gave them $2 billion of market value.
And what year was this, Doug?
So that was through the 90s. I don't remember the year that Franco disappeared into Newmont.
Yeah, okay.
But it was in the late 90s. So Barrick made the discovery at Gold Strike. So that was in the late 80s and the early 90s. And just as Barrick had made that discovery, Pierre and Seymour bought the royalty. I mean, it was wonderful, wonderful, fortuitous luck. But, you know, when they got something good, they knew what to do with it. So fast forward, Doug Silver calls me up and says, "Hey, we got to start a royalty company. Do you want to join the board?" And I said, "Well, of course. Let's see if this works." And I put the phone down and I thought, no, this is the idea. This is the idea. This is the spaghetti that sticks to the wall.
Okay.
I called him back and I said, "Doug, I'll drop everything. Let's go. I know a couple of places we could probably find a couple of producing royalties. Let's see if we can't make this work." So we approached an old friend of mine in Toronto, a guy named Claude Bonhomme, and we bought his 0.25% royalty on Hemlo. Wonderful guy, Claude. And we dashed around trying to find the financing, and the price to buy it was, I think it was $3.8 million. Okay. And it was cash flowing between $500,000 and $700,000 a year. And so it was, 5 or 6 times cash flow, which is an extraordinary number if you know what the current royalty value is, right? 5 times NAV. So that's 10 or 15 times earnings, right?
Yeah.
So it was an extremely cheap price. And we also had the advantage that gold was $300 an ounce. Copper was under $1. Nickel was $3. Zinc was 40 cents. Lead was 25 cents. And so we knew that we could negotiate prices that the 30-year lows in all of those commodities was going to skate us on side. So it was, so at first it was kind of shooting fish in a barrel, and we were the only company around. Now, shortly thereafter, as soon as we listed, on came Gold Wheaton, Silver Wheaton. Franco came back out of Newmont and relisted. Royal Gold was completely re-energized, and so we were early to the party, but the party got hot and heavy very quickly.
Got it. And Royal ended up purchasing International Royalty Corp for $700 million, correct?
They did. Yeah. So both Franco and Royal got into a bidding war, which was wonderful. Yeah. And Royal won the bidding war, and that was a wonderful transaction. Yeah.
Right. Okay. So what do you do after this, right? This is a colossal win, potentially a life-changing transaction for you. You've built and sold IRC. What's next? What were you thinking at the time? Because I know what you did, went on to found New Market Gold, which was another massively successful exit to Kirkland for $1 billion. But at the time, were you thinking of stepping back, or were you ready to charge into another opportunity right away?
Well, I did. I mean, things got very quiet for me. I played with my kids for a couple of years. It was wonderful. Yeah. And as a side business, some friends here in Nelson and I started a small run-of-river hydro company. So we played around with that for a couple of years, and it really went nowhere. And we sort of paid most of our investors' money back. And then just having been in the business for 20 years, I got a call from Doug Forrester, who said, we have a shell called Raystar, and we're thinking, we've been approached to to start a royalty company. And, you should join as a director, come jump on. Let's see if we can make this go. And that royalty idea didn't work. And I knew most of the directors at that point. So there was Blaine Johnson and Doug Forrester I'd known for a very long time. Great guys. The other directors were, it was Randall Oliphant and Lucas Landine. So, and then, so I had the privilege of joining this cast of characters. And so after the royalty idea didn't work, we started looking around, and actually we brought on a really wonderful guy named Ray Threlkeld. So Ray Threlkeld joined as our chairman. And so the four of us, Doug and Blaine and I and Ray, started looking around for other ideas. And along came Crocodile Gold. And Crocodile Gold was one of those companies that the market had really forgotten about. All of their mines were in Australia, but it was a Canadian listed company. So we jumped on a plane and flew out and looked at the assets. And the key asset in that company was Fosterville. Unbelievable. So we got there just as they had pulled a few early drill holes from what is now not the Swan Zone. So we saw drill core, 5, 6, 8, 10 meters of just gobs of gold, hundreds of grams of gold, just as we were doing our due diligence. So we couldn't get home fast enough to complete the deal. And it was wonderful. And working, Doug Forster was the CEO, did an incredible job, absolutely wonderful. And he and Blaine worked so well together. And I was just so privileged to be part of that team. And it worked out incredibly well. I mean, from the day we bought Crocodile Gold to when we sold was, about 18 months.
Yeah, that's outstanding. A remarkably fast turnaround. Were you expecting to catch Kirkland Lake's attention? Was that in the vision?
Well, no. So what we talked to many producers in Australia, and we talked to a few in Canada. When you're doing business in another country, especially Australia, talking to a fund manager about raising money or buying your shares, and they call the guy that they know in Australia. And, so we had several of those kinds of interactions, and they would call the guys that they know in Australia. And what do you think about Fosterville? And they go, it's kind of a dog with fleas. You don't really want to deal with that. And no one really understood what had happened or what had transpired in the exploration at Fosterville. So it took a while to overcome that scar tissue that the industry had built up around Crocodile's assets. But once we overcame it, it was just lights out. The merger with Kirkland Lake, we talked to several groups about it, and Eric Sprott had bought a nice chunk of Newmarket, I think 17% of it, and he had 15 to 17% of Kirkland. And so the obvious place to go was to go to Kirkland and say, you know what, Eric Sprott owns a chunk of you, and look at our assets. And so that's how that merger came together. And it was a wonderful win for shareholders, for sure. And many of us kept a good chunk of our stock in Kirkland afterwards. And the rest is history. It was extraordinary.
Okay, so thank you for detailing that. I wanted to start there with, International Royalty Corp, founding this company, selling it to Royal Gold for $700 million, finding the new market opportunity, building that up, selling it to Kirkland Lake for $1 billion. Notwithstanding then, Northern Empire, which you built with Mike Allen, turned around and sold to Core Mining. Again, remarkably fast. The turnaround there was remarkably fast. The reason I wanted to start there is because everything I do on this channel, I harp. It's people over everything investing. That's my approach. And, we talked about this before I hit record. You got to know what kind of investor you are in this business. And some are more technical. You may have a different skill set than I do, but I talk to people for a living. I run a conference company, and that's the hand I have. So I play that hand. I like to know who. I always invest in the who. And with that, success begets success. And that's what brings me to Northern Vertex. But prior to that, that's what brought me to Eclipse, which was the company that I covered on this channel in my newsletter in September, what brought me there was yourself. What brought me there was Marcel de Groot to Pathway Capital.
Very good.
A handful of individuals that I follow in this industry because success begets success. Okay. Now, let's talk about Northern Vertex a little bit. Let's talk about Eclipse, first of all, because when investors were looking at Eclipse, they were probably looking at, a single asset explorer. So you're looking at a relatively binary outcome. And you touched on this, right? When you put holes in the ground, you get one or two outcomes. You find something or you don't, right?
Yep.
The merger with Northern Vertex could have been perceived as a bit of a pivot for investors who are expecting a traditional exploration story.
Yep.
So can you talk to us a little bit about that and the methodology and thought process that directed that decision?
Well, your description of Eclipse was exactly right. It was binary, right? So it's either going to work or it won't, and you're either going to get good drill results or you won't. And as managers of a company, we have a broad range of risks. And there are some risks that you can control, and then there's a whole bunch that you can't. You can't control the gold price. You can't control the social environment. You can't control the political environment. And so as a way of mitigating the value of the company, you try to control the risks that you can control. So Northern Empire was a really good example of that. And Northern Empire had a couple of exploration projects, and they were drilling holes in them, and it was the binary outcome. And so the stock price went with the with drilling campaigns.
Right.
And when Mike Allen got involved, so I was a director of Northern Empire. When Mike Allen got involved, the board came to me and said, you know what, you should step up as as the chairman, or maybe even the executive chairman. Mike was a greenhorn CEO at that point. And so Mike and I created this relationship where I was really his mentor. So he went out and he figured out that he could probably buy sterling, which was an asset that the street had completely forgotten about, right? And so when he brought the idea of sterling to me, I went, what? That underground weird thing in Nevada, and he said, no, you got to jump in a plane. So I had to push past my scar tissue about that, jumped in a plane, and the main assets of sterling was sort of the resource that was permitted and the leach mine. So that was already there. But then we went to the north, and Jay, there were open pits there, and we stood on the lip of an open pit where the previous operators had mined this operation. It was called Daisy, was the operation, and this was all included in the claims that was sterling. And there I am standing on the edge of an open pit. There's a wall of 50 meters of a gram that's pre-stripped and all ready to go, and none of this was in the 43-101 report about sterling. So we got back and completed the deal, raised the capital. And then what that did is that functioned as an anchor value in the company. And the anchor value in the company meant that we could now, if we did some drilling and the drilling didn't work out, then we had a permitted project that we could put into production without having to wait for the permitting authorities to give us. So it was a way of mitigating the risk on behalf of our shareholders. So fast forward, we sold Empire to Coeur. Coeur has done very well with it. We're very pleased with Coeur's success in this project. And we started Eclipse with all the best elements of Northern Empire. And then we added a couple of other people. Marcel de Groot, wonderful, wonderful guy. We brought on the exploration manager, a guy named Warwick Board, a giant brain. He's a geological savant, very, very smart guy. And so with Eclipse, the structure of it was such that it was a binary outcome. It was an exploration play. And there were a lot of investors that looked at that and said, okay, if this Hercules thing really turns out as good as we hope it will, then there's a lot of money to be made, but a lot of investors will look at the upside and they don't necessarily qualify the downside. So for us, we had been looking at Vertex and the Moss mine for many years. We looked at it with Northern Empire.
Okay.
And the operation, when it started, it had some teething problems, but then they began to sort of clear some of those bottlenecks and the teething problems. But we always loved the exploration potential. So when Vertex started to permit drill sites outside of the patented claims, it became clear that they were going to really start to flesh out the exploration potential. And that's when we went back to them and just said, you know what, we just love this thing, and we would love to pull together a merger. And there were some stops and starts and lots of discussions, and that's when the merger happened. So we really, really love the exploration potential at Moss. And so now Northern Vertex has a very similar structure to what Northern Empire was. It had a backstop value. It had excellent blue sky potential at Moss, and it had excellent blue sky potential at the original project, which was Hercules.
Yeah.
And then at that point, we had sort of bumped over the development curve into the operations side. So
right.
It mitigated the risk for investors. Now, the stock has fallen more than we really wanted it to, and I know that some investors are disappointed as a consequence of that.
Sure.
But moving forward, there's a wonderful base value, and oh my, the blue sky potential is good. So we really like the structure of this asset. We really like the structure of this business and this investment.
Yeah. And it's exciting to me. And I wondered when the merger occurred, if you would have shareholders, Eclipse shareholders that were like, this isn't what I thought I bought. And maybe there was some selling activity. Maybe we saw that, right?
Definitely.
Whenever I would connect with somebody who would ask, because we covered the Eclipse story in depth in September. So I got a lot of incoming mail when the merger was announced, and they were like, you didn't see this coming, or what's going on? And I restated, Hercules is a great asset, but I didn't buy Eclipse for Hercules. I bought Eclipse for the people behind Eclipse, right? And you touched on a few of them, or we touched on a few of them. But you bring IRC, you bring Newmarket, Mike Allen, you guys bring Northern Empire. We have Marcel de Groot, who brings in companies like Equinox Gold, Sandstorm Gold. I mean, some of the sort of diamonds in the sector, and that's the team that you're betting on. You made an interesting point before we hit record. You said when a company pitches you on becoming a director, one of the first things you ask them is, if your bank account was full, how would you spend it?
Yeah.
And, often they'll go, oh, we put it right in the ground. We get to work, we prove out results. And your response is, okay, but then what? And they kind of shrug and like, well, it depends on what happens. Right. And I agree. But it is a binary outcome. Like you said, you'll find something or you won't. You get the results you and your shareholders want, or you won't. And so when I'm betting on the people, what I'm betting on is that they're going to have a plan C just in case, right? Plan A doesn't work out. Plan B fails. You have the wherewithal, the energy to have a plan C and hunt that down, right?
Yeah, absolutely. Well, that's the whole process of risk mitigation, right?
Yeah.
So, when I described, there's risks that you can control and there are risks that you can't. You try to control the risks that you can control. And so if you can generate a base value in the company.
Yeah.
And so many corporate managers completely miss the whole process and the thought process around the cost of capital. So the cost of capital essentially says that you can grow a company, but if you issue more shares than the value grows, then investors make no money.
Yeah.
So you can do an IPO at $1 and you can have $10 million in the bank. And if you don't do proper control of the capital markets side, then every financing that you do is a down round.
Yeah.
Or it's, you finance at $1, you finance at $1, you finance at $1. 5 years has gone by and your investors have made no money.
That's not what you want.
Exactly. And so the cost of capital is enormous for investors under that circumstance. So if you can, you try to mitigate that by, just telling people the story, making sure that that the value. I'm sorry.
I made you do all the talking. No worries.
No, that's okay. So really what you're trying to do is you're trying to generate value for your investors. And a lot of people lose sight of who you're working for, and it's the investors. And so
yeah,
if you can control the structure of the company and you can do financings that are increasing as you're moving along, trying to grow value, then your investors win, right?
100%.
So it doesn't always work that way. And markets are a fickle thing. And sometimes you have to do a financing at a higher price, and sometimes you have to do it at a lower price.
Yeah.
But if you're managing the whole process and you're conscious of it, then at least it's something that you're aware of. Whereas many companies aren't.
Yeah, 100%. A lot of chairmen, a lot of CEOs don't talk like that, right? We don't hear that narrative, that vision from too many CEOs, and that's the difference, right? And that speaks to your experience and your success. But so I'm glad I could bring you back on because, like I said, we covered the Eclipse story in September. I thought it was a smart buy. I built my position on the open market. I think it's a better buy now, right? You can actually enter at a cheaper price point. You're buying now, cash flowing Moss Mine with exploration upside and cash to fulfill drill programs at Hercules, which is an exciting asset in Nevada.
It is
arguably the best gold jurisdiction on the planet. Look, Doug, it's been great. Thank you so much for making the time. I'm really glad we could put this together. You as the chairman of Northern Vertex now, I think it's a very exciting story that I'm keen to continue to cover on behalf of my audience. So I appreciate you coming on, and I'd love to do this again sometime.
Very good. Well, I'm very pleased that we had this discussion. It's always an interesting one. And you know what? I've just had a lot of luck working with people that are so competent, and Northern Vertex is just another example of that.
Okay. I love that. Okay. Well, thanks again, Doug. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Hey guys, Jay Martin here, CEO of Cambridge House, and I am very excited to introduce Warren Gilman, the chairman, CEO, and director of Queens Road Capital. Warren, I've been looking forward to having you on the show. Thanks so much for joining me.
My pleasure, Jay. Looking forward to our chat, and good morning from Hong Kong. I guess it's afternoon in Squamish, but lovely morning here in Hong Kong.
Yes, it is. So there are a handful of directions I want to go with this conversation. A bit of background. Warren is a bit of a legend in the business, and we're going to get into this. But quick intro. A director to some of the world's biggest mining companies, including advisor to BHP, Rio Tinto, Anglo American, Zijin, a bunch more. But Warren, for anybody who's not familiar with Queens Road, maybe let's start with a bit of a high-level explanation. What is Queens Road Capital, and what do you spend your time doing?
Thanks, Jay. I've never been described as a legend before, so I really appreciate that introduction. My mother would be very proud. I hope she's listening. So Queens Road is a Toronto-listed company. So all your viewers out there can go out and buy the stock. I'd be remiss if I didn't say that as a director of the company.
Sure.
We focus on income-generating securities in the resource sector in spectacular ore bodies. We're driven by the quality of the ore body. And we generally focus on convertible debentures. So converts pay us a coupon every quarter. And we have a very efficient tax structure. So our plan is to take that coupon and pass it through in the form of dividends to our shareholders. So if you invest in Queens Road, you'll be receiving dividends. But Queens Road retains all the equity upside in those convertible debentures. So you have all the upside, you're protected on the downside, and you have income. So it's a great structure, relatively conservative structure in which to invest in the mining business, underpinned by fabulous ore bodies. Now, this is a company that I launched a year ago. So it's relatively young, relatively new, but it follows the investment philosophy that I employed for the previous 10, 12 years running a private company that was called CEF Holdings. CEF Holdings was owned 50% by Mr. Li Ka-shing, one of Asia's richest men, and 50% by CIBC, the Canadian bank that your viewers would be familiar with. Investing, CEF effectively invested Mr. Lee's money. I invested over the course of 12 years, more than $500 million of his money. Was incredibly successful. And this is literally the public version of that. So now all of your viewers and all of Queens Road shareholders can gain access to that experience. And hopefully we recreate that track record or even surpass it in the coming years.
Now I wanted to touch on that. CEF Holdings, yes, investing the wealth of one of the world's richest individuals. Did he have specific parameters, Warren? Like, were there specific marching orders about how you would allocate that capital? How did that relationship function?
He certainly had specific parameters. They weren't specific with respect to where to invest in the mining business. That was my job.
Okay.
Mr. Lee's job was to tell me whether to put my foot on the gas pedal or put my foot on the brake. And that was because, as you well know, the mining business has evolved over the course of the last 20 years to be very much dominated by China. And I would argue there is no human being on planet Earth who knows more intimately about China than Mr. Lee. At one point in the past 20 years, he was the largest single individual investor in mainland China. So he would tell me whether I should be investing or selling.
Okay.
Beyond that, he had specific guidelines to anyone who invested his money. So if you worked for Mr. Lee, you did it under the guidelines of two main points. Point number one, carved in stone, do not lose Mr. Lee's money. So we had to devise a way to invest in the mining business and not lose money, which, as you know, this is a volatile, cyclical business. It's pretty tough to do that. And we were investing through a pretty tough period. You'll recall that period, 2010 to 2018. Those were pretty tough years in the mining sector, unlike the environment where we find ourselves today. So we had to devise a philosophy, a strategy, a method of investing that didn't lose his money and yet provided him all the equity upside that we all want. So that was rule number one. And rule number two was you didn't get access to his capital for free. As I said, I invested over $500 million of his money. But he just didn't hand that money over. I had to pay him rent on that money every year. He would come to me at the end of every year and say, Warren, how big a check are you sending me? And he didn't want to hear about a down year in the mining business. He didn't want to hear that commodity prices were flat. He didn't want to hear that you had a problem with permitting, a delay, problem at the operation that you had invested in. He simply said, how much money are you sending me? You know, I somewhat liken it to working for the mob, and the mob doesn't care about your problems. They just need their money at the end of every week. Well, I had to also devise a way of investing that provided Mr. Lee his rent on his money at the end of every year so that I could continue to use his capital. So with those two cast in stone guidelines, and they weren't guidelines, they were rules, steadfast rules. We had to devise a way to invest in the mining sector that didn't lose money and gave people a return every year. That's what we did at CEF, and that's what we're doing at Queen's Road. So the idea at Queen's Road is just, I'm treating shareholders' money just like Mr. Lee's money, and frankly, just like my own money, because I'm a significant investor in this company. We will not lose your money, and we'll pay you a dividend every year.
Okay, Warren, I just have to say, you share stories like that, and then you sound surprised when I call you a legend. That's amazing. Okay, look, I want to dial it back to rule number one a little bit. And I'm just curious what you can share with me. Because yes, I cut my teeth. I wasn't managing Mr. Kashing's money, but I cut my teeth in the resource business from 2010 until today, and so I know that market very intimately. It was the bear market that I learned about this business. And all I can say about it is that when I entered the space in 2010, up until about 2015, I would estimate that 80% of the relationships I had vacated the sector because of how hard it was to make money. And those that were left are the core relationships I have today, which is why it was such an advantageous opportunity for me. But in the time, didn't feel like it. So what can you share about how you executed on rule number one, not losing money in one of the most ruthless bear markets in the resource industry?
Oh, that's a great question. And Jay, you've cut right to the nut of the issue and right to the core of Queen's Road, which is, what is your investment philosophy? How do you deploy your capital? And the driving factor behind that is, as I said earlier, quality of ore body. As long as you invest in quality assets, you're going to be fine. You're going to be fine in good times and in bad times. They always say cream rises to the top. Well, quality always rises to the top. So number one, my job is to find great ore bodies. And I can find them no matter what stage of development they're in. I can find them when there are just a bunch of drill holes and we don't even have a resource statement. We don't have a PEA. I can find them when they're already existing mines with a 40-year operating history. The point is, whether they're a bunch of drill holes or whether it's an operating mine, it's got to be a great ore body that makes money or will make money when it gets built in good times and bad times. That's point number one. Point number two, once you find that quality ore body, then you invest in a proper structure, because we all know that if you buy common shares, even in a great company and a great ore body, those common shares in a bad market are probably going to go down along with the rest of the sector, not by as much, but they're going to go down. That's why we focus on structures that protect our downside, but give us unlimited upside. And there again, we come back to the convertible debenture structure. Yes. Downside protected, pay us a coupon every quarter, but unlimited upside when things get better and things take off and mines get developed or companies get taken over. So those are the two core ingredients of our investment philosophy. Couple that with a couple of other points. With respect to commodity, we're commodity agnostic. We'll invest in any commodity. We don't just focus on gold. We don't just focus on copper. We're nimble. We have the ability to invest in things that are out of favor. So when things are screaming, that's time for us to sell, not to buy. So we use those cycles to our advantage. We're constantly looking for those great ore bodies, but in particular, great ore bodies where the underlying commodity is either off the radar screen or out of favor, because that's the time to put your capital to work. So commodity agnostic. Every commodity has its day in the sun, and have a diversified portfolio that exposes you to all of those, and hopefully at the down part in that cycle. Point number two, geopolitical risk. Mr. Lee was very, very conservative with respect to geopolitical risk. And he is conservative historically with all his investments. He has a global empire that spans the world, where he has 200 billion US dollars invested around the globe. But all of those investments are in relatively safe jurisdictions. He focuses on Canada, he focuses on Australia, he focuses on the UK, and OECD countries generally. And that translated likewise into CEF's and QRC's investment philosophy. Okay. No sense owning or being exposed to a great ore body if that ore body is located in, quote unquote, a funny country where you might own it today, you may not own it 20 years from now, or if you do, you'll probably own less of it because the government start taking more and more and more of it away from you. So again, in order to reduce the risk of the portfolio, we try to go to safe jurisdictions. Now recognize this is the mining business. Mining business, you have to take a little bit of geopolitical risk. At some extent, you have to go where the ore bodies are, but there are certain places we simply won't go to, and our portfolio will always be weighted to very great countries like Canada.
Yeah. Okay. Yeah, because I noted that, in the portfolio right now, you're holding NextGen, you're holding ISO Energy, and then which would speak to that. But then Adriatic Metals, right, which I believe is Bosnia, and I'm gonna botch this. Herzegovina. Did I say that close?
Good enough. Herzegovina.
So, which historically is not the most predictable jurisdiction. So, talk to me a little bit about that.
Yeah, and that goes to, well, you have to go to where the ore bodies are, but still a relatively safe mining jurisdiction. It's part of Europe. It certainly had some strife 30 years ago, but it's been stable now for 28 years, part of Europe. And because of that history, very underexplored. And as a result of that, Adriatic was a first mover back into the country and has discovered an incredible ore body, which I think is underappreciated in the North American context. A lot of your viewers won't be familiar with Adriatic because it's listed in London and Sydney, Australia. It's not listed on the TSX.
Right.
So not as many viewers will have heard it. NextGen, everyone knows I'm in love with NextGen, and I'm sure most of your viewers are. It's a fabulous, incredible ore body that's going to change the world in the uranium sector. And I made my first investment there with CEF in 2016. As much as I am in love with NextGen, it has an IRR, a stupendous IRR of 52% based on the bankable feasibility study that was just released. Well, to put it in context, Adriatic has 113% IRR. So different ore body, mainly silver, majority silver revenue. But can you imagine? It has an IRR double what NextGen is, and NextGen is stupendous. So it's quite an ore body, and again, falls perfectly into Queen's Road's focus.
Okay, yes. And you know what? I had Warren Irwin on the show about a month ago, Rosso Asset Management, and we were mainly talking about uranium and not to put words in his mouth, but he was essentially calling out NextGen as taking the seat from Cameco. That's what he's predicting. And
yeah, well,
makes a strong case.
I agree with Warren, my namesake, my brother with a different last name.
Yeah.
And Warren's a very astute guy, and can't agree with him more with respect to NextGen.
So one of the reasons I was looking forward to having you on is because as you just detailed your investment philosophy, ore body structure, looking at commodities that are out of favor, geopolitical risk. You didn't mention the number one thing on my list, which is why I feel like I have so much to learn from you. I'm people over everything when I approach this. As a consequence, I don't look at a ton of deals, to be honest, Warren. And I often get notes from subscribers. People sometimes assume I look at hundreds of different deals, but I don't. I have a list of names that I track in the sector, and I pay attention to what they're doing. And because I don't manage anybody else's money, that's enough for me. You know what I mean? So you must look at you have to look at a crazy spectrum of opportunities if you're focusing on ore body first. Is that the case? Yeah.
Yeah, Jay, 2 points. First of all, I totally agree with your investment philosophy as well. People, management, that is almost everything. So very, very important. And my investment in an ore body in a company is always an endorsement of the management team that's there. I shouldn't be investing in the company if I don't believe in management. So I agree with you, critically important, and something that's very important to Queen's Road. I have the benefit of having been in this business for 40 years. And, I grew up in Timmins. My father was an exploration geo. So I've known a lot of the players since I was 6 years old. And so the benefit of that knowledge and experience and knowledge of the people really helps in following management teams. And I love the Canadian analogy of hockey analogy of playing the man, not the puck. And I often refer to investing in great management teams as just following the man. And that is a great way to run a business. But for me, at the end of the day, the best combination, obviously, if one can find it, is the great.
Sorry about that.
And that's no problem. And that's what we strive. Great management team, great. It's probably good for a ride. But unless that great management team ultimately finds that great ore body, it's a trade. It's not an investment. And I've done that in the past. Just personally. A great one is Fortescue. I was an early investor in Fortescue, and Andrew Forrest tends to be one of those people that you follow, and wherever he goes, you invest and see how it turns out. And Fortescue has turned out to be a $50 billion company from a company that when he started it was obviously $10 million. So I was an early investor in that. And lo and behold, 20 years later, Andrew Forrest is one of the largest shareholders in Queen's Road. It's a small world indeed. And life can be funny.
Yeah. Okay. So let's get back to commodities that are out of favor. So we touched on next gen and ISO. Now, my question for you, Warren, is I've seen sentiment really heat up in the uranium sector. So are you looking to deploy, are you keen to deploy more capital in uranium, or do you feel like you're well positioned and it's time to look for something else? Talk to me about your uranium sentiment.
Right. And the driving force behind our original investment, and when I say our, I'm going back to the CEF days with Mr. Lee, the driving force behind that original investment when NextGen and the Arrow deposit was a bunch of drill holes was the ore body. It wasn't a play on uranium. It was a play on a spectacular ore body. A lot of people interpreted that investment as a play on uranium. They thought, Warren's investing Mr. Lee's money. Mr. Lee knows all about China. Mr. Lee must have a really great insight into the build out of nuclear reactors in China. Therefore, he has a view on the uranium price, and that's why he's getting involved in the sector. Okay. In actual fact, even though all of those things were true, that wasn't the driving force. That wasn't the catalyst behind the investment. The catalyst was it being a great ore body. So that continues to be our focus. We are very well positioned with respect to uranium, as you mentioned, with our investments in NextGen and ISO. So, and with the success of those investments over the course of the last 8 months, our portfolio currently is very heavily weighted towards uranium, simply because those stocks have done so tremendously well. Mm-hmm. So yeah, I would suggest that, Adriatic was our first diversification away from uranium. I expect the next investments will be something other than uranium, simply because we want to diversify the portfolio. But I am keen, nevertheless, to invest more in the uranium sector. So perhaps our fifth or sixth or seventh investment might be a uranium investment, simply because I do believe that if we get exposure to really good ore bodies, and perhaps that's simply more of next gen and ISO, the uranium price does have the wind at its back right now. I think it's still a great time to invest in that sector, because I believe that we're going to have a pretty good decade for uranium stocks as all of this unsatisfied demand eventually comes under contract and the market really tightens up.
Right. Now, so my perspective on the uranium sector, Warren, is that it's, well, I guess nuclear power has largely been misunderstood for the majority of my life and stigmatized, right? And there's been some disasters that have created this, but still I feel like it's a bit unfair, or undeserved is a better word, right? And there's a number of reasons for that. Actually, Warren Irwin is one who loves to talk about this, and he was sort of speaking to me about the narrative created by Greenpeace. There was this anti-nuclear narrative, because a lot of the funding from Greenpeace comes from the coal sector, which people may not realize. And that's why Greenpeace was so negative towards nuclear, but not coal. And anyways, all that to say, if you're not choosing nuclear, you're choosing coal. That's typically what, so from a green standpoint, it's a bit of a ridiculous misunderstanding. Anyways, if you're looking further, like earlier in the food chain, earlier stage uranium, what can you tell me about where you're looking right now? Either jurisdiction, you can talk about companies if you want to, but are you looking at the Athabasca Basin, or what catches your attention right now?
Well, obviously, one of the things that underpin great ore bodies is great grade. And there's one place in planet Earth where you go for grade in the uranium sector, and that's the basin. Okay. So I think you can be pretty well assured that we'll stick close to home. Saskatchewan is a great province for developing mines, and grade is king in the uranium business, and that's where you'll find it.
Okay, got it. All right. Look, Warren, it's been awesome having you on. I'm really glad we could put this together and make this happen, get you in front of my audience, introduce Queens Road Capital, hear some of your stories. I'd love to do it again sometime down the road, but thank you so much for your time.
Thanks, Jay, and appreciate your time. I'll leave your audience with a summary, which is, Queens Road, just very, very early days. We've got a market cap now of 200 million. We didn't touch on my shareholder base, which is six Australian self-made billionaires who dominated the capital raise from a year ago. Those guys are very supportive, looking to grow this company. We started off with a market cap $100 million a year ago. We're over 200 million now, and I expect we'll be $1 billion company in the next few years. As I said, regular dividend payer, high quality deposits, very, very early days. So a great time for your listeners to start following the story.
Yeah, I love that. And if you were able to execute on rule number 1 during the previous decade, then I'm excited what you can do with the next decade, Warren. So thanks so much for sharing that. And it's definitely on my audience's radar. Appreciate it.
Great, Jay. Talk again.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined once again by Alex Whittier-Sharon, CEO of Empress Royalty. Alex, welcome back. It's good to see you.
Great to see you. Thanks so much for having me, Jay.
No, it's my pleasure. I'm excited to get caught up on the story. The last time we spoke was end of January at the VRIC, the virtual VRIC that we hosted here on the channel. Since then, I know you've been to Mexico 4 times, doing diligence, putting capital to work. As a shareholder, I appreciate this. Where I wanted to start today was, Alex, there's been a surge of royalty companies that have hit the market in the last 12 months. And definitely a surge of investor interest. Like, I'm seeing it. Whenever we have a royalty company on, we have outsized response from the audience, and I get it. I get why. But what I would love your help with today, or love you to help my audience with, is what are the easy steps, or what are some steps in your opinion that investors can apply to value a royalty company? Say they're looking at 6 and they want some just quick hacks to determine which are worth more time than others. What should investors focus on?
I think one of the interesting parts of the royalty space is how companies develop their royalty portfolio. There's sort of 3 different ways of doing it. You've got the exploration, the project generators, those type of royalty companies. You're getting early stage opportunities, high risk, doesn't cost a lot of money, and there's a long lead to the revenue generation. But you really need a lot of projects in your portfolio to get a win. And then there's the third-party royalty acquisition companies, so like a royalty trading company, meaning that they've already got the royalties are already in place. So it's a simple acquisition, but it's quite a crowded marketplace. So you end up paying sort of premium for those types of royalties. Okay. In that situation, third-party royalty acquisition, they don't have a direct relationship with the company, and they don't have the ability to renegotiate the contract. And then the third type is the creation, which is where we're focused, where we're working with mining company partners to provide them financing solutions to either get into production or expand on the production. It's definitely more labor intensive to structure them and put them together, but we're able to structure that contract to meet not only our goals, but the goals of the company. So we work very closely with the company. We get a lot more information about what's happening, what they want to do with the company, where they see it growing, what the opportunities are. A lot more in-depth due diligence goes into this. And we're able to do this and get access to this type of deals through our network, through our strategic partners. We're able to source due diligence, negotiate through those relationships.
Right. Okay. Actually, I'd love to segue then into your strategic partners. It's what turned my head about the Empress story in the first place. Most people watching this know Endeavor Financial. They're, a hallmark name in mining finance and advisory. In addition to Terra Capital and Ascendo Banco in Mexico. So if you could walk me and my audience through these 3 strategic partnerships that you've developed for Empress and what each brings to the table, I would appreciate that.
Yeah, absolutely. So Endeavor Financial, as you mentioned, hallmark in the mining industry, it's a global mining finance investment banking firm. So they have access, they've got a lot of different clients on the debt finance side, corporate finance side. We get access to all of their cash flow modelers, financial analysts, mining engineers. So this brings a whole team of investment bankers to Empress. So it's not only sourcing opportunities because they're so well connected within the industry, but it's also helping structure those deals, do the due diligence, and be able to execute on the transaction. So very much deal flow for us, and so that support in the execution. Our second partner is Terra Capital, run by Jeremy Bond in Sydney, Australia. Terra Capital is a boutique fund that focuses on the natural resource space. It gives us access to Australian deals, Australian listed companies with projects internationally. But as Jeremy's been an active investor in the natural resource market in Canada in the last 10 years, gives us a fantastic capitalist markets network. So it also provides a very unique opportunity for Empress. And then our third partnership, which we signed in August, is with Ascendo Banco, run by Javier Reyes. And this gives us access to Mexican streaming and royalty opportunities. Ascendo Banco has over 30 clients, mining companies as their clients. So we're able to work with Ascendo Banco and provide that full financing solution to companies. And their look at investment size similar to our range. So it's very complementary in the smaller size investments, being that $1 to $10 million. A great example of that has been the deal we completed in November, Candelaria. That was a joint deal we did with Ascendo Banco. And then we're working on one with Telford Mining and the Talahueto project, where Ascendo is providing the debt facility and we're providing the stream alongside some equity.
Got it. Okay. And I want to talk about the Talahueto agreement soon. That's interesting, the deal flow component, because when I saw these partnerships, my immediate thought was, well, they're never going to have a problem raising capital. But the deal flow advantage is notable. So on the capital front, I know you guys just completed a financing, put $16.4 million in the treasury. Anything to mention on this, Alex?
Yeah, we did most of the sort of bought deal through Red Cloud, Canaccord and Mackie. And this financing definitely gives us the ability now to execute and close on the transactions that we're really advanced on. So it's going to allow us to bring revenue into Empress pretty quick.
Okay. Now let's get into some of these agreements. Let's start with Talahueto and just walk my audience through. This is the Tulsa mining project. So walk my audience through what you've structured here.
Yeah, so this for us is a $5 million US silver stream on the Talahueto project. This project is fully permitted. It's half built right now, and I've actually just been to site looking at the project. And we came alongside Ascendo Banco, who's providing $12 million in debt. We're providing the $5 million silver stream, and then there was an equity raise that's just being completed now to support this, which gives them a full $25 million to get Talahueto into production, which should be the end of this year, beginning of next year.
Okay.
So I'm down here right now, just been to the mine site, met with different government officials, met with their off-takers to make sure all the counterparties are working well together. It's a very exciting one. So this one, we're in the final stages of negotiation on the documentation, and then we'll provide the funding for it when we get that part completed.
Okay. And another agreement that's recently been on the radar is Manica in Mozambique.
Yeah, so this one is a $2 million investment US for Empress. It gives us a 2.25% royalty on the entire project. And this one, as you mentioned, in Mozambique. This one will be in production in Q3 this year, so hopefully providing revenue to Empress by the end of the year. We've signed the documentation. We're just waiting for the final CPs before we fund. And then this one will be part of the portfolio of a near-term cash producer for us.
Okay. Now, who has the expertise in Africa out of your three partners? Because I look at this and it's exciting coverage. You got North America, Australia, Latin America covered with these three partnerships. Is it Endeavor? Does Endeavor bring expertise in Africa? Yeah,
Endeavor has been advising to mining companies and been in Africa for as a company for over 20 years. David's who's the managing director of Endeavor Financial, also our executive chairman and chair of our investment committee.
David Rhodes.
David Rhodes. David's been in Africa for 25 years.
Yes.
So we've been able to, and we're not going into any country where the team hasn't been there before. So we know how to operate within those countries. So obviously de-risks that for us by knowing the countries we're going into.
Yeah, 100%. It's the know-who angle, right? Okay. Okay, so let's walk through the pipeline a little bit. What can we expect in the future, Alex?
So we're very much focused on, as I mentioned before, near-term producers or producers. I've got exclusivity now in 2 new deals. And this means we've got the terms negotiated, the term sheet signed. We've got exclusivity and we're advancing due diligence, both technical and legal. And this is on ones in Peru, where we would double their production, and other ones in Kenya, where we would increase the production by a third. So if these ones do vet out through a due diligence process and come online, these will be immediate revenue coming into Empress.
Okay, so what I like is the diversity of revenue. I love the team. I think that's why we connected in the first place. I like what you're building. And yeah, it's. Do you expect to remain focused in Latin America and Africa? Or where geographically, Alex, do you have preference to where you're going to be shopping in the future?
We're going to countries that we've been in before. So that's part of it, part of the criteria. We see a lot of opportunity in Latin America, higher grade projects, less capital to get them into production. And also with Endeavour's relationships and Ascendo's relationships, we're seeing a lot there at the moment. But definitely Africa as well. We're looking at some stuff in Australia, Indonesia. So we are looking globally. Probably roughly about 75% will be in Latin America. That might change when the opportunities come up. But that's kind of where our focus is right now at the stage that we're at.
Yeah. Okay. But not restricted to that, obviously.
No.
Okay.
No. We look for good projects and good returns.
Right. Yeah. Do you have a list of like, where do you start? Where do you start when you, because I imagine you're looking at hundreds of deals, you know, what's the first thing that you need to see for you to take a deeper look?
A good project. It has to be a project that makes sense. Absolutely key. Obviously, the other most important thing is the people and the management teams running these projects. You know, we're working with people we know can get into production. They know how to operate the country that they're in. And these deals are coming to us through the management groups that we know. And there's other situations where we know a group that's running a project and they're in production, but we know they could do more production with more capital. So we've approached a few of those, like the one in Peru where we're going out to the groups that we know. But it's very much about the people and their competence and ability to do it. And that comes through our relationships and history with them.
Okay. Look, Alex, I appreciate you coming back on and updating myself and my audience. I do appreciate your time. I know you travel like crazy, so it doesn't go unnoticed. But I'd love to get back in touch 6 months down the road, check in on the story again.
That would be great. Thanks so much for having me, and thanks everyone for listening. Always a pleasure talking with you.
Yeah, my pleasure. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by the Bond King, Stephen Van Metre, president of Stephen Van Metre financial planner, portfolio manager, runs a YouTube channel, among many other things. Stephen, how are you?
Great, Jay. Thanks for having me on your show today.
I'm really happy to have you on. I'm excited to dive into some topics with you. This is the first time we've had you on our show. So for anybody who's not familiar, could we begin with a bit of a highlight reel? Stephen, where do you focus your time and what do you do?
Yeah, good question, Jay. You can find a lot about me on my weekly macro show on YouTube. I'm active on Twitter, Facebook, LinkedIn, and I'm a portfolio manager. I've invented a formula-based strategy called Portfolio Shield, which you can read more about on my website, and I'm also managing macro fund.
Okay, now a handful of buckets I want to jump into with you today. The majority of my audience comes from a precious metals investing background. And as a consequence of that, we get a lot of consistently audacious gold forecasts. You have a contrarian standpoint, which is why I wanted to have you on. So I wouldn't call it a prediction, but you made a case for $1,300 gold, correct? And I'd love you to walk us through that a little bit.
Yeah, and you're right. There, when it comes to gold, you do get a lot of these big numbers. I think it's kind of like Tesla stock too. You just get big numbers. When I look at gold, it's not always inverse the dollar, but it's frequently trading inverse the dollar. Now, a lot of people think the dollar is going to the toilet, and maybe even farther down. And I have a completely different view that the dollar is going to rally. And when I look at gold, and I look at how it's traded up from 1,300, it hasn't traded on a lot of volume. And as you look at the price structures moving up to current price, and you go back down, you find out that there's not a lot of what we call support from a tactical perspective. And so all support really is where buyers are at and where are those buyers that don't want to sell, that if prices came back down to that level, they'd buy more. Well, that number is 1,300. There's a massive amount of buyers at 1,300. But between 1,300 and where we're at now, there's not a huge amount of buyers to support this. So if we get a dollar rally, which I believe we will, then there aren't a lot of people there to hold gold up. So I'm looking at 1,300. Now, could it hold up around 1550? Sure. I could be completely wrong. I'm just looking at it from a volume perspective. Is 1,300 is where the buyers are at. And my gut feeling is if it gets down to 1,300, we're not going to see those buyers sell.
Got it. Okay. Now, that makes sense, especially relative to a rising dollar. So my next question, therefore, is what's your case for a rising dollar?
Yeah, and that's a lot has to do with quantitative easing and how quantitative easing works. And a lot of people believe that QE is designed to weaken the dollar and raise interest rates. But in actuality, it's designed to do the exact opposite. It's designed to lower interest rates to spur lending growth. And it's designed to kind of not remove dollars from the system, but put them in what I call a dollar prison, lock them up into the banking system. So that way, even though we can account for them, we can see them, they just can't move around a lot. Kind of like an actual prisoner. They are a citizen, they are part of society, but they're locked in somewhere, and their productivity as part of the society is, well, rather limited. So when you understand that QE is really a dollar prison and that it causes the velocity of money to slow down and continue to fall, because even though there's a lot of dollars, they're just stuck in the commercial banking system, that over time, as the Fed continues to do QE and continues to trap these dollars, well, the dollar is going to rise. And on the back of that, we already are in a dollar shortage, partially due to quantitative easing. But the main reason we've seen the dollar fall is just due to massive amounts of short positions, either on the dollar or long positions on foreign currency. So you have this perfect recipe where QE will eventually work its way through all these short positions, cause the dollar to rise. And that's really what the Fed wants anyways, because what is the ultimate goal of QE? Well, it's to get American consumers to borrow money. Why? Because it creates money in the system. Mm-hmm. Well, how do you get that money out abroad? And how do we do that? Right, Jay, if you and I were going to think through this and said, how are we going to get dollars out of the US into foreign countries? Well, it's real simple. I want a strong currency, so foreign produced goods and services are cheaper, and then I'm going to borrow money and go buy them. And so when you start really examining what QE does, lower rates, stronger dollar, and if you get that stronger dollar, then, like I said before, you could see gold move with it, but there's too many times that there's an initial shock that drives gold lower.
Okay. Now bear with me because this is not my area of expertise. But so if I'm tracking you correctly, yes, the assumption would be you increase the money supply, you increase the velocity of money. That would be a logical correlation. But in fact, the opposite occurs. So therefore, even though you're increasing the supply of the money, since the velocity of money is dampened, the money itself is still relatively scarce. Even though there's an increased supply of it, there's less of it sloshing around. Am I kind of on the trajectory here?
Yeah, and so let's kind of dig deeper in that, if you don't mind, about this money supply issue, because that's really kind of the crux of this inflation view. Is everyone they look at the year-over-year rate of change of the money supply, that we're kind of at that annual anniversary, and for the last 12 months, this is going to be massive inflationary because QE causes an increase in the money supply. That's actually completely backwards. QE is a money supply Pac-Man. I mean, it chews up the money supply. It needs a rising money supply. It doesn't create it. It's an effect of QE. So let's kind of dig even deeper in that. How does that even happen? How do we get this money supply growth from QE? Well, the whole point of QE is to, again, lower rates. And depending on the size and the scope of a QE program done by a central bank, if it's broad-based across, short-term to long-term interest rates, you should see the whole curve come down. If it's focused on the front end, you'll see short-end rates come down. But the whole point of why you see money supply growth in tangent with QE is because, savers go down to the bank and they start building up their savings. And normally they'll say, well, my emergency savings is at the limit, and I have a buffer. So I'm going to take that extra amount and I'm going to put it away at a little bit longer term where I can earn a little bit higher rate. Well, the problem with QE is it slams those rates down, where a saver says, why would I go put my money in, say, a 5-year CD and tie it up where there's a penalty to get it out when there's a literally negligible increase in return? So what you start to see is this money supply growth, because savers have nowhere else to put their money. There are higher yields. You see corporations just parking their money in cash. And so that starts to grow the money supply. And then everyone gets excited that, okay, that's inflationary because this money is going to come out of the money supply. But that's not how it works. So as the money supply grows, the bank has to pay interest on this money. Now, granted, it's not much, but they still have to. Yeah. And so how does the bank get the interest to pay depositors on their money? Well, they take those deposits and they convert them into reserves. And all that means is they go and buy treasury securities. Right. That's all it means. So now all of a sudden you have depositors who don't even know they're funding the U.S. government debt, which is really interesting. I think a lot of people listening right now are like, I'm funding this deficit. Yes, you are. You absolutely are. So you've got the bank, now has these reserves, these treasury securities. The Fed comes along and through QE and says, hey, bank, I'm going to swap that reserve with you. So you might be holding a 5-year treasury note right now. I'm going to give you an overnight reserve. I'm going to swap with you. That's what QE does. So in order for the Fed to keep doing QE, they need more reserves. In order to get more reserves, they need more banking deposits. Why do you get more banking deposits? You need to keep rates so low that depositors have no other choice.
Right.
That makes it's kind of so now. Okay, now here's where it gets really interesting. Are you with me so far?
Yeah.
Okay, so that reserve swap that the Fed does. Let's unwind it just briefly. When a bank creates a reserve out of treasury security, they have the power to undo it too. So if there's a big demand from depositors for cash, they can just sell the treasury security, get the cash, and meet depositors' needs. Now, when that swap occurs, that reserve asset that the banks are given, well, they're not actually given it. It's actually held at a Federal Reserve member bank, and the commercial banks can list it as an asset on its balance sheet. So from a balance sheet perspective, there's no change. We have a reserve to begin with, swap to a reserve asset. But the Fed now is in control of this reserve asset. The only way to undo that is through quantitative tightening. So what kind of happens here is this reserve asset can only move inside the commercial banking system with banks that are eligible to handle reserve assets, who are part of the QE program. And by doing that, it limits the velocity of it, limits the movement of it. Now, if we had a large number of commercial banks, let's say we had like a couple thousand of them that were part of the system, well, then that reserve asset could move all around. But when you have like a small number, and I don't know what the exact number of, 10 to 20 of these, the velocity, the ability of that money to move around is very, very low. And so that's why if any of your viewers were to chart the velocity of money against the monetary base is where we see this pickup in the Fed data, and you take the monetary base and you invert it, you'll see very clearly, like, wow, QE is a velocity crusher. Yeah, that's exactly what it's supposed to do. It's supposed to put these dollars and through this swap mechanism, it puts them in a prison.
Now, is this possibly behind Jerome Powell's recent statement where he said there's no longer a relationship between the quantity of the dollar and the value of the dollar, which is, again, it's counterintuitive, right?
Right.
But you wrap your mind around that, you're like, either he doesn't understand basic economics or he's just trying to pacify the population, but maybe there's more to it, and that's what you just explained. Is that related?
Yeah, I think that is. I didn't catch when he said that, but effectively, right. He's got a lot of dollars out there, and what he wants to do is make it worth more. Well, he can't destroy them. He doesn't have a mechanism to destroy it. The only way to destroy a dollar is to apply it toward the principal value of a loan or as part of a regular payment. Any principal payment on a loan destroys a dollar. So what could he do? Well, he can do one thing: lock them into the commercial banking system where they can't move around very much.
Right. Very interesting. Okay.
So that way the other dollars, right, that are outside it become hopefully worth more. And as they get stronger, then that incentivizes people to come back to where we started originally, is borrow money and maybe go buy that foreign car, take that foreign trip, or invest outside the US and get those dollars out there, where the euro dollar market really can start multiplying them, because a lot of our dollar denominated debts are held outside the US, and there's a demand for dollars to meet those. Well, The Fed has to get dollars outside the system, but they have, again, no mechanism to do that. They can't just write a check and say, here you go. So the only way they can do it is get American consumers and businesses to borrow money, spend that abroad. And the only way you can do that is lower interest rates and increase the value of your currency, which is completely the opposite of what everyone really believes right now.
Yeah, no kidding. It is a very uncrowded bet going long dollars. So you know what? Actually, recently I had Brent Johnson, he must know, Peter Schiff and Raoul Powell on a panel, and they were debating. I was just moderating. It's called the top asset class for 2021, and Raoul was long Bitcoin, Peter Schiff gold, and Brent the dollar, obviously. So. Brent and Peter have had a similar bet at my event every January for the last 2 years, and this being the third. They're now betting whether or not the dollar will rise or fall in the 12-month period. Obviously, your money's on Brent for this one.
Yeah, absolutely. Brent will be right in the end. There's no question about that. And again, it's all because of what QE does. And then you start to connect the dots. Well, if QE causes the dollar to go up and interest rates to go down, that means the bonds are going to go up too. Well, then you start looking at the relationship between bonds and dollars, and you start figuring out that a dollar is just an overnight duration bond. So they're not perfectly correlated. There's times they separate, but generally they'll follow the same direction. So yeah, Brent will be right in the end. The only question is how long will he have to wait to cash in on this bet? Yeah,
he may re-up another couple of years. Okay, interesting. Now, Stephen, question I have to ask is, what could make this wrong? What could make you wrong with this prediction?
Yeah, that's a good question. So if you don't mind, I want listen, can we dig into what a liquidity trap is? Because that's really where you see the where Steve is wrong view come out.
Please.
Okay, so we kind of talked about how the money supply is not going to lead to inflation. So what happens when a central bank does quantitative easing, we get into what's called a liquidity trap. Now, if you actually went out and talked to a central banker, they're going to tell you this doesn't exist. And Jay, the way I like to frame this is it's kind of like a black hole. So if you and I point a telescope at a black hole, and we'd be, I can't see it, right? Because it's black. It looks like space. But if we zoom out and look at the event horizon and look at the circumstances going on around it, we go, okay, we can see that. And that's the problem with central bankers. You mentioned the word liquidity trap, and they start shaking their head and go like, nah, that doesn't exist. Well, what happens in a liquidity trap is the demand for money. So we kind of talked about the demand for money being QE. QE has a demand for deposit money to be converted into a reserve, to be converted into a reserve asset through QE. When the demand for money is rising more proportionally than the money supply, you get disinflation or deflation. In fact, that gap that gets created has to be filled by lower consumer prices. So not only are we likely to see the dollar rally and bonds rally and interest rates fall, we're likely to see consumer prices fall. Again, another view that very few people have. So why did I want to go through this? Because how does a planet or an object escape a black hole? Well, there's some very, very small ways it can happen, but it is possible. And the same is true with a liquidity trap. Because a liquidity trap is created by QE, the most obvious way out of it would be for the Fed to do quantitative tightening and raise federal funds rate. What that would do is take all of these dollars in the depository system and give them somewhere else to go. But Jay, you listen to the Fed meetings, press conferences, I know, as much as I do, and the Fed's not going to undo QE anytime soon because the perception is that it's a good thing. So there's one check mark that we can say is not going to happen. The second way out of liquidity trap is lending growth. So this is where you get consumers and businesses out borrowing lots of money. And why does that work? Because that's how money is created into our system, is when people borrow. So we need money to get out of this problem, and that's how it's created. Well, let's go to step 3 before we come back and dig into step 2. There's a third way out, which is fiscal stimulus. Now, a lot of people are probably thinking, okay, we're doing that. The problem is, not only do you need a massive amount of fiscal stimulus, you need continuously increasing amounts of it. And why do you need it? It's because you need to create lending growth. See, lending growth is really the only way out of this whole trap. And we kind of know that because today, as we're recording this, the Chicago Fed National Activity Index came out for February and showed we went from positive growth in January, although a much slower rate than months before, to negative, which means we had below average growth in February after we had a stimulus check in December. So what you find out is these stimulus checks just don't work because of, again, the negative impacts of QE. So how do we get out of this trap? Well, one, the Fed unwinds and does QT, not going to happen. Raise federal funds rate, not going to happen. Congress does infinite amounts of fiscal stimulus. They can't do that, not enough money. So the way I get to be wrong at this moment in time is if we get a massive amount of lending growth.
Okay. Now, so let's walk down another path here. We do see the dollar rise this year significantly. I think you said, and correct me if I've misquoted you here, foreign governments hold more U.S. dollar debt than the U.S. Did I get that correct?
Well, they hold a lot of it. I mean, don't get me wrong. There's a ton of dollar debt here. The problem is it really is the dollars outside, because how do they get dollars? Yes. Right. If I'm in the U.S., Jay, you're in a foreign country. You don't live in a dollar world. You need dollars. Well, how do you get them? You get them from people in the U.S. to spend them over there. So they have effectively a dollar shortage, and that kind of feeds into, again, the strengthening dollar is their dollar shortage creates a demand for dollars, which also leads to a rising dollar. I think that's more along Brent's dollar milkshake view is this shortage of dollars in the foreign market leads to a greater demand for them.
And what's the impact on these foreign nations that are holding U.S. dollar denominated debt in a rising dollar environment? I mean, for them, that means their currency is going down, or what in their case, what you look at is the Fed does not have the authority to print money, but there are a number of foreign central banks that can. So what would happen is to get dollars, that they don't have to pay on their debts to keep from defaulting is, they could print money and sell, dump their currency on the market to get dollars, which would devalue their currency and increase the value of the dollar. So for them, a weaker dollar has been beneficial, easier to get. A stronger dollar means, it costs them more to get. Right. It sounds like a death spiral.
It is.
Right. Okay.
It is absolutely that. I like to use the phrase, a rising dollar is the pin that pulls a grenade on this whole thing. Right now, it's being held into place, but when the dollar rips higher, it will be unstoppable. I mean, it will be worse than a bull in a china shop because there will be so much demand for it, and there is a massive shortage of it created by QE. So the longer we do QE and the less lending growth we get, the worse this is in the end.
Which would then therefore lead to a string of sovereign debt crises in other nations who are holding U.S. dollar denominated debt. When they go belly up, then, I guess the U.S. is left holding the bag, correct?
Well, or even worse, they just print more money. It drives the dollar up higher. And then you see what happens to U.S. stocks. They start crashing. And then all of a sudden, oil, all this inflation stuff crashes. You get a deflationary shock. You get a financial crisis. And then you have a problem because it's still, you don't have enough dollars being created to start servicing debt. You get more defaults. And the pandemic has really pushed that off because banks have been told not to foreclose or not to default on these loans. Well, all of a sudden now you've got this really high dollar. You've got everybody needing it, and then like game of musical chairs, the music stops, and we've seen this happen in the great financial crisis. There just isn't enough money to pay the debts. And people default. That is what a liquidity trap is a shortage of dollars. And the problem is you can patch it, right, by fiscal stimulus. Like, the government can send you a check, Jay, and you can pay your bills. But the problem is what happens next month, right? And you're like, I'm short again. Oh, here's another check. Well, at some point they're going to say, hey, you're on your own, pal. We've been giving you a bunch of money. You need to figure it out. Well, the problem is there's not enough jobs. There's not enough dollars. And eventually there is a point where if you don't get that lending growth, which we're not seeing because now interest rates have been pushed up by speculators, and a lot of people think that's reflationary. Now it's the exact opposite. In a liquidity trap, higher rates lead to less demand because people aren't borrowing out there. And we've seen that in the lending data. We're starting to see that in the housing data. And people are rejecting higher rates. And ultimately, that is another factor of how you get to even lower rates. Why liquidity traps lead to new all-time lows in yield is because you need this, them to be so low to get people to go out and borrow money to create more money. It's just the fiscal stimulus has just really pushed this can down the road, and in my view, is only going to make it worse when it does eventually happen.
Okay, interesting. So that's walking down that road a bit further then. That is what you are forecasting through to the sovereign debt nation crises, leading back to, I guess, massive crises in the United States. And when you say kick that can down the road, I mean, I hate to ask people for time predictions because I don't do it, but you know, do you have a horizon, Stephen, that you're thinking about right now?
I don't, because the banks I know are being told not to default on loans. I know a lot of consumers haven't been paying on rents, haven't paid on mortgages, haven't paid on their bills. The question is when they're going to be required to start doing that. And that's when we're going to find out that, wow, this situation is really a lot worse than we actually believe it to. Because if they've been paying on their bills this whole time, we would know it. I mean, we'd probably be in a whole different situation, having a little bit different conversation right now of, wow, the economy is just cratering because all these people are being forced to pay on their bills. Instead, they're out spending money on goods and services and then saving money, which we're seeing in the deposit numbers. But once they have to start making good on their debts, then we'll truly know the scale of the dollar shortage. And at that point, the dollar rips. And when it does, everyone, they're going to wish it did. I promise you, they'll wish it didn't.
Right. Okay, because the rising dollar is ultimately worst for the Fed. Right.
Yeah, because they can't stop it.
Yeah,
they're going to have to do so much QE, and see that's where you get down the spiral, right? I think you kind of mentioned it a few minutes ago. Is you can't stop it. So when people come back to like, how can I be so bullish on bonds? It's because the Fed's going to, if you thought what they did last March of $1 trillion was a big deal, wait till you see what they're going to do when the dollar skyrockets and they have no ability to stop it. They're going to do more QE. But now you and I just discussed the fact that actually makes it worse. And ultimately, what they're going to do is slam rates down so close to zero or zero. I think we'll see parts of the curve go negative. They're going to have to do it again because, well, first they've convinced everyone that actually does something, but to get rates so low to create inflation expectations and lending growth to get out of this mess. But yeah, the rising dollar is a problem because the Fed doesn't have the ability to stop it.
Got it. Okay, so that's the trade from your perspective. You're long bonds, US dollars for now. Yep. Until some sort of event like this starts to materialize. And then where do you think it go? Is it emerging markets? Is it back to hard assets like gold, off-grid, Bitcoin? Where do you look?
Yeah, good question. Is because I think the CPI is going to go negative on a year-over-year basis. So a lot of people out right now we're shaking their heads and go, there's no way. It's possible. You see it if the dollar rips higher. I mean, gold, you're going to see crude and food prices just completely tank. You look at the core CPI; it's not even reacting as if there's inflation. So the CPI goes negative on a year-over-year basis. What is it I really want to buy? What would be my number one choice? Gold mining stocks.
Gold mining stocks.
Number two, emerging market stocks. Because why? Those are your big two sectors, or you can do precious metals, whatever you like. But those are where you go when you see a negative CPI print, because when it goes up, you can't not get inflation. Now, how high it goes, I don't know. That's a different story, but that's where you want to initially start out, is go from bonds into inflation-sensitive assets.
Why hasn't CBI been recognizing inflation? Is that just like a formula issue? What do you think?
It's QE. QE is deflationary. So if we summarize everything we've talked about, you could say QE is deflationary until we get lending growth, and then it becomes inflationary.
Okay.
So if that's really the basis of, and what QE is designed to do, it's designed to, again, remember we talked about that liquidity trap. So where that demand for money is growing more proportionally than the money supply. Well, what happens is that gap has to be filled with lower consumer prices. And so when you hear people reporting on the CPI every month, they go, okay, well, next month, this part is going to go up. And then the next month comes along and that part does go up. And then another part goes down. And then the month after that, it keeps they keep saying everything's going to go up. But because of the liquidity trap, if something goes up over here, something's got to go down. So if crude oil prices and gas prices go up, then you'll see other parts go down because there's a shortage of money. And so when everyone gets excited about it, and I think you'll appreciate this, Jay, everyone is like, okay, when the economy reopens, right, massive amounts of inflation. And I go like, no, you don't understand. It's going to be worse because the limited supply of money is now going to get stretched across more businesses. And so what have we already seen in the unemployment data? We've seen people lose their jobs in the pandemic, go back to work, and now they're losing their jobs again because there's a shortage of money. So the more businesses, the more people working, nope. What we saw it in the hours worked. They dipped a little bit. It's like, wow, that people like that shouldn't happen. It doesn't. Liquidity trap happens every time.
Interesting. So coming out of this, vaccine-led recovery, if you're choosing between the economic boom of a lifetime as everybody gets back to work versus coast-to-coast insolvency event for small to medium businesses, I think I know which camp you're landing in right now.
Yeah, as long as the Fed's doing QE and there's no lending growth, which, if we looked at all loans and leases across commercial banks, you're looking at 2 to 3% year over year lending growth, which it really needs to be a lot higher. It needs to be 6 to 8%. So we're not seeing that. And then you look at what are consumers doing with their stimulus checks, right? A third is savings and a third is debt payoff. Well, we already talked about that paying off debt destroys money. So stimulus is not even inflationary. It's actually disinflation. It can be deflationary. So yeah, I'm definitely on the fact that please reopen the economy. You're going to find out that the liquidity trap is real and is not what investors are expecting at all.
Interesting. Stephen, look, this has been fascinating and very educational for myself. So thank you. Thanks for making the time. Thanks for coming on the show. And I'd love to do it again sometime.
Jay, anytime you like, let me know. I'd be more than happy to come back and speak with you and share more of my views with your audience.
I have to get you on with a few people. Maybe we'll call up like a Brent Johnson and a Raul, and then somebody else to provide a counter argument to this. That would be fun. But let me set it up and I'll get in touch.
Okay, I'll look forward to it.
Thanks again, Stephen.
Thanks, Jay.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Fred Bell, CEO and Director of Elemental Royalties. Fred, how are you?
Very good, thanks, Jay.
Yeah, thanks for making the time. I'm excited to dive into this story. We always get a ton of interest around royalty plays, and this is not necessarily a newer story. I know you founded in 2016, but maybe it was newer on my radar, to be honest. So I'm excited to bring you on, and I think timing is really good to have a look at this. Before we jump into it, I want to get to know you a little bit, introduce you to my audience. You're a young man, but what's interesting is 3 years ago, I know that you won the Young and Rising Star Award at the Minds and Money Conference 2018, probably in London. Is that right?
That's right. I didn't realize it was 3 years ago. It feels it feels a lot more recent than that.
Time flies, man. Okay, so give us a bit of background, Fred. Who are you and where'd you come from?
So I'm based in London. We started the royalty company privately a couple of years ago, but we listed actually in the summer of 2020 on TSX-V. So in terms of most investors having any awareness of us, it's probably only the last 7 or 8 months that we would have even been sort of visible. And prior to that, we set Elemental up in 2017. And I think it came through experience of working with junior explorers, developers. And I think if anyone who knows the mining space, will know that the years from maybe 2013 to 2016, 17 were pretty lean years. And they were difficult from a financing perspective. And one of the things that I learned going through that experience early on, and I worked in London for AIM-listed companies, and I was based in Melbourne with one of the other partners here. And I've worked across probably half a dozen African countries and Australia. And I think one of the things I learned is that often with a junior exploration company and developer, half the battle is having a good asset. But the other half of the battle is financing it correctly. timing the market, which is very hard to do, and not diluting yourselves. And I think, my experience from that was that actually a royalty company, when you sort of take a step back and critically think about the industry, it's a really good way to play the mining sector. And if it's a gold royalty company like Alden, it's a great way to play the gold space, because what you do is you can actually have exposure to multiple assets across jurisdictions and with different operators, and you can really diversify your risk. And if you can get revenue from different assets early on, you can be as diversified as a mid-tier miner, but you're a $50 million royalty company.
Right.
And that's a sort of light bulb moment when I sort of thought, well, if I'm doing this and I want to set up a company again, I think the way to do it, especially at my age, is to start a royalty company with a difference, which is producing royalties from day one.
Yeah.
That is the elemental story. We've had producing royalties from the day we started. I think we're the third, in the sort of revenues in the royalty space, really high on the revenue side, and that is, I think, unusual in the junior royalty space. That's, I suppose, a quick background.
Yeah, thanks, Fred. Thanks for that. So, yeah, gold royalty. I think you guys locked up 4 agreements in 2020. Is that right? I want to dive into those. Prior to, though, there's definitely been a surge of new royalty companies listed. And like I said, definitely a lot of interest from my audience. From your perspective, Fred, in your opinion, what's the quick metrics investors should look at when they're valuing a royalty company? Say we're looking at 6. What are some of the quick and dirty rules investors could apply to eliminate half of them?
Okay, so put aside Elemental, just talk royalties generally.
Please.
I'm an investor. I know the space really well now. If I was looking at a royalty company, I think the first thing I'd want to see is the whole reason I'm investing in a royalty company in the first place is because it should be lower risk. It should have diversified revenue as a number one point. Because you have diversified revenue, then you make yourself immune to a lot of the disaster stories of mining that destroy investor returns over the years. And there's a great example in terms of COVID over the last year. And if you are an operator in a jurisdiction through no fault of your own that's been really badly impacted by COVID, you could have your single mine shut down and lose your revenue for X months. But if you're a royalty company and you have 2, 3, 5, 10 royalties with revenue, you might lose one of them, but you've actually got the others. And so you're able to keep going. And so that's my one sort of critical assessment is check the downside risk. Do they have revenue, and do they have revenue from multiple assets? And then number 2, I think, is always quality. And quality can be a number of different things. It's the operator, it's the asset itself, and I think the resource. But if you have good quality operators and good quality assets, you're more likely to have a royalty that will deliver better over the longer term. So first of all, protect your downside. Make sure it's got revenue from multiple assets. Number 2, are these good assets? Are they good quality operators? Are they mines that will go not just for 5 years, but 10 years and longer? So I think those are the two key things. And then the third thing after that, and maybe this delivers some of the alpha, is if you've got those 2 building blocks in place, what is the management team and what's their track record and their background? And I remember I always used to invest when I was younger, and I invested in explorers in my early 20s when I knew not nearly as much as I do about the industry now. And actually, one of the questions I hardly ever asked was, who are the management teams and who are the people? But since I've now been mining for the past sort of 12 years, I think one of the first things I'd always ask is, who are the management team, and what have they been involved with, and sort of what track record and reputation do they have? And that is, I think, in the royalty space, that if you get a really good management team with good assets and diversified revenue, I think you're onto a winner. And that would be how I would look at it on a personal level.
Okay, thanks for that. I appreciate that. So let's apply these rules to Elemental. Talk to me about your revenue and how it's diversified.
So I think for us, it was my background. I studied history at university. So one of the first things I did before we set up Elemental was I looked at the history of the royalty space, and the royalty companies. I think that have often run into issues are the ones that haven't had diversified revenue from the outset. So for us, it's the hardest thing to do. But if you can get some producing royalties on day one, if you can be cash flow positive from day one, your future, your destiny is in your own hands to a much larger extent. And so I think we were really, really selective in what we did. And we bought some royalties from some pretty large operators. So Acacia, who's now part of Barrick, Yamana Gold. We bought one royalty privately. We bought one royalty from, if you know, Carlton Breweries, who are Foster's Beer in Australia. These were big companies that had, in some cases, held these royalties for 20 years. And they were very much non-core assets. And so what we were able to do was we were able to identify the royalty, evaluate them, extract the value, and I think put it into Elemental to give ourselves a really good foundation of diversified producing royalties from day one. And I think that's one of the things that probably set us apart straight away when we came to market to list last year.
Okay. And you're right. It's not easy buying producing assets like this. It's a competitive landscape. So how do you compete, and talk to me about the quality of your assets then, Fred, and how have you been able to be competitive in what's a very crowded space now?
I think if you look at our track record of acquisitions, I think to date, the royalty acquisitions we've done in the last 3 years, I think are second to none in terms of returns. And that's you can see that in our presentations and the sort of 2.5 year paybacks on some of them. And I think the way we've been able to do that is that we have, for the large part, we have focused on third-party royalties which have not been in competitive processes. And so that's enabled us to, I think, probably turn down 98 in every 100 deals, but focus on the 2 that were really outstanding value. And then when we came to last year, and we did 2 transactions, and they were both our biggest. So a $12.5 million acquisition of a royalty on Endeavour's Wang Yon and a $55 million portfolio acquisition from South 32. Those 2 deals doubled the size of the company with each acquisition. And what that really did is it gave us this great blend of value and scale. And both are really important in the royalty space, because you obviously always want the best value you can get to give returns, but you also need scale, because with scale, you get A, lower risk, B, you can have a bigger, more diversified portfolio. But crucially as well, once you start as a listed company, what you really want is, let's just take an example. Your running costs are $2 million a year, plucked out of, just for example's sake. If you have $2 million of royalty revenue, obviously you're covering your costs, but you're still having to raise money to invest on a day-by-day basis. If you then get $1 million of royalty revenue, you've increased your revenue by 50%, but you have $1 million to play with. If you have $2 million additional royalty revenue, you have increased your royalty revenue by 50%, but you've increased your available money to spend each year in investments by 100%. Mm-hmm. So the thing is, because you're a royalty company with fairly fixed costs, each additional dollar that you add in revenue is a really sort of it can be 2 times or 3 times sort of free cash flow, and that is, I think, where Elemental now is at that inflection point where we've got more than enough money to pay our costs, and so every $1 million now we add in of revenue is going to be essentially 90% going to the bottom line, and that's really where the model starts to get powerful. And I think that's why we've worked so hard over the past couple of years before we listed to get that portfolio of producing good quality royalties in, so that when we come in now, we can comfortably look ahead and say we're going to have more money last year than this year than we did last year, more money next year than we did this year to invest, and that's a really positive cycle and position to be in.
What are your 2021 revenue projections?
So we announced last year $5.1 million US as our pre-audited but revenue numbers, and then for 2021, depending on the gold price, I think we've said $7 to $7.9 million US, and that's about 4,000 to 4,400 gold equivalent ounces. And I think if you look at the history of the company, we have, since we started in 2017, we have doubled the revenue nearly every year since we started. And so I'd say that those revenue numbers for 2021 are on the basis that we do nothing else. So if COVID locks us down and they cut off the phone lines and brick up our house, then that will still be what Elemental can deliver. And I think that one of the unique things about us is with the South 32 acquisition in particular, this year is the first year we have 12 months of royalty revenue from Wang Yon, which was our biggest royalty. And we have our new biggest royalty that starts production in Q2, Australia's newest gold mine. And so next year will be the first year we have a full 12 months of revenue from that. And then in 2023, that will be the first year we have a full 12 months of revenue from Equinox's new acquisition on Mercedes. And so what you get is, you get this, and again, it's one of the benefits with a really scalable royalty model, is that 2021, 2022, and 2023, without doing anything else, we will have more revenue and more royalties paying us each year in the current position we are now.
Okay, now, so we're looking at 7 to 7.9, 2021. What about 2022?
So 2022 is, it includes one of the sort of development assets, but I think what we say is if we don't include that, we're looking at a plus $10 million sort of annualized run rate from the second half of this year onwards. Okay. Once we have Carla Winder in. And then you go into, I think our big development sort of pre-feasibility stage gold project in Western Australia. And one of the things that, again, if you look at the royalty space, and it's a parallel for the mining industry, but we all know that projects often take longer than intended. And mines can take longer to build, projects take longer to come on stream. And one of the things that we did at the beginning to de-risk is we really focused on buying royalties on existing mines. So there was a track record of production. We knew what we were getting. We could see what the royalty had been paying. And if you look at our portfolio, most of them are producing royalties and most of them are up and running. So they're very de-risked in that sense. And I think that, again, is a big differentiator. So that pre-feasibility stage project that we've got, that's probably the big one that's sort of development stage, okay, where the timelines can move. And I think if you look at a lot of sort of other developers or royalty companies, you'll see that 2021 morphs into 2022, and it takes another 6 months, takes another 9 months. And so if we can have a really good $10 million plus base, that whatever happens, we're pretty confident we're getting that from existing mines, existing operations, then it puts us in a really good place down the line. Even if some of these subsequent royalties are delayed by 3 months or 6 months, it doesn't actually cost us any more, and it doesn't really impact, the amount of revenue that we already have. And I think that's the key position that we wanted to get in, to be in that $10 million plus space.
Okay. Now I want to wrap it up talking about your team. It was the third point that you mentioned when you're looking at criteria. It's usually the first thing I look at when I'm looking at a company. So talk to me about who you've surrounded yourself with, Fred, and do they bring expertise to the royalty business? Talk to me about your executive team. So it's funny, and it's a funny world, because it's actually two of our directors personally own royalties themselves, and both of those at one stage over operating mines. And so I think we've got a lot of experience, not just in the management team, but actually as well on the board. People who have been personally involved in bringing projects on stream and holding a royalty on it across that period. And I think that if you look at our track record over the last couple of years in what the team has been able to do, I always say it's an awful lot harder to buy a royalty on a producing mine than it is to buy an exploration royalty. And an exploration royalty could probably be a few pieces of paper. But if you want to buy a royalty in an operating mine in a certain country, you'll need to do tax due diligence and structuring. There will be an awful lot more due diligence in terms of legals, tenure, environmental, all of those kinds of things. And so I think for us now, we have acquired royalties over operating mines since we started in Mexico, in Chile, in Australia, in Burkina Faso, and in Kenya. And those are operating mines. And so I think our success rate on deals that we have actually
agreed terms on and gone through to execute, is we have executed successfully on every single one. And that's something that can often be overlooked. You think, we'll buy a royalty, we agree the price, that's it, done. It's not. And I think we have built up a lot of IP over the years in doing this, and also in the deals we've looked at where we haven't actually bought the royalty, but we have done a lot of work looking at different countries, jurisdictions, different royalties or streaming structures. So I think we've learned a lot both from that and from the people involved. And on our team, we joined Discovery Group when we listed in Canada.
Yeah.
And the principals there, John Robbins and Jim Peterson, I think have a really good track record and network in Canada, and really helpful for us, particularly in the odd year that we've had over the last 12 months, not being able to travel and not being able to come to Canada and America ourselves and market. I think it's really helpful having the benefit of their experience and network with us. And then I think one or two of the other people on the board bring a really good mix of technical experience, which is so important. And if you look at our sort of management team at the moment, the average age is probably in the mid-30s, our sort of day-to-day management team. But then if you look at the people around us, they don't always like me to call them the sort of experienced grey hair, but it's that kind of technical experience that you can't succeed without. We can go out and we can bring in lots of royalty opportunities, and we can do a really good commercial due diligence on it. And we know the marketplace and we know what opportunities work. But I think what you really need is you need people who have been geologists, engineers, geophysicists, who have worked on different mines and seen everything that's gone wrong. And they know the history of the project and they know the history of the people working on it. And you can get a really good feel for that. And so I think we're lucky in that we have some really good quality institutional shareholders and a number of people in the mining space who have been really helpful for us as we've been building the company, and we've been able to lean on some of their knowledge and contact base. And I think that's been really helpful.
Okay. Thanks for sharing that. There's distinct advantages to being part of groups like Discovery Group because of the resources the overhead company brings to the table. We've had Jim Peterson on the show very recently, digging into the Valor story. A big fan of that guy. Okay, thanks so much for coming on, Fred. I appreciate your time. I wanted to introduce this story to my audience and get to know it better myself. So thank you. And I'd love to do this again, maybe 6 months down the road, check in and see how things are going.
Fantastic. Thanks, Jay.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by David Morgan, the chief editor of the Morgan Report. David, welcome back.
Jay, it's always fun to be with you. Thanks.
Yeah, I appreciate you making the time. So I wanted to bring you back on because we spoke in January. You were among a ton of interviews we did in December and January. We did about 100 interviews with the intention of gathering as many forecasts and perspectives as possible so that we could then sort of pick and choose what we could apply into our portfolios. Now, a quarter's gone by already. We're at the end of Q1 of 2021 already. I wanted to pull back a select few personalities onto the platform to get an update, right? Because it's been a crazy quarter. Lots has changed and some things went to plan and some things didn't. So I'd love to get your perspective on what's changed, how your conviction may have shifted, and how that impacts your outlook for the rest of the year. Maybe a good place to start would be, we're sitting here, I guess, at the end of talking about the gold market now, a 7-month depression in the gold price since August-ish. My question for you is, what are you doing now? Is it time to buy? Is it time to wait? And how are you actioning right now?
Yeah, that's a great question, Jay. Right now, building cash, but nibbling. It's tough to be all things to all people. There's people that just caught on the gold story a year ago, and maybe they got in too high. And then there's, first of all, I'm long-term, now I do make intermediate term calls and I'm pretty good at it. My long-term calls for tops has been very good. My bottom calls haven't been that great, but the main idea is to have a goal and don't overdo any one sector. Now I know I'm overinvested in this sector. I know it well. I know I can take the risk. Some people can't. So if you're that personality, 10, 15% weighting or whatever is probably adequate. So one thing I'm going to put in the next report, and I do it on my videos for our paid members, is covered call writing. So you can have a stock like one of our top tiers and what I call rent your stock. So you can go a month out and and believe it or not, Jay, you're going to get, most of the time, you're going to get like 3 to 5% in a month. And the reason it's so high is that gold stocks have the highest beta, or the highest volatility is what that Greek letter means, of any group in the stock market. And because of that volatility, you pay more for the option, which means as the option seller, you receive a big fat premium. I had an options expert I met at one of your conferences, and had him do a mastermind with me, and he did the portfolio. This was about 3 years ago. And all I do is my top tier, which is only like 5 companies, but he works at it. He writes an option out 1 month every time. It yielded 40% in a sideways market. So, there's that aspect. And I'm going to be publishing that as an outline in the next Morgan report. Something you can do your own. You don't need to buy the report to get it. In fact, it's going to just be an overview. But that's some way to generate some income and also kind of soften your loss, because every time you write that call, your cost basis comes down. So if you're on $100 stock and you write an option for $5, then that time it's 95, and you write it again, it's 90, and you write it again. And you could do 4 or 5 times in a year, and your cost basis goes from 100 down to, let's say, 80. And that's maybe your average price right now, because we've been in this 7-month lull and you don't feel so bad. Now you can't do that with, some of these junior companies don't have options, but in the big companies, you can do it. So I've structured the portfolio conservatively, Jay. I remember in the early days at your shows way back in the 2002 and 2003, and some of the guys in my business were just kicking it. And I was doing good, but being conservative, maybe not as good on a percentage basis, but I'm still here. And in the long, long run, I was doing pretty good where a lot of these guys left the business. So, it depends on your perspective, depends on how you like to invest.
Got it. Okay. Now switching to the silver market. David, what has surprised you most about the silver market so far in 2021?
Well, I have to give you 2 answers. One is this Reddit group, Wall Street Silver, that came out of nowhere, basically, from this GameStop situation. That was unexpected. And of course, it's been sort of one of my dreams about what's wrong with the metals, and particularly silver, is the lack of awareness. No one really hears the silver story unless they're at, one of the Vancouver Resource Investment Conferences, or maybe one of the other investment shows around. And they find it on the internet, or they're kind of a metals head or a resource investor. But I mean, the general public just doesn't hear the silver story. Just somewhat the gold story, but it's usually diluted. And so that was number one, because awareness is key, education and awareness. The second thing is, and I hate to sound like a whiner, but it's the price situation we're presently experiencing.
Okay.
I mean, look, common sense would tell almost anybody, not even a futures trader like me, and I don't do that much futures trading anymore, but I used to actively, to see a buy like we had in 4 days in silver, taking a price or taking the amount to 100 million ounces in a 4-day time frame. If you did that much volume respective to the percentage of what's available in the corn market or the cotton market or the wheat market, you would have probably been up limit 3 days in a row. Silver made this big up move on the aftermarket over the weekend, up to a touch around 30, and then came right back down. And it's been like 28, maybe 28.50 is kind of its high. So it's been in this trading range between 25 and let's say 27.5 since that time frame, which is only like 5-6 weeks ago, if memory is correct.
Yeah.
And this is rather frustrating to new silver investors, but I got to back up and go to the conviction trade of 2020. And when at Davos, which we now know, most people know as the World Economic Forum, when Guggenheim's chief investment officer, Scott Metre, was asked what's his conviction trade for 2020, he said silver. He said that in January of 2020, and it went from roughly 18 to, I forget what it closed at, 28. We had about a 40-something% move over that year to year, January to January. Been flat now. It's frustrating. It doesn't make sense, but there's been a lot written about that. You got a question or two on that idea, so I'll hand it back to you.
Yeah, cool. Well, you're right about the sort of mass audience awareness tuning in. And you drew some parallels recently between the silver market and the 2008 crisis, specifically with analogies pulled from the movie The Big Short about the housing crisis in the US. I was wondering if you could recap that for our audience today.
Sure. I've watched the movie 2 or 3 times. I actually own it, one of the few movies I've bought. But there's a part in the movie after Dr. Burry gets Goldman Sachs to write them the option to be able to short the mortgage securities that are basically garbage, and he knows it and has known it for a long time. And then, of course, further on, he says he wants to guarantee that they're still going to be around to pay him. I digress. So what happened is, as the movie progresses, the market goes against him and against him. And it's not only Dr. Burry and his investors, other people on Wall Street are catching the whole idea as well. So there's more on board on the short side. So market continues to go against them, lots of frustration. And then all of a sudden, I think it's Countrywide Financials, headline news, biggest news on the ticker. It's going bankrupt. Major brokerage. It does a lot of subprime mortgages. In fact, I think their whole business, I may be misquoting, but Countrywide was pretty much notorious for subprime type. So, very difficult paper. The credit scores aren't that high. Chance paybacks aren't as good and all that stuff. And this is an absolute in your face. It's happening. It's right there. And the market actually goes against them. And these 3 lead players in the movie are like baffled. This can't be true. And I forget the exact line, but it's something like, this is the most corrupt thing ever, or something else is going on. And from the movie, there's something else is going on, that one of the banks wanted to be on the short side now that they saw that these kooks were correct.
Yeah.
And once they got on the short side, then the whole thing started to tumble down, and away it went. And everybody that was short the mortgage securities were making a lot of money. So the analogy is similar, that, we see all this physical demand. We see offtakes from the COMEX itself. We see premiums on 1,000-ounce bars, commercial bars. We see the PSLV rewriting the prospectus. We see the SIVR, Aberdeen Trust, rewrite the prospectus and basically whine about the speculators taking silver, for crying out loud, when those funds are supposed to be long silver. They're supposed to be long only funds. If you can't buy a commodity, you can buy a stock, because an ETF is a stock representation of fill in the blank. And in this case, it's silver. So all those things adding up, Jay, just give me the idea that we might be at that point in the movie The Big Short, where even though it looks like we're wrong or something's wrong, we may not be that far away from something breaking free. I would say, I do technical work, don't hang my hat on it. I'm pretty good at it, and the market knows more than me. But I'd say if we got a 2850 print 3 days in a row on the continuous contract, in other words, a spot month, and it's decent volume, I think that's it. I think from that point, we'll see, I could be wrong, we're probably into the 30s pretty quick. And there is some congestion at 30. I mean, there are people that bought silver at 30. And now, with $26 or $25 silver, you're paying 30 or 31 anywhere if you're a retail investor. Even at some of the banks, you're paying a huge premium to get, Silver Maple, Silver Eagle, even a RCM, Royal Canadian 100-ounce bar has got a huge premium on it. So something's just not smelling right in the silver market. I'll leave it there.
Okay, we'll have to wait and see. Now, talk to me about your portfolio for 2021 and how you've allocated cash between, call it early stage explorers through to miners. What are you holding now? What are you shopping for?
Okay, well, my big positions, I've been writing some calls, not as aggressively as I outlined. The mid-tiers are still doing well and getting great news, so we're keeping our paid members informed about that. haven't done much in the speculative sector. There was one that basically wasn't living up to their mission statement, so I dropped it off the list. I hate to do that because once I but I'm not married to any of these things. If there's something that changes, I have to adapt, correct, and continue. So I corrected and continued. I just got on our mastermind, which is primarily fund managers and AIs, accredited investors. Just had a presentation yesterday on a new silver situation over by me in the Silver Valley. That looks quite interesting. It's not got the paperwork out yet for a private placement opportunity, but it'll be coming. So I'm definitely going to take part, which, those people on that call know that. And it looks like, very high potential. I mean, I know that area pretty well. I'm not a geologist, but I've been over there many times. So that's sort of one I'm kind of very intrigued by. For current, it happened like Tuesday and this is Wednesday. So it's yesterday. So that's it. I am holding cash, building cash, because I think we're nearing the bottom in gold, but I also think that it's not going to be a rocket ship up. I think it's going to hit the bottom of the trading range. And I think that's where we are or close to it. And then it's going to come up to the top of the trading range over time. And of course, between that, it goes up and back and forth with higher lows. And then it's got to break through the trading range. So I do expect better gold prices by the end of the year, but nothing significant. So I'm willing to focus a little bit more on silver. I think it's got more upside at this point in time, but not so much that I don't have enough cash to take advantage. If we get a large stock market sell-off and it takes everything down, including the miners, or I see something I really want to invest in, that's an opportunity that presents itself.
Okay. I love it. Look, David, I appreciate your time. You know who I was just talking to before this was Daniella Cambone. And I told her, I'm talking to David Morgan next. And she goes, you have to share this story with him. She said you were her first interview ever in the business when she, going back would have been like 15 years at Kitco. And they were positioned at the bottom of the escalator at the PDAC. And she said she pulled you aside, was super excited to convince you to do an interview with her. And then she couldn't get the audio to work. And you guys had to try it a couple of times. Do you remember that?
I do indeed. Yeah. I mean, in the career I've had, which I'm very blessed, almost everything has happened at one point or another. The PowerPoint quits working because the bulb goes out in the unit, and then the lectern, the mic quits working. I mean, not everything. So I just got you just admit that something went wrong and try to pretend, or instead of pretending everything's okay. People know you're human. I mean, most of them will be very empathetic with you, and of course, knowing she was probably nervous, I just handled it to the best of my ability. That it happens. So what? I've got time, so relax. And it all comes out. We all have our stories, but I hadn't thought about that in a while, but I do remember it.
Yeah, well, you're one of her favorite analysts that she's interviewed. She shared that with me, so I just wanted to pass that on. Look, I appreciate your time, David. Thanks for coming back on, updating my audience, and look forward to doing it again.
Thank you, Jay. Appreciate it.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Luis Zapata, the CEO of OROX, soon to be executive chairman of SilverX. We're going to get into this transaction during this conversation. Luis, I haven't had you on the show before, so I'm excited to dive into this story with you. Thanks so much for joining me.
No, thank you. Great being on, and great to speak to you.
So let's start with you a little bit. My audience might not be familiar with you. I'd like to know the CEO behind the deal. So let's start here. Give us the highlight reel. Who are you and where did you come from?
I was born in Lima, Peru, but I grew up in Richmond, BC. Did all my education there, went into mining finance. My first job out of college was at Canaccord Genuity in Vancouver. I grew to be the head of South American equities for Canaccord. And in 2013, I moved to Peru full time. I'm basically just been in mining finance my whole career. It's all I know. I love it. And been financing mining companies since my early 20s, basically.
And what inspired you? Because I've seen this, I don't want to call it a trend, but in the last 12 months, I've seen more and more professionals move from banking to running a public company, specifically in the precious metal space. Timing makes sense. I get it. But what inspired that decision for you?
I've been in the business almost 15 years, so I kind of saw what makes good companies, and it's really all about people. So when I felt that when my network became good enough, through meeting people like Paul Matisik, meeting good other, executives, etc., I just felt it was time to make the jump. And a couple of years ago, I saw the market was weak. I thought that it was going to flip around. So I said, I'd like to take over a company and put an asset in, and that's really what became SilverX now.
Okay, so talk to me about the team a little bit, because that's what turned my head. As we said before I hit record here, I've been a shareholder of OROX for maybe 7-8 months. I know you guys have had a busy 15 months, but it was the people that turned my head, right? I've invested with Paul Matisik in the past and made money, and he's one of the personalities that I tend to follow around the space and just make sure I know what he's doing. So talk to me about the team at OROX and what you guys have built.
Yeah, for sure. We took over the shell that became OROX in January 2020. We've done 3 deals in 14 months, each one bigger than the last. Paul came in the Peruvian transaction, which took us from the shell to OROX in June of last year. A lot of people don't know, but Paul lives part-time in Lima, Peru. He's my neighbor, a few blocks down from me. So we've known each other sort of socially for a few years and in business circles. So we were always looking to do a Peru deal. So when we partnered up with Paul and also Daryl Carty, who was a great Vancouver financier, a great guy, we thought it was the time to make the jump. And that's sort of how OROX was born. And then previous to that, I had always known about the asset that we're rolling into SilverX, La Recuperada. I helped them finance privately. So to be able to roll them into OROX has been an amazing thing for us.
Yeah, Daryl Carty is another individual who is someone you should pay attention to. He's more behind the scenes. A lot of people don't know Daryl, but and a lot of the deals I've had on the show in the last 12 months, he's in the background. Okay, now let's talk about La Recuperada. Forgive my botching of the pronunciation, but what struck you about the asset? Let's talk about it.
For sure. We wanted to roll in Latitude Silver, which is the company that owns La Recuperada, for 3 reasons. Number one, it has production, 1.7 million ounces silver equivalent over the next 12 months, going to 2.3 million ounces 12 months after that. We see organic growth potential in that asset to 5 million ounces, which we think is great. Number two, as a resource, 7 million tons and change, equivalent to about 70 million ounces of silver equivalent. And number three, what the guys did, which really attracted me, was they consolidated a district, right? I mean, they took over a district when they bought this asset from Buenaventura in 2017. They've expanded it from, 6,000 hectares to 15,000 hectares. And today there's 90 known productive veins on site. So veins that have actually been touched by mining methods in the past. So we think we have our hands on basically what's Peru's next great silver mining district.
Okay, and I would imagine the game plan here is drill, expand the resource. What have you guys got planned?
Yeah, I mean, look, we're a company that we're going to be out to market, back trading at about an $80 million market cap, but we're in production, right? So we have 1.7 million ounces of production going into 2.3. So that's number one, expand the resource by drilling. We believe in creating value by the drill bit. So we're raising $14 million in this go public transaction, if you will. And with that, the most of it's going to the ground to increase the resource and turn it from an inferred to a measured and indicated resource. But also there's high-grade silver zones which have never been touched really by modern mining methods. So increase the resource, increase the category of the resource, and obviously expand the resource across all categories. That's the plan.
Okay. And I know we have some optionality at Coriorco. Can you want to talk about this a little bit?
Yeah, no, Coriorco is a project Paul and I originally vended into the shell that became OROX. It's a high-grade gold target. It's drill ready. I mean, there's 17 known outcropping veins and in a dome that we really like. The previous operator had basically done a sampling program across the entire dome. And you had 3.5 grams at surface across 17 veins. There was previous mining. We got our hands on the mining records. It was around 10,000 tons of, call it 10 grams. And then below that, it was 13 grams. So we think it's the upper reaches of a low sulfidation epithermal system. We think it's drill ready. We're shooting 3D IP in the next few months. And then now as part of SilverX, we'll drill it and it'll give our investors sort of a high-grade gold target within a silver company that's in production.
Okay. And so correct me if my numbers are wrong, but we're looking at about 30,000 meters of drilling at La Cuparera, right? 5,000 exploration at Coriorco. And then what can investors expect? Will you be looking for more acquisitions, Lewis? Like what's next on the radar for you? Because I know your ambition is to become, the next low-cost silver producer in Latin America. So are you looking for more properties?
100%. I mean, look, Peru is the world's second biggest silver producer, right? So the question is, why has nobody built the first majestic mining in Peru? There's a lot of these mid-tier mining opportunities, silver mines that have been, mined by local Peruvian families or local Peruvian groups that have never had the room to expand or the capital to expand. We think we have a good sweet spot there. I mean, Recuperada, again, we think we took it at 1.0 because it was on care and maintenance when they bought it. Now it's 1.7 million ounces going to 2.3. We see 2 or 3 other opportunities like that. So to build a 5 to 10 million ounce silver producer, we think is quite feasible in Peru. And I think that's the value that we bring. The whole team is based here, from Paul to myself to our, our CEO, incoming CEO, et cetera. Only our CFO is in Vancouver. So, we're a local group with access to Canadian capital and Canadian know-how. And I think that's really what's going to drive a lot of value.
I want to ask your own question. Why has nobody built the first majestic of Peru yet?
I think Peru was obviously the land of elephants in all sense. Like there's huge copper mines, huge gold mines, huge silver mines, right? I mean, Peru's biggest primary silver producer is a company called Volcan. They produce 20 million ounces. And then the next biggest one would be Fortuna, right? So there's not a lot of people looking at the small, like 2 to 5 million ounce producers that could become 5 million ounce plus, because, silver was such a weak spot for so many years that nobody really thought about doing it. I think we're the first to look at that strategy, and, we're executing right now.
Okay, let's get into your cap table a little bit. Starting with management and insider ownership. What can you share, Lewis?
Look, pro forma, we'll have about 30% plus, 35% management and insider ownership. I think that's quite large for any company. We have institutional ownership from Sprott. We have US Global. We have Baker Steel. So we have great institutional backings in this $14 million round. We've been lucky to collect more institutional orders. So, we'll be a relatively tight company. We're doing a $14 million raise at a $66 million pre-money valuation, $81 million post-money. That's Canadian. If you look at some of our peer group, they have around the same or higher valuation with no production. So I would argue we're very attractively priced. And that's what we're doing right now.
Okay. And so near-term catalysts, if we're looking for trigger points, we've got cash in the treasury, we've got to focus, drill programs are running. We're waiting for results at this point for La Cuparera, for Coriorco, and that's what investors should look out for the next 6-8 months.
Correct. So one of the big things about our company is, look, we have 2 rigs on site now. The third one's going up next week. So we have 3 drill rigs turning even before we go public, call it middle of April. So we'll have drill results. We have production results because we are in production. I want to make that clear. We'll have resource expansion, resource sort of upgraded in the resource categories, and definitely M&A. I'm a banker by trade. I think everybody knows that Paul's a deal guy. We're not here to run a 2 to 3 million ounce producer. We're here to grow the next Pan American or First Majestic.
I love it. Can you run my audience through your production numbers?
Yes. So 1.7 million this year, call it the next 12 months, 2.3 million the year after that. That's on the current installed plant capacity of 600 tons per day. We will be doing a slight capacity increase to 720 tons per day. That's where we go from 1.6 or 1.7 to 2.3 million ounces. Okay. This year, we are putting an EIA study for an upgrade of the plant to 2,500 tons per day. So we think organically this asset can grow to 5 million ounces. But again, I think the big driver for us will really be M&A. I just came back from meetings. We're chasing M&A deals all day long.
Okay. Yeah, that's the other catalyst we'll keep our eye out for, which is exciting. Okay. Yeah. Okay, Lewis, thanks for coming on the show. I appreciate your time. And I can hear that you're downtown Lima. We can hear the traffic outside your window right now.
I live right downtown.
I want to bring you back on 4 to 6 months down the road, get an update on the story. But thank you for coming on. I appreciate your time.
No, thank you, Jay. Nice talking to you.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party. revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Rick Rule, who prior to this interview, every single time I've had you on, Rick, I've introduced you as the CEO of Sprott US Holdings, and as of 7 days ago, that's no longer the case. Now you're an investor and a speculator, among many other things. But welcome back.
Thank you. It's nice to be back in this role. I will be, as you might imagine, less constrained by regulation and corporate etiquette these days. So the interviews might become more interesting.
Every time you've said that, and like I've talked to you a few times in the last couple of months, and you've mentioned something along those lines, less regulated, less constrained. For some reason, I always get excited about what's he going to say? Where could this go this time? So let's start with that though, because I know this has been a long time coming. I know your plan was to see your clients through the bear market and then step back. I don't know how many times I've heard you say on our podium, bear markets are the author of bull markets. And you could also think about that in the sense that bull markets are the reward for bear markets. So after seeing your clients through the bear market, Rick, why not stick around for the party and the bull market?
Well, I would suggest two reasons. One, I'm now 68 years of age. I've done the same thing effectively for 45 years. I'm not trying to say I was always CEO, but I've been involved in client service, investor service for 45 years. And that's a very long time. As I said in my retirement letter, among other things, I'd like to travel with my wife without an investment conference or a mind tour tagged onto it, but rather for sport. Also, however, the regulatory climate has made operating within the regulated financial services realm increasingly less amusing. It has seemed from time to time that anything I said to investors publicly that was useful was prohibited. And that became somewhat disconcerting. I understand that I could not and should not give investment advice to people that I don't know. But the idea that I might be able to talk as an example about a company at some point in time and disclaim it at the beginning, say this isn't investment advice, this is the way that I view this company in terms of my own money, could have been misconstrued when I was in the regulatory environment as being investment advice nonetheless as a licensed person. Right. I'm not a licensed person anymore. I'm an investor and a speculator, maybe a particularly well-informed one, but an investor and a speculator. The second thing is, Jay, that increasingly I think that social commentary and political commentary is an important part of an investment discussion. And frankly, if you're Sprott with 200,000 investors worldwide, some part of my political commentary or social commentary, irrespective of the fact that it is investment related, might be offensive to more than one of them. So some of what I said was, well, not deliberately, offensive to some constituents within Sprott and served to embarrass certainly some of the employees of Sprott. And I didn't want to do that. But at the same time, I felt that this social and political commentary was a necessary part of describing some of the investment theses that I was involved in. So I won't be constrained any longer from doing that.
Interesting. Okay, so if I hear correctly, obviously we're stepping back from Sprott as an employee standpoint. You're not stepping back from the market. You're not stepping back from media. And so from on a personal level, Rick, are you going to be as involved in the market as you've been?
In the sense that I will keep one private client. His name is the Rule Family Trust. Myself, yeah. I will sub-advise some Sprott products, but merely as a sub-advisor. And I will continue to mentor other portfolio managers and private wealth managers within Sprott, but their decisions will be theirs, not mine. I would expect that in some senses I'll be more active as an investor because I'm relieved from all managerial responsibilities, which, despite my best efforts to shirk them, took as much as 35% of my time in 2020.
Right.
I am taking the business that you knew as Sprott US Media, the Vancouver conference, which is, of course, a companion of your own conference, the old Sprott's Thoughts blog, the Sprott Investment Media, U.S. media business will now be called Rule Investment Media. And I suspect I'll be much more active in that business, hopefully occasionally cooperating with Cambridge.
Excellent.
Something I look forward to.
Yeah, me too. Absolutely. Okay. Now you referenced 45 years. That's a long time. That's a lot of cycles. That's a lot of entrepreneurs that came and went, a lot of speculations. Now, it made me think about, Rick, when I flew to Carlsbad to meet with you in 2015, and I was in a bit of a stuck place because I've been running Cambridge House for close to 5 years. We were in the pit of a bear market, and I was struggling to get some vision on how we should proceed forward. And you were very gracious. You sat with me in one of your boardrooms for probably an hour and a half. And one of the questions I asked point blank was, Rick, is if you were in my shoes right now in this market, what would you be doing, right? What were some of the decisions that you'd be making? And, you seemed to think about it and you sat back in your chair and then you said, look, I can tell you what I did do when I was about, that stage of my career. And what you said is you identified the top entrepreneurs in the business, fortuitous that you were able to, but you did, right? Individuals like Ross Beatty, Lucas Lundin, Bob Quartermain. And you said you made yourself indispensable to them. Right. And then ever since then, I approached my business very similar, right? I looked for those personalities, whether they're the entrepreneurs, the money managers, the newsletter writers, whoever, and focused 90% of my energy on those relationships. But my question for you is, we're all trying to find the next Lucas Lundin, the next Ross Beatty, the next Bob Quartermain. Now, you spent a lot of time and hosted a lot of panels at my show and others talking about the next gen of these legends. Can you say with confidence now, Rick, and we're not looking at their current deal or their next deal, but who in 15, 20 years do you think you could point to with absolute confidence and say that's the horse to bet on? Does anybody stand out? Any entrepreneurs in the space that are way above the others?
Sure. I think in your town, as an example, all of a sudden the names are going away. Nikki Adshed-Bell, if she decides to continue on her current trajectory, will be one of those. She certainly has the tenacity and the intelligence. It's up to her whether or not she wants to do it, of course. The whole team around Sandstorm, led of course by Nolan Watson.
Yeah.
I think Amir Adnani has proven himself competent as a multi-issuer stable. That's probably a start.
Yeah,
I think there's probably 4 or 5 in town that have been able to build a team, which they need to do. Nobody can do it by themselves. Have an established track record so you can see how they do what they do. Have a reputation, which is a bit different than a track record, so that they have lower cost of capital relative to their peers. And have also shown them discipline. What you want to avoid is somebody who is a serial issuer, who just gets in the business of marking up 15-cent paper to 50 cents and moving on.
Yeah.
You want to be involved with people who understand that building a company, either to being a successful company or for an exit, involves a 5 or 6 year time frame. And you want a young entrepreneur who will do whatever is necessary to make each individual effort a success. I think that's important. There are other groups in town that have 5 or 6 prints on the table, all of which might go up in a bull market. But that's not the same as a serially successful group that is more likely than not to be successful in the future. It's a very different circumstance. You need to segregate between people who build companies and people who buy paper by the truckload, like a supermarket does bread, and retail it in the same fashion. Those are very different disciplines.
Yeah. Okay. Thanks. And 3 names is a lot, actually, more than I expected. So thank you for sharing that.
I have 2 more. I'm just I'm waiting for a month to see what they do.
Okay. I'd speculate on one of those at least. I'll have to call you in a month and see how we did. Okay, Rick. Now, speaking to anybody who entered the gold space last spring, and there was a frothy rally, like you said, a rising tide lifted a lot of ships. The macro trends supporting a rising gold price haven't abated. If anything, they've gotten stronger, right? We're talking about our expectation that inflation will keep running hot, our expectation that the Fed will keep rates suppressed, which in theory is the formula for a rising gold price. But in practice, the last 7 months haven't played out that way. And so what do you have to say to investors right now who 7 months later are starting to question their conviction and say, what did I miss? Where was I wrong? And why is the market not performing as per the theory?
Well, your second point is the explanation. The increase in gold price from $1,100 to $1,900 coincided with a decline in the interest rate on the U.S. 10-year Treasury from 235 or 240 basis points down to 60. The plateauing and then the decline in the gold price coincided very, very, very closely with the increase in the interest rate on the U.S. 10-year Treasury from 60 basis points to 175 basis points. Your listeners will need to decide what they think the likelihood is that this interest rate increase can stick or be increased. You'll recall in an earlier interview that you and I did, Jay, that I identified several factors, and it's worthwhile, I believe, going over them. The first is quantitative easing, which I think you and I both correctly identified as counterfeiting, were it not done by Parliament or Congress, but it debases the currency. The second is debt and deficits. And debt and deficits continue on unabated. In my country, the deficit this year will likely be $3 trillion, adding to an existing on-balance sheet and off-balance sheet debt at the federal level that exceeds $140 trillion. The third, of course, is nominal and real interest rates. If the interest rate on the U.S. 10-year, which is the world's benchmark security, continues to rise, the gold price will continue to weaken. My own belief, personally, Jay, is that as the increase in the interest rate in the U.S. 10-year, if it continues at this level, that the signal will go through the rest of the economy, which is to say, in the United States, the 30-year fixed mortgage rate will go up by 100 basis points, which will be hard on home buyers and home builders. The prime interest rate will go up, which will make it more costly for American companies to invest and employ. The capitalized value of dividend distributions will go down because of the increase in alternatives from savings products, meaning that share prices, which are now based on dividends, will fall because alternative yields are higher. Auto loans will become more expensive, and most particularly, the gargantuan amount of short-term liabilities at federal, state, and local governments, which need to be rolled over in 2021, 2022, will be rolled over at higher interest rates, which is to say that the deficit will be increased because the interest rate will be increased. That's a very long way of saying that I don't expect that either the voters or their political masters are much inclined to higher interest rates. I believe that they think that the economy is in good enough shape that they could let it rise so they can cut it again if they need to. If your listeners feel different than me, if your listeners feel that the economy is in fact vibrant enough that these interest rates can stick, or that interest rates could actually rise from here, then they need to be leery about gold and gold stocks. I feel differently. It's worthwhile revisiting point 2 as well. Specifically for U.S. investors, but I suspect investors around the world, to the extent that those investors believe that the budget deficit falls substantially below GDP growth, which is to say, if GDP growth were to go to 3%, as an example, and the budget deficit were to fall substantially, in other words, if it became apparent that we might be able to actually grow to the point where we could begin to at least service, if not amortize the budget, I think that gold would be weak. When I look at the popularity of deficit spending in the United States, and I look at the unconcern that both Democrats and Republicans have with the deficit, I don't think that's likely. Mm-hmm. But your listeners and your viewers will need to make up their own minds. The final point, and I'm sorry for this long-winded answer, but it's the $64 trillion question, is that if you observe prior bull markets, the two that I've lived through in 45 years, what you will see is that while they are decade-long affairs, they are punctuated by numerous cyclical declines inside a secular bull market. The decline that we've seen on the gold equities index is 30% plus, is extraordinarily common. If you look back at the bull markets that we enjoyed in the 1970 to 81 period or the 2000 to 2011 period, smaller cyclical declines of 10% or 15% happened historically with the frequency with which you and I breathe, inhale and exhale. And while that's unpleasant for people who haven't experienced them, it's fact. And you either get used to them or you get out of the way.
Yeah, right. And I'm glad you touched on that because I've heard you reference that so many times during the bear market when you're talking about your experience in bull markets. And I think even to say 50% corrections, although challenging, right, to maintain your conviction, occur with consistency. Rick, how much emphasis do you put on, I don't want to call them rules, but things like the Elliott wave, right? You must be familiar. I wasn't, to be honest, because I really focus more on sentiment than anything, just because of where I sit in this world. But do you put a lot of emphasis on theories like this?
I don't. I have a use for people internal to our own business, like Paul Wong, who use technical analysis as a timing tool.
Okay.
I don't believe that markets are so much a source of information as they are a facility for buying and selling fractional ownership in businesses. Mm-hmm. So the most important tool that I use is simply whether or not I think something is cheap.
Yeah.
When you and I visited in July of last year, I think I commented to you that there were very few things in the junior market that I could buy, which told me that the universe was overbought and it was time to sell.
Yeah.
A plethora of bargains, particularly a plethora of bargains when everyone is afraid, is the most bullish sign I know. A dearth of bargains, particularly when everybody is aggressive, is the most bearish sign I know. That may be confirmed by technicians in Elliott wave, but I prefer to think of it in sort of Graham and Dodd terms. When are things cheap and when are they not cheap?
Yeah, I like that perspective. I'm rereading Anti-Fragile right now, and
wonderful book.
Yeah,
just a wonderful book.
It is. It's dense. I feel like it's not the kind of book I can pick up and read 30 minutes of every couple of days. I have to spend 2 hours with it consistently to really absorb. And I'm maybe a third of the way through it this time, where we're talking about the noise versus signal. And I think Taleb's analogy is if you're paying attention to anything on an annual basis, best case scenario, you're getting 50% noise, 50% signal. Most of us pay attention on a daily basis, where you end up with 95% noise, 5% signal. And if you're into it on an hourly basis, like a lot of market participants are, you're looking at something like 99.5% noise to the 0.5% signal. And I know this book is not that old, it's only a decade or so, I believe, but the amounts of noise that we've become exposed to has only amplified dramatically so. And so how do investors avoid this trap, Rick? I mean, you may have just said it, right? You're not worried about technical analysis, sentiment trends. You're strictly looking at the value of companies. But any additional advice for investors?
Sure. There's this wonderful phrase now, FOMO, fear of missing out. During periods of time when there is a fear of missing out, and you feel it in yourself, things are too bullish. In bear markets, there's a fear of participating. In other words, things look cheap, but you're afraid to write the check anyway. So I think almost doing the opposite of consensus. One of the times that you and I talked, Jay, I believe it was probably when you were down in Carlsbad. What I said was that my life would have benefited in every regard from doing less.
That's right.
Had I picked the 10 best people that I did business with in my 20s and early 30s and stuck with them and never did transactions with anybody else ever, I would have worked a quarter as hard and I would have made twice as much money. When I look at the most successful investment product I ever offered to the public, which was Exploration Capital Partners 2000, and that was a truly spectacular performance. You'll notice I'm picking the best, not the worst. What I noticed back testing that was that I made something like 165 or 170 buy decisions in a 6-year time frame, and 7 of them made a difference.
Right.
Which tells me a lot. If I had it to do over again, I would do a lot less. I would do much bigger transactions. Marin Katusa talks about his strategy as the alligator strategy or the crocodile strategy or something.
Yeah.
Where you just sort of hang out and wait. Jimmy Rogers says the same thing. He says, to be a real investor, you sit in the corner of a room and you do nothing.
Right.
And once every 3 or 4 years, somebody walks in the room and puts down a bunch of money in the center and walks away. You get up from your corner, you go take it and walk back in your corner, and maybe you don't do anything for a while. It's difficult for people to do nothing. Even people that have been in the business like me for 45 years, it's very difficult to do nothing.
Yeah.
Fear of missing out is a great sin. I used to give a lecture in your conference, actually a workshop in your conference, where I talked about the difference between the fear of omission and the fear of commission. In the fear of omission, you miss out on money that you could have made. In the fear of commission, you make a mistake and lose money. And while fears of omission are aggravating, fears of commission are painful. And I would prefer aggravation to outright pain.
Yeah. Yeah, I love that. It's a new bus every 15 minutes, I think is the quote, or the
wonderful quote. Buffett has a good one too. He says, baseball's a game of baseball with no called strikes. Your money is your bet. And so you just wait there. And if a guy throws one past you, it doesn't matter. So you just wait till the pitcher gets tired and you swing at the fat ones.
Right. Yeah, you made me think that's the most important characteristic of an investor is patience. Over and above everything else. Okay, now you opened up this interview talking about your ability now to talk about companies you are invested in and that you think very highly of. And so obviously, Rick, I'm going to try to peel some stock picks out of you now. What have you got for us? What are you very bullish on right now?
At present, this will be extremely unpopular with your listeners. At present, the only companies I have in my global rankings database that are 2 ranked. Remember that 1 is perfect. 2 rankings, and I just only very recently had some 2 rankings because of a general decline in natural resource equities. They're all Russian, which is something that American and Canadian investors don't like. And by the way, these are not stock recommendations. Many speculators are too uncomfortable owning Russian stocks to make it worth their while, no matter how much money they make. Just because of their prejudice against Russia or their lack of fondness for opaque markets.
Sure.
But there are names like, this isn't really Russian, but Kazatomprom, which is, from my point of view, the finest uranium company on the planet. Polymetal, which is a very rapidly growing Russian gold and silver producer. I recently demoted both Gazprom and Lukoil from 2 to 3 because the oil and gas price went up so much that those stocks had returned to favor. But my highest ranking stocks are Russian, which makes them extremely unpopular with my old client base and your listeners.
I suppose so. You know what? I've got the CEO of Kazatomprom booked in to come on the show next month, so I'm excited to talk to him.
I believe personally, this will make me a lot of enemies in the uranium space. I believe that if you include the middle management, the younger people at Kazatomprom, that it's the best managed uranium company in the world.
Interesting. Okay, but I got to ask you for some Canadian American listed companies. Do any come to mind that you're comfortable endorsing right now?
I'm not going to endorse any of them. I can tell you some that I'm attracted to, and they'll probably bore your listeners. My highest ranked Canadian stock at present is Altius Minerals. Not because I think that'll be the best performer on the market in the next three months, but because they're the best capital allocators in the junior resource space in Canada. And the enterprise value, which is to say the market capitalization less current assets plus debt, substantially less than gross market capitalization. And their new emphasis on streaming and royalties in renewable energy, where their partner is Apollo, one of the largest U.S. private equity businesses, I think will grow much faster than the market believes it will. I'm encouraged, too, that in their most recent quarterly report, their management team expressed concern about the difficulty that they have deploying capital, saying that if they are unable to deploy capital, they'll return it to shareholders by way of share repurchases or dividends.
Yeah.
Now, most speculators don't want rational, common sense capital deployment. They want hot sex, which is to say they want to be lied to on a consistent basis. They want a narrative that turns them on.
Sure.
What I've learned is that money isn't made in a quarter. It's made in 3 years or 4 years, and it isn't made with a narrative. Yes, you can trade $10,000 against a quick narrative and make enough money to take your girlfriend out for a nice dinner or buy snow tires for your car or something like that. But that's not how money's made. And so I would say that easily my highest ranking Canadian would be Altius, simply because it suits my needs. It may not suit.
Sure. No, I mean, Rick,
your people's needs.
Everything you just said is consistent with what we were talking about 10 minutes earlier, right? Whether it's Altius's capital deployment strategy, right? They're not in a rush to deploy cash if they don't see the opportunities. Your outlook on these narratives versus companies, it's all very consistent with what we just discussed, right? There's a new bus and
right.
is the characteristic to wait for or to hold. So when we spoke in July, I asked you about deploying capital, and your answer, as you just stated, was everything's a bit too expensive for my liking right now. 7 months later, gold prices come off. A lot of the miners have come down a little bit at least. Has your sentiment changed, or are you?
Oh, I'm much more bullish in the precious metal space.
There we go. Interesting.
Much more bullish in the precious metal space. I wouldn't describe myself as wildly bullish yet in the junior space.
Okay.
Which is to say the sub-billion market capitalization.
Yeah.
Although there are some exceptions to that. I'm quite bullish about the current affairs as an example of Sandstorm, where I don't think that the market has adequately priced in a transaction on Hod Maden, which hasn't occurred, but I think will occur,
right.
and hasn't appreciated the legacy value of their assets. So that would be an example. Where I'm really bullish myself is on the mid-tier producers, usually single asset producers that are enjoying very high free cash. There are valuation discrepancies in the market between multi-asset producers, which are regarded as being less risky because they have multiple sources of income, and single asset producers, where you have some risk associated with the shutdown of your single asset.
Mm-hmm. Okay.
But from my point of view, the discrepancy, the delta has become too broad. And if the price of these single asset producers doesn't increase, my suspicion is that they'll be taken over by multiple asset producers and the discount will go away de facto. So that interests me. I should tell you, Jay, that I can't tell you really which way the gold price is going to go. I have a suspicion, of course, but I can't tell you which way the gold price is going to go. What I can tell you is that if you look at the gold producers by the metric that I like most, which is net present value of future cash flows as a percentage of enterprise value being market capitalization minus debt, add back cash. Mm-hmm. By that ratio, using the forward strip as the gold price assumption, not either current prices or aggressive prices, but rather the prices established in the futures market, the universe of gold producers, particularly intermediate gold producers, is the cheapest that I've ever seen them. This goes back 45 years.
Yeah.
If the gold price doesn't hold, in other words, if it falls, then I'm going to look pretty stupid. If the gold price goes up, which is what I think it will, I might look stupid for not having invested more capital in the sector at the present point in time. I have a buy list of 7, which I'm not going to share with you because I don't want 100,000 competitors from your listeners driving up the prices of stocks I'm trying to buy. But suffice it to say, they are market capitalizations between $1 billion and $5 billion, generating free cash margins net of sustaining capital in excess of 15%. And, trading at reasonable multiples, sometimes a discount to net asset value at current strip prices. This is, as I say, the cheapest that this class of stocks has ever been, to my knowledge, in my career.
And can you tell me, I'm going to prod a little bit, can you tell me anything about the jurisdictions?
The jurisdictions where I'm finding the best ratios of free cash flow to enterprise value is Australia.
Interesting. Okay, Rick, it's been a pleasure having you back on. Thanks so much for making the time. I love getting you in front of our audience.
Jay, I'm hoping that you'll allow me to make my normal offer to your audience.
Yeah, of course.
I am still affiliated with Sprott in this fashion. If any of you care about the way I think about the companies that you own, you can ask me directly. Go to a website, sprottusa.com/rankings. Enter the stocks, the resource stocks, no cannabis stocks, no tech stocks. And I will rank them 1 to 10, 1 being best, 10 being worst. I will comment on those stocks where I think my comments might have value. Please be patient. I'm about 900 rankings behind. There was a bit of a snafu, an IT snafu in my leaving Sprott, which wasn't resolved until today. So when you submit your rankings, please be patient. Remember that I'm a doddering old 68-year-old, and I'm 900 rankings behind. But I look forward to fulfilling that service for your readers. I've, checking my records, done it for over 1,000 Cambridge House listeners in 2020, and it's been an unalloyed joy for me to do so.
Amazing. Yeah, I don't know why you wouldn't do that. I actually submitted a portfolio close to a year ago, be about 10 months ago. And I think I'll do it again this spring because why not? I
look forward to it.
Exceptionally valuable. Okay, Rick, thanks again. It's been a pleasure having you on. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Nico Kakos, the president and CEO of Blue Sky Uranium. Nico, how are you?
I'm doing well, Jay. Thanks for having me on your program.
Now, I'm excited to have you on to introduce this story to my audience. I've been covering more and more nuclear and uranium content over the last month and a half in response to demand from our audience, which is great because it's definitely a sector that I'm sort of most bullish on for 2021. And part of my bullish sentiment is not just driven from the supply and demand economics, or I think that nuclear as an energy source is very much misunderstood and underrated. But for most of my life, the biggest barrier, and you tell me if I'm on base or off base on this one, the biggest barrier to nuclear hasn't been technological, hasn't been financial, it's been public sentiment, right? And I feel like I'm starting to see that change now. The stigma might be a thing of the past, but I don't know. What are you seeing from your side, Nico?
No, I absolutely agree with that statement. I think what we're seeing is a big fundamental shift happening on a global basis in terms of the public accepting electricity generated by through nuclear reactors as being safe, as being a secure way to generate electricity, a very efficient and very dependable way of generating electricity. And that's, I think, what is the major driving force right now behind a global expansion for building more and more nuclear reactors. And that, of course, underpins the demand for the nuclear fuel, which is uranium. And this brings us into what we're trying to accomplish with our company.
Right on. Yeah, and it's super important because, like anybody, like I want a greener planet, right? I want less emissions. I want cleaner air, all this stuff for my kids, and et cetera, et cetera. We talked about this a lot. I hosted a nuclear summit a couple of months ago here on the channel, and a lot of the conversation ended up being, if you're not choosing nuclear, it's not like you're choosing solar or wind power. You're choosing coal if you want that scalable electric power. And it was Warren Irwin from Rosso Asset Management who was on the show saying a lot of this narrative has been controlled by Greenpeace. And what people don't understand is that the anti-nuclear sentiment that originated from Greenpeace was funded by coal lobby groups who needed a strong voice to downplay nuclear. Anyways, we won't dwell on that too much. I want to talk about Blue Sky. For anybody who's not familiar, Nico, with the Blue Sky story, why don't we start with just the highlight reel, the elevator pitch. What is Blue Sky Uranium?
Well, Blue Sky Uranium is an exploration company that's focused on advancing a brand new uranium vanadium district in southern Argentina. Right now, this district is the largest, has the largest deposit of uranium in Argentina, and is the most advanced uranium deposit in Argentina. And the real upside here is that it has the potential to rank among the largest uranium districts in the world with some of the lowest operating costs. And that's what we're working on. Okay. Now, I believe this was an in-house discovery. Is that right? That is correct. Can you give us the timeline of what led up to this? Well, we've been working on this since 2006, so that puts it at almost 15 years of work, and it really has to do because of the size of this district. It wasn't this district. It runs about 145 kilometers in strike length by 50 kilometers wide. So it's just an enormous. It's like it's a district that covers, say, from Vancouver almost to Seattle. So it really is an enormous piece of land. And we've examined and explored throughout most of this, and have identified uranium mineralization throughout. And it wasn't really until the last few years that we started to really focus on the southern portion, and we established a resource, and we completed a PEA, a preliminary economic analysis on it. So now we have a solid understanding of the geological model, and we're stepping away from that and beginning to put numbers and pounds to the resources. Okay. And can you speculate a little bit for me? I think you have a drill program underway. What's the work program look like, and what are you hoping to show investors? Well, we do have a 4,500 meter drill program underway. We're drill testing about 10 kilometers north of our current uranium deposit, and another 15 kilometers north of that. This program is going to last over the next couple of months. And what's our objective here? Well, we have a deposit of just under 23 million pounds of uranium and 11.5 million pounds of vanadium. Our objective here is, can we now, with the knowledge that we've got, find another one, expand this, and continue to grow this. This district, is not too dissimilar than some of these districts we see in Kazakhstan, which have multiple deposits adding up to 100, 200 million pounds of uranium. With, these are the districts that currently produce 60% of the world's uranium. So this is a very unique discovery in Argentina. Okay. And talk to me about cash right now. I think you recently completed some funding. Are you cashed up and ready to talk to me about your runway right now? Yeah, because of the restrictions from last year, were lifted in December. It was in late December that we announced the financing. Said, well, okay, let's resume our exploration program and get going again. So we announced a $3.5 million financing. And we received an absolutely unprecedented demand from sophisticated funds and private equity investors to participate in our private placement. We increased it to $5.5 million. And we capped it at that. And now we're completely funded to complete our exploration program, which will last another couple months, and also to begin our pre-feasibility engineering studies, because that's the program that's going to lead us towards making a production decision in the near future.
Okay, so talk to me about that a little bit. Because I knew you were oversubscribed, looking for 3.5, ended up with 5.5, and lots of institutional interest, private equity and funds. What was attracting their attention, not just to Blue Sky, but to the uranium sector in general right now?
I think there's a general understanding, like we said at the outset, because of this increased in acceptance of uranium and nuclear power. We're seeing now more nuclear reactors being built around the world, and the demand for uranium, as of a couple of years ago, is already exceeding what the supply is. So there is a crunch coming. There's a number, because uranium, again, is purchased in long-term contracts, 5 or 10-year contracts. These contracts now are beginning to expire. So a lot of the utilities are coming back into the market, trying to renegotiate new contracts, and we're seeing a huge uranium deficit, and the price, of course, is working towards us, is moving upwards. And this is a fabulous example, fabulous backdrop in which for Blue Sky to be uncovering new uranium discoveries.
Okay, now talking about Argentina a little bit, we've had a handful of companies exploring in Argentina, mainly copper, gold, like Filo Mining, Jose Maria Resources. Obviously not a uranium company, because I think this is quite unique. So what's the landscape like operating in Argentina? Unique opportunities, unique challenges.
Argentina is unique, and our group, being managed by Grosso Group, has got almost 30 years of active experience in working in Argentina. In fact, we're an award-winning considered pioneers in Argentina. But Argentina for nuclear is a different ballgame. Argentina, most investors don't realize, has been in the nuclear business since the 50s. It's a nuclear country. In fact, they're involved in every facet of the nuclear cycle except for production of uranium.
Right.
So they've got nuclear reactors, research reactors. They build and export small nuclear modular reactors around the world, and they're quite well regarded. There's even a pilot enrichment plant. But all the uranium that they need, they have to currently import. And they're paying an average price of almost $85 a pound, which is nearly triple the spot market right now. So this creates a very unique opportunity for Blue Sky in that we can step up and become the very first domestic supplier of uranium to the government in Argentina.
Okay. Now let's dive into the people a little bit. Talk to me about the management team, Nico. Any highlights in the team that you've assembled at Blue Sky?
Yes, absolutely. Our chairman, Joe Grosso, is founder and president of the Grosso Group. He brings a humongous competitive advantage for Blue Sky to operate in Argentina. He's been Mining Man of the Year there. He's been inducted into Argentina's Mining Hall of Fame. And the name Grosso Group in Argentina carries a lot of respect, opens up a lot of doors, and it allows us to get permits quickly, to gain access to remote projects, work with local communities. So it's really important. Another couple of people I'd like to highlight are our exploration geologists. Our chief geologist there is Guillermo Pensado. Guillermo is a unique individual in that he is a geologist and an expert in uranium. It's not a very common thing to find in Argentina. So he's been very key in helping us to understand the geological model and advance this. And again, Guillermo received the Exploration Geologist of the Year in Argentina just about a year ago. And the last person who joined our team here is Chuck Edwards. Chuck Edwards is a metallurgist and processing engineer, and he was the chief metallurgist for Cameco for over 20 years. And he loves this project. He's joined us as an advisor. and he heads all our metallurgical and process engineering work. So we have a really top-notch team, and I feel a great sense of pride to lead a company, with such empowered individuals behind me.
No kidding. You know what? I used to live in the Terminal City building in downtown Vancouver, and I used to always bump into Joe Grosso in the elevator. So haven't seen him in over a year, but you got to tell him I say hi.
I certainly will.
Okay, now speaking to your prospective shareholders right now, I want to ask you about trigger points. Thank you for opening up the kimono, Nico, and letting us inside the Blue Sky story a little bit. What should investors be looking out for in the next 6 to 12 months? Trigger points for Blue Sky Uranium.
I think Blue Sky right now is at an inflection point. I think, the PEA that we did, it established Blue Sky's current deposit to rank amongst the lowest potential operating costs in the world. I think our PEA had a cash cost of $16 a pound, which is a lot less than what you see with most hard rock uranium producers, which is upwards of $40 or $50. Now, the second leg that we need to demonstrate is, this entire district. How quickly and how cheaply can we find additional resources? And that's what this current drill program is. I think in the next, by the end of April, beginning May, we're going to start getting some of the results back. If we're getting good grades here of uranium, I think we're going to be off to the races in terms of growing the current resources and demonstrating the scalability of the project. And then the next step is in May, we plan to commence our pre-feasibility studies. So that will take about 10 to 12 months. And at the end of that point, we'll be making production decisions.
Okay, excellent. All right. Look, thank you for coming on. There's definitely sentiment building around the uranium sector on my channel, and for myself, we all look towards NextGen and Cameco as a safe home for capital in the uranium sector. But for investors like me, who like to move earlier stage and really get that torque, we're looking for companies like Blue Sky. So Nico, appreciate you making the time to come on today, connecting with my audience, and I'd like to do it again sometime in the future.
I would love to. Thank you, Jay.
If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
All right, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Jeff Clark, the gold and silver analyst at goldsilver.com and the gold advisor on Twitter. Jeff, it's good to have you back.
It's great to be back with you, Jay. Thanks.
Well, I wanted to bring you back on because we chatted in January at the summit we produced on the YouTube channel then, the VRIC. And, through December and January, we ended up collecting about 100 forecasts from newsletter writers, analysts, money managers, because everybody puts out their forecasts for the year in December and January. We collected a ton of them. But the first quarter has been not what a lot of us expected, right? So I wanted to pull on a few of the personalities that I trust and opinions I respect to get an update and say, here's where we're at, here's where our conviction lies. Because I am getting some messages these days from our precious metals investors who, at the end of a 7-month softening in the gold price are now starting to question their conviction and wonder if they made the right decisions in their portfolio last spring and summer. So why don't we start there, Jeff? What do you have to say to investors who are questioning their conviction right now in regards to gold and silver?
I think it's always wise to, reconsider or question your assumptions about a bull market. But there's really nothing, honestly, that has forced me to change my mind. The fact that the prices are stagnant, weak, range bound, however you want to describe it, doesn't really change my idea of where we are going in the big picture ultimately. look at 2006. Pull up a price chart of gold in 2006. It was flat for a long time, over a year, I believe. I wish I had the data in front of me, but it was flat for a long time. And a lot of people thought, this is not, the bull market's over. It's not going anywhere. Yeah. And a lot of people used that opportunity to buy. And of course, they were very well rewarded after that. There are other examples like this in history as well, where the price is really flat in the middle of a bull market, or the price even goes down a lot in the middle of a bull market. So I think if you focus on the big picture and not the road right in front of you, but the horizon, and you look at all the factors out there that could impact and propel gold and silver prices higher, you have to view that as the current environment as something that would be more of a buying opportunity as opposed to anything else. At least that's how I view it. I don't think the bull market is over. I don't think we're in a bear market. Look at 2008. Look what happened then. Gold and silver prices sold off big time in October. Gold fell by a third, from 1,000 down to 700. By any technical indication, we started a bear market. And yes, of course, that was the time to buy. If you happened to buy on Halloween Day in October of 2008, you were very well rewarded. I think, based on incidences like that, we're in a similar environment now. The price is range bound, but ultimately, I think we're headed much, much higher.
Okay, thanks for that perspective. I like how you encouraged investors to step back from the day-to-day fluctuations, because it's so easy to get trapped in that, right? You start obsessing over the price of things and the day-by-day or even week-by-week movements, which in the big picture aren't so relevant. So therefore, Jeff, what are the macro trends that keep your conviction high right now that investors should focus on?
I think, in the big picture, it's what Mike Maloney has talked about. It's monetary abuse, basically. What we're doing to the currency, especially in the US, but this is a global thing as well. Not only are all currencies today fiat for the first time in recorded history, but you have most of the advanced economies grossly abusing that currency, right? And I just don't believe in a free lunch. I think there will be consequences to that. It doesn't feel like there will be consequences right now, right? But there is no free lunch. Look at almost any period in history, and you'll see that when there are abuses like this, going all the way back to the Romans, that this has impacts on the currency. It causes a monetary shift. It causes a crisis. It causes turbulence. And when that shift begins to take place, that's when gold and silver are really going to shine, irrespective of what any other asset might do. So, in the big picture, I really view this as, look at it this way. I'm going to hold gold and silver and continue to buy on weakness until the monetary system is redone. Until the dollar is, the abuse the dollar is going through it. I'm not saying this is imminent. I'm just saying in the big picture, I'm going to hold gold and silver and mining stocks until there's some kind of revamping of the system, because there's always an accounting of the monetary abuse versus the price of gold and silver. And that process has not taken place yet. Therefore, I'm holding and buying until it does. Okay. So then, if you built your portfolio last spring, call it early spring, picked off a lot of what you interpreted to be top performers in the gold and silver space, saw a phenomenal rally through the spring until July, August, and even a little bit after that. Right now, what are you doing, Jeff? So we've seen a depression in the price, valuations have come down. I stopped buying gold and mining equities in July, August, because things got a bit expensive. It actually got kind of frothy for a short period there. So it's almost like a reset, a second chance to participate, but you have to have the wherewithal to believe that your thesis is correct, that this is just that 30% correction that occurs in almost every bull market. My question, Jeff, is what are you doing right now? Are you sitting on cash waiting for things to come down even further? Are you actively buying in the market, or are you sitting in your portfolio happy with it and this is just a blip on the radar? Well, first, the key to determining what gold and silver equities are going to do is what are gold and silver going to do? So irrespective of what the stock market does, what real estate does, what Bitcoin does, what do gold and silver do? If you believe they're ultimately headed higher, then that tells us that based on history, the equities are headed higher as well. So what I did, and I say this in full humility, but I bought very aggressively last March, both miners and the physical metal, and obviously did very well. And then in July and August, I started taking profits. And now what I've been doing is basically buying. I'm doing three things. I'm holding what I have, because even if there's a stock market crash, I'm looking at what gold and silver are going to do, not what the stock market is going to do, at least looking more to that. So I'm holding, I'm building cash, because if there is a big sell-off, you want to be able to take advantage of it. And having a nice cash buffer, that kind of empowers you. That empowers your portfolio, right? It gives you a nice buffer, and it allows you to take advantage of opportunities. And then the third thing I'm doing is I am selectively buying right now. You have some producers that are off 50% from their August high last year. So, this is a strategy I use. And again, I say it in full humility. The timing has been great for me, but I learned the hard way. I'll admit to you, and this is embarrassing, but Jay, I chased the uranium stocks up in 2006, the big run up, right? And then the crash in 07, I believe. I chased them up because I thought, wow, this is a raging bull market. I want to participate. And oh man, I got hurt, financially in my portfolio because I chased them. So I learned by experience through the school of hard knocks not to chase. And so I don't chase. And I also learned that you buy when things are weak. If you believe in the big picture, if someone is doubting the big picture of where gold and silver are headed, then you probably don't want to buy. My conviction is I think by any reasonable standard, they're headed higher. So I'm buying now. So that's what I've been doing.
Okay. Now, last we spoke in January, it was a little bit less clear on how the vaccine rollouts and recovery was going to look, right, on the back of this pandemic. You've since made some pretty bold predictions on the CPI for this year. So my question for you is, I generally get if I were to really generalize, two predictions on this show about what's going to happen after we reopen the economy. Either we're going to have a widespread insolvency crisis that is yet to be realized because of all the stimulus. And once that is shut down, small to medium businesses will be left on their own, and the truth will come out that they're insolvent, right? That you can't shut down an economy for 12 months without severe consequences coast to coast. But the second is, no, it's actually going to be the economic boom of our lifetime, because the whole economy simultaneously is going to wake up and begin charging. Do either one of those plot lines resonate more with you, Jeff, or is it somewhere in the middle?
The bold prediction I make, and I'm staying with it in January, was that the CPI doubles. Yeah. We've had asset price inflation that comes from the monetary side of things. But what's coming now is fiscal stimulus, and that's a direct injection into the economy. And also you have so many other inflation indicators, commodity prices that look like Bitcoin charts, input costs are rising, shipping costs have tripled in a year, so that's going to cause, consumer price inflation. So I made that prediction when the CPI was 1.4. So I thought within a year by January, it gets to 2.8. Who knows? That may end up being conservative. Now, the caveat to all this is that if we do get a stock market crash, that is obviously deflationary, and that would temporarily, at least, hurt the inflation argument. But there's also the combination, inflation and deflation, the stagflation like we had in the 70s and 80s, right? That's also a possibility. But yes, I think I do lean a little more toward the inflationary side of things. There's a lot of pent-up demand. Supply is crimped. Savings, I don't know if a lot of people know this, savings rate in the U.S. are at their highest level ever in recorded history since the Fed started keeping records on that. There's more in household savings right now than ever before. So a lot of that cash is going to come out as well when things start to open back up. People are anxious to get out again, just like you and I were talking. We got on air here. We want to travel again. I think all of this is going to contribute to a real push on demand and a real push on supply, a real crimp on supply. All of that is inflationary. So I tend to lean toward that argument. The great thing about gold and silver, though, is they don't have to have inflation to do well. They're a crisis hedge. They're a store of value. There's a lot of other catalysts that could push them higher, right? I just happen to think that inflation is probably one of the bigger stories, probably later this year, probably this summer.
Okay. Now, another prediction you made earlier this year was your expectation that silver will double. Do you stand by that today?
Yeah, I made that in January as well. So I think silver hits $50 by, by the end of the year, January, somewhere in there. And that's based partly on the inflation argument, right? And silver clearly responds historically directly to inflation. So if consumer prices do move up, and again, I'm referring to consumer prices here, not monetary inflation, but the actual CPI readings. If that begins to move up and makes headlines this summer, I think silver responds. And silver's biggest bull market in history was during the runaway inflation of the 70s. Its second biggest bull market was during the fear of inflation from 2009 to 11 with all the QE efforts. We didn't actually get CPI inflation, right? Mm-hmm. But we had the fear of inflation, and that fear drove people into gold and silver. And silver always responds more than gold. In every single bull market, silver has outperformed gold. And I think that's exactly what will happen again.
And is that reflected now as you're back in hunting mode, which I love. I love to hear this. And so congrats, took profits July, August, smart. Now you're ready to go back into the market at depressed valuations from when you exited. Are you approaching with an emphasis on silver therefore for that torque, or are you split? How are you looking right now?
Oh, I'm looking at both gold and silver, definitely. But obviously we're including silver in this mix. You want to have silver in your portfolio. I wouldn't go so far as say I would have only silver, because there are some differences between gold and silver. We can go into that if you want, but I'm looking at both. I'm looking at the opportunity. It's just that with silver, you are going to get more torque, as you say. That's well put. It's going to rise more. The equities are probably going to rise a lot more than the gold equities. So I'm definitely focused on both.
Okay. Last question before I want to try to peel some stock picks out of you, Jeff. Yeah. So the world is opening up now. We're getting back in airplanes. You're heading to Miami in June. We're looking at booking at events in Florida in September. And this is all good stuff. So now that we can get on airplanes and travel again, is there pent-up M&A demand that will be realized?
Oh, I love this topic because, yes, that's exactly right. Think about it. Analysts have not been able to get on planes, just like we haven't been able to get on planes, right? So all the bank analysts and all that, they've not been able to visit projects. Now they're going to be able to. And so M&A is likely going to pick up. It's already starting to pick up a little bit, right? I think for that reason alone, you're going to have analysts on site looking at projects. We also have simultaneously, supply is dropping, new supply is dropping in both gold, but especially silver. So there needs to be M&A. They haven't done as much exploration and development and expansion since 2013 when prices crashed. So there has to be M&A for that reason as well. So you put those two factors together and you could see a nice little surge in M&A this year, next year, and going forward. So I think, you want to look at things that are big and rich.
Can I press you for any takeout targets that you're looking at?
Well, I wanted to talk to you about First Majestic Silver too, because they just did M&A, right? They bought the Jarrett Canyon gold mine there in Nevada, which is kind of in my backyard. I've actually been there, but I didn't get to tour the operations. But this is a very big mine, and it produces a lot of gold every year. First Majestic just bought that. And interestingly, so that's gold, right? And First Majestic Silver has had primary silver projects only, but they bought a gold deposit, and it'll increase production by roughly 30%. The dilution was about 12%, so it's a very accretive deal. But they're diversifying, into gold. But they assured me, I've talked to management about, they assured me that their next asset purchase is going to be silver. Definitely, you can count on it, is what he actually said. So
now First Majestic, to my knowledge, Jeff, was the only pure silver producer up until this acquisition. Anybody else on your radar?
For silver, or I like that, and I just was going to mention real quick. A lot of people like to follow Eric Sprott, right? And he invested again in the company to make this acquisition, and now he has $550 million, over $500 million invested in First Majestic Silver. It's now his largest personal investment in the mining space. So that tells you what he thinks about it anyway. So. But to be honest, what I've been buying recently is some of the pre-producers. And I like this stage because a pre-producer implies they're going to become a producer, but they're not there yet. They're building a mine, gearing up for production. I like that because they almost always get a re-rating. You can count on, and think about it, you go from a cash-eating junior to a revenue-producing company, and you should be re-rated. So they usually get that re-rating. So the two that are on my radar right now that I'm actively buying right now is Ascot Resources, ASCOT Resources. You can look that up. They basically have two gold projects that are going to feed into a mill. The IRR, the combined IRR there is over 50% now. We did really well in pure gold, and I think this could be the next pure gold. And just to give you an idea, those stocks, when they get the re-rating, leading up to production, the stock tends to rise. But it's the last 3 months where that sweet spot is, where they tend to rise the most. So Ascot's probably not going to be in production till the end of 2022, right? So it may not be till next September when you see the big rise in the stock. But of course, between now and then, the stock could be up 50%, easily, especially if gold and silver rise. Right. The other one I've been buying a lot, Jay, is Artemis Gold. Okay. Yeah, I like that. It's the Blackwater project in BC. It's huge. Yeah. It's got over 8 million ounces just in reserves, and
amazing year in 2020.
Yeah, amazing year in 2020. That's going to be a mine. It's low grade, but the IRR again is like 51%, I believe. Okay. So that's going to be a mine. So I've been buying it on weakness. They're probably further out than Artemis than Ascot in getting into production. But I've been buying on weakness out, building a position while the stock is weak in anticipation of that re-rating 2 or 3 years from now. So those are two also that I really like right now.
Now, a couple companies you mentioned to me in January. One is Maple Gold, an earlier stage speculation. Any updates on your preference there?
Everything I said then is actually still true. They're gearing up now. The JV with Agnico Eagle is closed. They've built up cash. They're looking to drill now. They'll be starting. They're in Quebec, so they're going to be drilling here real soon. This year is going to be a major drilling year for them, so it could be potentially very exciting. There's a lot of things happening there with that company, so I definitely like Maple Gold. The stock has been weak because there hasn't been a lot of news recently, so this has been a good opportunity to buy for those that maybe want to take a stab at that. But I do like Maple Gold. There's a lot of potential there. It is a speculation, but wow, lots of potential there. Could be exciting.
Okay. Any others that you want to call out before we wrap it up, Jeff?
There's a lot. I frankly, do as I say, not as I do. I own probably too many juniors. It actually got to a point where it's getting hard to track them all. So that's why I kind of started putting some more money into the pre-producers that I mentioned. But another one I really like, I've been buying, is Metallic Silver. That's up in the Keno Hill district, which is one of the highest grade silver districts in the world. They're onto some things there, lots of drilling going on. They're surrounded by 8, I believe it is, other mines or projects in that area. So it's a very fertile, prospective area for looking for silver. So I like that one too.
Okay. Look, Jeff, I appreciate your time, and thank you for coming back on and updating our audience. Thank you.
Thanks for having me, Jay. Look forward to seeing you in person at the next conference.
100%. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined by Alex Sukernick, President and CEO of Nova Royalty Corp. Alex, welcome back. How are you?
Doing great. How are you, Jay?
I'm always good, man. It's good to see you again. You know, every time I have you on, it's because you've just completed a transaction. I've had you on like once per month in November, right? Yeah. And you came out the gate so hot with this story. The market responded really, really well. I mean, anybody who built a position in the winter has been very favorably rewarded. You know, so I want to talk to you about what's next in the pipeline. You know, what goals you're setting for 2021. I know you're a long-term thinker. I love when I first met you when I was asking about, you know, the near-term 12-month plan. And you're like, I don't think about anything in terms of a 12-month plan. Like, this is a legacy business we're building here. And I appreciated that. And the proof is in the transactions you're putting together that are very forward-thinking. What I wanted to do today was revisit the macro a little bit and the copper narrative a little bit, because in December and January, Alex, I sat down with probably 100 different analysts, newsletter writers, money managers, and because everybody puts out their forecasts in December, January, right? And copper was one of the most common conversations that we had. And you shared an article with me a couple of weeks ago, put out by Trafigura, one of the world's largest commodity traders, forecasting by 2030, it's a 10 million ton copper deficit annually. And 2030 is not that far away. So first of all, just what are your thoughts on that? Is this realistic? Is he on the money there? And what happens next with the deficit like this?
It's crazy. I mean, 2030 in copper terms is like tomorrow. I mean, if you listen to what the Freeport CEO was saying, I think recently, he said that if you want to develop a mine, and it's assuming you have a real reserve and you've done your technical work, it's a 7-8 year process from today. So, I mean, 2030 in this industry, which has such big lag times, is literally tomorrow. And so 10 million tons is, the number is much bigger than people think it is. I mean, so this is a market that's about, say, 25, 30 million tons a year, depending on how you count. It's very tough to bring one mine into production. I mean, it occupies the resources of a major company to build one mine completely. And so, for instance, take Taka Taka, you know, where we own, let's see, the First Quantum's next major priority, which I mentioned multiple times now. Now, that's going to be a mine that's going to take them probably a good 3 to 5 years to build. It's going to be multiple billions, a lot of challenges. That's going to produce, you know, an average of just over 200,000 tons a year of copper. So that's going to fill 2% of your deficit that's coming basically tomorrow. So the question is, where's the other 98% going to come from? Yeah, and so it's. I mean, I don't think anybody knows. I don't think anybody knows the incentive price that it actually takes to speed up. I don't think anybody knows exactly what the production schedules look like. I mean, one thing we have learned over time is that these big projects, you know, kind of where we focused our royalties on, is that's going to be where people look to, because there you can get the scale. You know, both initial production, you can expand them because these are massive ore bodies. They always get expanded over time anyway. You might be able to speed up the expansions.
Sure.
So yeah, look, I mean, you look at that number, you're not even sure if you can believe it, to be honest, because it's just so big. But it looks like, listen, that's what the world is looking for in terms of decarbonization goals. I mean, the industry is going to have to figure something out.
Yeah, and that's what when you look at numbers like this, that's what I try to wrap my mind around. It's like what do you do about this? I mean, it's a substantial deficit. And okay, let's talk about that demand for a second, Alex. So 10 million tons a year is colossal. Where is the majority of that demand going to come from?
It's going to be worldwide. I mean, that's the thing. I mean, what we've never seen, which is what's happening now. I liken it. Imagine if the whole world was undergoing an industrial revolution at the same time, and they're all using the same inputs to get there. I mean, this is I think why we started the company. I think in the first place, we saw this trend coming. It's not even a trend; it's just a complete change in terms of how we operate. And I mean, I'm a history buff. I've read enough in my life, and I have the industrial revolutions that we've seen in the prior age. They all happened separately. You know, the Americans did it in their own time. The Brits did it in their own time. Europe did it in their own time. Russia. So it was spread out. Right now, everyone is doing it right now, and they're trying to shorten the time frames as quickly as they can. And they're all using the same technologies. So I have never seen anything like this, actually.
Do you ever wonder about the geopolitical implications? Because like you said, it's a worldwide demand. Everyone's trying to build at the same time, and everyone's charging towards an energy revolution or variety of things that are creating this copper demand. So the competitive landscape that's going to be created, you think is going to be significant. Do you think about that? Yeah,
of course. I mean, listen. I mean, these are, you know, kind of. I mean, I think I mentioned before. I mean, I think that a lot of people and governments, they consider sort of this energy transition effort to be existential. You know, this is something that they view as vital to the survival of the world and their countries and populations and the like. So the resources you need become a strategic asset, no question. So no doubt. Listen, I mean, there's a lot happening. I think the world is changing kind of faster than most of us can keep up with at the moment, to be perfectly frank. But I mean, all we see right now is that you're going to have this need, and it's not like you can just bring a random deposit into production. You know, this is a complex business. It requires a lot of money, a lot of expertise, and so I think that, you know, the deposits that are large and capable are just going to see that much more love and attention earlier from people in anticipation of that.
What is the average time horizon to put an economic deposit into production, Alex?
Well, listen, if you're talking from exploration to production, you're talking 30 to 40 years. I mean, this is not a short development timeframe. You know, once you have a full reserve and things of that nature, I mean, like Freeport said, you're talking the better part of a decade to get that done. You know, because permitting. I mean, look at permitting right now. Look at the United States. It's not easy out there right now. So I think the world right now is really figuring out where the stuff can be produced sustainably. You know, so it's not like I'm pointing a finger at the regulators at all. It's just the fact is that there's environmental considerations which are very important right now. Yeah, this wasn't the case, say 50, 70 years ago when it was happening. So you've got two competing needs. You have the need of the world to create sort of this energy transition. At the same time, you know, the mining industry is the mining industry. You know, it's not all easy. You know, obviously there's environmental concerns that come with that. And people are trying to address that, but I think there isn't a consensus yet on how it's going to happen. And I think people have talked about this, multiple times. It's like you're unleashing so much new metal demand, but the question is how you're actually going to get there. So I think we'll all find out.
Right. And those are the options. We're going to see a rising price inevitably when there's such an asymmetric supply and demand landscape. We can look at speeding up the expansion of current mines and then expediting the build out of proposed. What countries come to mind, Alex, as the most favorable locations investors could be looking at if they're looking at near-term producing copper deposits? Nearish.
I think we really love Canada and Chile.
Yeah.
I think those are excellent places. Really super supportive. Australia is excellent. I think the Salta province in Argentina, where Tacataca is situated, is excellent. So I think that, you know, there's definitely some places which are making a clear effort to really beat, I think, the key regions where these materials are produced. And so I think, you know, the world will somehow distribute, I think, kind of who does what. And I think from what we see right now, these places definitely look very strong. And then we'll just see how it goes from there.
Okay, so let's talk Nova for a minute, because you were incredibly busy over the last 6 months. Like I said, every time we had you on, it was to talk about your most recent transaction. And I know there was a sense of urgency, right? You were the first mover out the gate. You've locked up agreements with all the significant copper projects to be honest. What's next for you? What can investors expect in terms of news flow for 2021?
Oh, look, we're hardly done here. I mean, we've only begun, so I think that, we've picked up royalties and some exceptional deposits, no question. And I think, we've gotten out of our way to make sure that we got royalties on things that had a clear future in the hands of strong people. I think we've done that. But there's more left. And so, when we started the company, we literally dug up every piece of copper, nickel on the planet, every camp, everything that's in the pipelines of majors and mid-tiers and juniors and et cetera. And so we have a global team. It's in every place, and we're constantly talking to royalty owners about potentially doing deals with us. Our job was to track the world, and because we really want to create the best possible proxy for the sector, as we grow. So look, I think it's reasonable to expect that we'll continue adding to the portfolio. And so I think, listen, it's been a great start, and sometimes we'll do more, sometimes we'll do less, but I think we have a lot happening here, so it's going to be exciting, to really grow the company into something that any investor hopefully can see as a great proxy for these commodities.
And that's what Nova really is, right? It's the proxy against the copper price. So anything you can talk about, or go ahead?
Well, I think it's both. I mean, the copper price is good. But I think more importantly, we don't want to be just slaves to the copper price. I think we've gotten the royalties on really exceptional deposits that will operate once they're going in any copper price. And so, and I think that's a critical thing, because the advantage of a royalty is if you do your asset selection correctly, you're getting generational dividends essentially. And so look up when the commodity prices go up, obviously you do exceptionally well. But even when they fall, if you have the right asset that's strategically positioned, I think you can do very, very well. And I do think that's a critical differentiation from the royalties. I mean, take an example. Imagine that, for instance, right now, I think we're looking at a very high copper price environment for the next 10 to 20 years just because of what's happening. But these are mines that will outlive that as well. These are 50, 70, 100-year projects eventually. So you're going to go through periods of all kinds of copper prices, but these are also deposits that naturally expand over time. So you can have the copper price drop, but your royalty revenue may go up because your deposit, actually naturally kind of expands. That's the nature of, if you look at the history of what mining companies do with their prime projects, that's exactly what occurs. I mean, I saw a presentation from BHP some time ago. It's a shame that I lost it somewhere, but they basically showed to you kind of the return on capital on all the on all the major projects. Kind of in the mining sector. And most of them lose money, except that 1%, which actually compounds at double-digit rates for decades. So all we've done here is you try to buy royalties on what you think will be that 1%. That will really kind of be the focus of people and really generate those returns. So I think that kind of as a company, that's what we wanted to create and to build. And look, we're obviously always looking to add more. I mean, I think the reason you buy a royalty company versus something else is obviously the current assets give you everything. They give you the asset upside, they give you the commodity price upside, and they also give you access to the company and the team that built it, so that we can add more things of that nature to the portfolio. And you can do that obviously kind of in the structure where your G&A cost of running the company. We spend everything we need to spend in the business to make it successful, but in the context of the size of the assets, it's very small. So it's really something where you can run a top-notch business in a very good way without ever really interfering with the asset value which you got. It's great. So yeah, look, I think it's pretty exciting.
Now, I have to imagine you're on the radar of some traditional precious metal royalty companies, even though you're focused on copper nickel, which may be outside their historic business model. You've got to be on the radar now as a potential horizontal integration. Mm-hmm. Have you had conversations with any, Alex?
No, nothing serious. Certainly. No, not really. Okay. We think that, like precious metals guys, some great companies in that sector, of course. But for us, listen, all we're concerned about is really where the world's heading and capturing royalties on what we think will be the most strategic deposits and giving investors a way to invest in that. And so that's really, I think, the full scope of our activity, and that's pretty much all the time is spent on that. Any corporate stuff and things of that nature. I'm not sure how that fits into what we're doing at all, to be honest. It's all, so.
I appreciate that. No, I'm just curious because I have to imagine your names come up in a variety of boardrooms in the resource business when looking at the growth of the business and where this is going.
Yeah, look, I mean, it's we never saw the company as something that we needed to sell. I mean, the reason I think you started business is because you think you can build a great business. That's all we think about.
Sure. Okay. Do you expect going back to the market for capital in 2021?
Well, listen, given how much we're doing, we'll I mean, if we don't come back, it means that something has gone wrong. So I think that we definitely will be back at some point. Look, we've got access to some pretty good financing tools. We've got a healthy balance sheet. We've got $20 million available from BD Capital on the convertible loan facility. We have an ATM facility that we set up about a month ago or so. So I think, we have more than enough for certain things, but obviously, given what we'd like to do in scaling the business, at some point we'll definitely have to come back as well. So we'll just see what form that takes. I think the way we think about it is we set out to build a business that would be the best proxy for investing in these commodities in the whole energy transition thing. Whenever we go back to the market, it's because we saw a great opportunity to enhance that business, and we need additional capital. So I think that whenever we do come back, investors, I think, will be pretty excited to hear from us because it means it's something that really adds value. So, when that happens, it happens.
The 20 million facility with BD is relatively new, if like 3-4 weeks ago, correct? So talk to me a little bit about this.
Well, the facility is not new, but the amount is new. So they funded us really before we went public. They gave us that financing facility for $15 million. And so that was a $13 million convertible loan facility and a $2 million commitment to invest in their first equity offering, which they did already. So we had used up, it was $8.5 million of the 13 of the convertible loan facility on the Vizcachitas deal. We used up 5. And so we had 4.5 left. And I think they're quite happy with what we're doing so far. Now, and obviously, look, we have a need for more capital just in case we need it. And so they were really gracious, and they gave us another 15.5 to expand that because we were down to 4.5 availability. So now it's back to 20. And it's a great tool to have, whenever something serious comes up.
Okay, 100%. Look, Alex, it's been great having you back on. We started covering the story in November. I know a lot of our subscribers bought in. They've been handsomely rewarded, and I like to stay on top of it because it's been a moving target. And I know a few investors have been chasing the stock. They've messaged me about it. So,
well, the thing is, it's funny when you get calls from investors, and people want to know why the stock has gone up so much. And I guess we consolidated a little bit. Now they want to know why it dropped a little bit. And to be honest, I'm probably the wrong guy to ask about all this stuff because it's. You're just building the business. You see so much opportunity and upside. I mean, whether it's $2, $4, $6, $10, $20, like you're not really paying attention to any of this. I mean, because you have so much you can do here. I mean, we got lucky that we were the first mover, and we got a chance to get some great assets, and we have a window to more great assets. So all you're thinking about is building a great business. The market's the market. I mean, I don't know what else to say.
Yeah, good for you. It's a good outlook, honestly. Getting yourself out of the noise, right? And just focusing on the signal.
Yeah, like I don't have time for noise, to be honest. It's just, you don't have a lot of choice, to be perfectly frank. But no, like we've been blessed with investors, I think, supporting the story. It's great to have people who call us up and they say, no, we love what you guys are doing. It's some people, it's the only stock they own, which is great. I mean, I think, my favorite deal, I think, still is very much the second Taka deal. When we did the first one, they took 80% cash, 20% stock. And that's understandable. We were like a super new company. We had just gone public like a week before. I mean, we were just happy that we got it, to be honest. Right. And then, I think we started building the business and began to execute the strategy. And I think they saw kind of what we're trying to do. So when it was time to buy the other 0.18% that they looked to do something with, they took 80% in shares the second time, and so I think when that occurs and people show that vote of confidence, and it was actually done at a materially higher per share price than we did the first deal. So look, you're flattered and really honored by the shareholder support, and hopefully it stays that way.
Yeah. Well, you're humble, and how many times you mentioned luck, and you've been blessed, and you get lucky and all this stuff. But I know it's hard work behind the scenes. So I guess we'll keep our eyes open, because I know the pipeline is full, and you didn't touch on specific transactions, but I know there's some coming. So we'll stay on top of it, and I'll look out for news.
Yeah, look, on the deals, it's tough to touch on that. All I can say, Jay, is like our job is to track the world. So anything in our sector, we're intimately involved in anything whenever there's a window open. So, I don't even know how to guide on this stuff. I mean, our job is to cover everything and go through the window when it's there. So, that's all I can tell you.
I love it. Okay, well, we're almost allowed to fly again. I'm coming to New York probably late spring. So
phenomenal.
I'll have to hook up. I look forward to it. Yeah,
absolutely. All right. Thank you very much.
Thank you, Alex. If you are just tuning in, my name is Jay Martin. I'm an investor and the CEO of Cambridge House. And today, what we are doing on the YouTube channel is revisiting the forecast that we collected at the beginning of the year. In December and January, I probably interviewed 100 investment gurus here on the channel so that I could create an ideal portfolio for myself for the year. But a lot's changed in the first 3 months. And so today we're having the Q1 wrap party, revisiting our forecast from January, determining where we were right, where we were wrong, and how we need to adjust our portfolios accordingly. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined again by Peter Schiff, the chairman of Schiff Gold, the founder of WRPSF. Peter, how are you?
I'm doing well today. How are you?
Good. I'm really good. Yeah, good to see you again. Where I wanted to start is I've got a question for you, something I'm trying to wrap my mind around right now. I think that most people who pay attention to the markets right now would agree that inflation's going to run hot. And I think that most people who pay attention to the market right now would agree that the Fed's going to continue to suppress rates. And historically, that formula that creates negative real rates has been the setup for a rising gold price. But that being the case, for the last 7 months, the opposite has been proven true. And so my question for you, Peter, to start is, what am I missing? What are we missing here?
Well, I think the key to the reason that gold hasn't done better is, first of all, we did have a pretty big run leading up to this period. I mean, gold hit 2,100 and change last year. And so nothing moves up in a straight line. And at that point, when gold was at its peak, a lot of people were bullish. And we know that markets don't like to go up when everybody is bullish. So generally, something has to happen to shake confidence so that enough bulls turn bearish, right, before you can have a base to build another rally. So I think what you're missing on the inflation thread is, yes, most people see that inflation is going to run hot and that it's going to be north of 2% and maybe even north of 2.5 or maybe 3. I mean, people, will vary on how much they think we're going to overshoot. The Fed has already said that they're okay with an overshoot because the Fed is confident that it's only transitory, and that even if we have higher inflation as measured by CPI for 2021, maybe even 2022, that it's going to be short-lived and we're going to be back into our sub 2% zone, right? So I think to the extent that the markets agree with the Fed that the increase in inflation is temporary, it's hard to argue that then, we should factor a temporary increase in inflation into the price of gold, right? Because, you're talking about a long-term forecast for inflation when you're moving into gold. But I think the other factor is that people still expect the Fed to fight inflation, especially if it ends up getting out of the comfort zone. I mean, maybe headline inflation does come in at 3.5, 4%. I think what everybody thinks is that, the Fed is going to have to tighten in the face of that big a overshoot, right? So I think the markets are also bracing for the fact that, maybe we're going to get more inflation than the Fed is bargaining for. And therefore, the Fed is actually going to tighten rates a lot sooner than they're now indicating, because their current posture is based on inflation not getting too far above 2%, even though they haven't specifically said how high above it they're comfortable. I think the markets are trying to get ahead of that by thinking, it could be a lot more than they think. And therefore, the Fed's going to have to raise rates sooner than they're saying. They may have to start, tapering off their bond buying sooner. And so I think that's also scaring the gold market somewhat, that the Fed is not going to be as easy as the market thinks. Now, I think the market is wrong on both counts, right? I mean, I think that inflation is actually going to overshoot by a much bigger margin than pretty much anybody thinks. I don't believe that it's temporary. I believe it's the beginning of a protracted period of much greater increases in consumer prices. I mean, the Fed tries to hang its hat on the fact that the last 10 years or so, or 20 years, we haven't had a lot of inflation. And the Fed says, well, that means that, that's the new normal and we're never going to have it again.
Right.
I think that was the aberration. I think we're going to go back to normal. And I think there were some other factors that helped to mitigate the impact of inflation, which is the expansion of the money supply on U.S. consumer prices. I mean, one certainly was the CPI that was dramatically changed in 1998, and all of a sudden, magically, inflation disappeared after we rejiggered the CPI because we claimed that it was overstating inflation, so we had to fix it. And I think now it understates inflation. So that's part of it. But a lot of it had to do with China and their willingness to accept our dollars and exchange for their products and just buy our treasuries and supply our market with all sorts of consumer goods. So there were these, extenuating factors that I think made the lag between printing money and increasing prices longer than normal. It didn't stop it. I mean, we're going to see the impact. We're just seeing it later than we might have in the past. But so the other thing, though, that I think the markets have got wrong is not only is inflation going to be bigger than they think and not be transitory, but the Fed's willingness or even ability to do anything about it really doesn't exist. I mean, the Fed could talk all it wants about how it's going to fight inflation if it was wrong and inflation became a bigger problem. I just don't buy it. I don't think the Fed is going to do that. They can talk a tough game, right? They can bark, but they will not bite. Because think about it from a practical point of view. They've already said 2.5% inflation. That's not going to worry them, right? A little bit above, maybe 3. And they've also said they want to wait at least a year. They're not just going to look at a blip up in inflation. They want to make sure that the inflation isn't transitory before they take action. That's what Powell's already said, right? They want proof. They're just not going to look at it. They're just going to assume it's transitory unless they're proven wrong. So let's say they wait. And as they wait, the inflation just gets bigger and bigger and bigger because they didn't act preemptively. And now a year goes by and maybe inflation is 6%, 7%, and it's headed higher. And now the Fed is like, okay, we were wrong. It wasn't transitory. We got an inflation problem. Well, now they got a bigger problem in trying to solve it because now they have interest rates still at 0. What are you going to do if inflation is 5%, 6%? Move interest rates up to 25 basis points, 50 basis points? That's not going to do anything. They got to move interest rates up to maybe 8%, 9%. I mean, it's not even a possibility that they can go anywhere near that amount. They're going to have to start unloading U.S. treasuries and shrinking the balance sheet. They would create a far worse financial crisis than anything we took place in 2008 if they actually had to fight inflation because they waited too long and let it get out of hand. So my thinking is they will not fight inflation. They're going to surrender. Inflation is going to win without a fight. And so when people understand this, that inflation is going to be much greater than the Fed thinks or anybody thinks, and it's permanent, and the Fed is never going to do anything about it. There is no way to put out the fire. I mean, gold will just go ballistic when people, finally connect those dots.
Okay, there's a ton in there I want to unpack. I want to jump back to one point you made sort of midway through about CPI, because you were tweeting like last week, CPI is another government lie. And just now you referenced the changes they made in 1998. So my question for you is, what changed and why now should we not trust this number?
Well, the government always makes changes to their methods of measuring things, whether it's GDP or inflation or unemployment. And they always tweak the numbers to produce a better result as a report card. It's like, if the students were allowed to kind of change the way they were graded, like the methodology for coming up with their grades, would it surprise anybody that all of a sudden they started getting more A's and B's and fewer, C's and D's, right? Because they were in charge of it. So the government always wants to make the good stuff better, like economic growth, and the bad stuff worse, like unemployment or inflation, right? So they want to find ways to make those numbers little and the good numbers big. So they made a lot of changes in 98. I mean, very substantial ones, because they were taking into consideration the recommendations of the Boskin Commission, which according to the Boskin Commission, the CPI was overstating inflation. So they introduced other, formulas into the computation of the number to try to correct that, right? So they deliberately wanted the CPI to be a higher number because they were being told it was overstating. I mean, they wanted it to be a lower number.
Right.
So I'm not really sure. There's a lot of geometric weighting and substitution and hedonics and all sorts of stuff, right, that I don't really understand all the exact changes. But I know they were profound. And I think this period of, oh, wow, we have low inflation, it's not a coincidence that it followed this major revision into how we, calculate it. And I did this in 2013 and you can see the whole video. I did a big video on inflation. It's on my YouTube channel. But this was in 2013, right? And I said, I think the CPI is understating inflation. And I had a bunch of ways a bunch of baskets, but there was one thing that's easy to look at. And my video is a lot more comprehensive. I did a lot more analysis of different prices. But just to point out one of them, because I remember it was newspapers and magazines. So according to the CPI, from 2003 to 2013, newspaper and magazine prices were up by 30%. That's what the CPI said. Now, I figured, well, this is easy to check because all the newspapers and magazines have their prices on the cover.
Right.
So all I had to do is use the internet and get pictures of those magazines from 2003 and get pictures of the same magazines in 2013 and compare the cover prices.
Sure.
Right? So I did like 20 magazines, and they were the big ones: Times, Newsweek, USA Today, US News and World. I did New York Times, Wall Street Journal, Washington Post. I just took really big magazines, right? I don't know the exact ones they used, but they must have had a lot of the ones I used, right? Because I used the biggest ones.
Sure.
And I just compared the prices in 2013 to the prices in 23, added them up, took an average, and said, okay, how much more expensive are these magazines today than they were 10 years ago, right? Very simple. And I got about 130% increase in price.
Okay.
So the actual increase in price was 130%, but the CPI scored it as if the prices had only gone up 30%. So that is a huge amount of increase that totally was not captured by the CPI. Now, the question is why, right? How did the government take these numbers and get them so that they were so much less than the actual increase? Maybe they said the newspapers are better, they're printed on better paper, maybe they're delivered faster. I don't know. Maybe they assumed that people weren't paying the cover price, that more people were using subscriptions and getting discounts. I mean, I don't know what they did. But the result was that 130% increase turned into a 30% increase. And so this stuff is going on with a lot of products, not just newspapers and magazines. So, the measure is not honest. And of course, it's interesting because the government keeps complaining there's not enough inflation. Yet they're the ones that are cooking the books to pretend that inflation is lower than it really is. Because what they're really trying to do is get the go-ahead to produce more inflation, which is printing money. This is the problem, is that people are focusing on an effect of inflation and ignoring what inflation actually is. Inflation is an expansion of the money supply. It's the money supply that's being inflated. Prices can't be inflated. Prices can go up, they can go down, but they can't be inflated. It's money supply that's inflated. And when you have more money and then you're chasing a certain amount of goods, well, the price of those goods goes up. So inflation causes prices to go up. It isn't prices going up. And obviously we have massive inflation. We've never been printing this much money. So the question is, when is all this inflation going to manifest in a way that's, more obvious when it comes to consumer goods? And I think that's already happening. But, the CPI will never reveal the true extent of these price increases. But it's going to be more and more obvious as the true rate of inflation is so much higher than what they're officially reporting. There's only so much they can shrink the packaging. There's only, because a lot of the inflation comes because they just, give you less, or they substitute lower quality ingredients, or, stuff that used to come assembled. Now you got to assemble it yourself. They find different ways to lower the quality and not increase the price. And I'm sure the government's not picking up on any of that. It's probably, if the quality improves, they calculate that. But they probably ignore all the circumstances where the quality is diminished.
Interesting. Okay, now I want to jump to a quote that Powell came out with recently. I could probably guess your take on it, but I want to dive into it a little bit. Where he came out and said there's no longer a relationship between increasing the money supply and the value of that money, right? No longer a relationship between increasing the number of dollars and the value of those dollars. So just to jump into it, what's he talking about? And what's your take on that?
Well, he's trying to say that in the past, right, printing a lot of money would have been negative for the value of that money, would have been negative for the dollar.
Which is obvious, yeah.
Right, if he's saying that that's no longer the case, that is a ridiculous statement. Maybe you could say that for the last several years, that hasn't been the case. But to say that it'll never be the case makes no sense whatsoever, because you're basically saying that the law of supply and demand has been suspended, that somehow it no longer matters. Obviously, if the U.S. government mailed everybody a check for $1 million, we wouldn't all be millionaires. We couldn't all go out and buy, expensive sports cars. There's just not enough of them to go around. The prices would have to go up. They can't make everybody a millionaire by giving them $1 million. They could make them a millionaire, but you'll have to be a billionaire to buy things at that point, because being a millionaire won't matter because everybody will be one. So to make a statement like it's unlimited, we could just print as much money as we want, and we're never going to destroy the value of the money that we're printing. The money that you're printing, when you're printing paper money, you're not mining gold. See, when you bring gold out of the ground, you are introducing a new resource into the economy. You're bringing gold, which has all sorts of uses, right? And so the world is wealthier because a resource has been harvested and now is available for use, right? Mm-hmm. But when you print money, we don't have anything that we didn't have before the money was printed. So all money does is enable you to buy the goods and services that have already been produced. And if those goods and services aren't there, the money means nothing. Doesn't matter how much you produce if there's nothing to buy. And you just can't keep printing money. Prices just have to go up. What we need is more goods, not more paper to buy the goods. And so his statement is just so asinine, and it reveals, either a complete misunderstanding or lack of understanding of basic economics, or he's just lying and just figures that, nobody's going to pick up on it, right? He doesn't really believe it. He just doesn't want to admit the problem that they're creating by printing all this money, or get holders of U.S. dollars to start to worry more about the value of all the dollars they're holding on to. And not just foreigners, but Americans who may have dollars and that they're holding on to or saving that they're hoping to use to buy stuff in the future. If they understood the truth that those dollars may have no value in the future or very little value, they wouldn't hold them. They'd be getting rid of them right now, which is not what the Fed wants, because that would accelerate the crisis.
So that's I guess where I struggle with this, because I have to assume that Powell does understand basic economics, right? Like,
I don't know. I just know this.
Right. I mean,
man, that's he may not. I mean,
it's possible for sure. Anything's possible, and but I assume he's an intelligent individual, probably has his biases and his blind spots and his internal pressures that I'm not privy to, but he's got to be a smart guy, right? That's my assumption. I could be wrong there, right?
Well, he could be smart in intelligence and IQ, but there are a lot of smart people that believe a lot of dumb things. So
for sure,
intelligence is not necessarily something that's going to keep you from making these mistakes.
You're right. And I guess what I therefore wonder is how much of this is just to pacify sentiment. It's just to pacify the public, pacify the holders of dollars. Like, is that the core? Do you think that's the core motivation? It's to keep everybody calm, to avoid the crisis mindset. Everything's going to be okay. It's just that narrative.
Yeah, well, I think a large part of the Fed's job is public relations and spin, and to try to create a false sense of confidence in the U.S. economy, in the U.S. dollar. I mean, I remember I watched an interview or listened to an interview with Ben Bernanke, and he was being interviewed, I think, by maybe it was Motley Fool or some podcast or Yahoo Finance. It was something. But he was no longer Fed chairman. And so the guy that interviewed Bernanke played for Bernanke clips of Ben Bernanke talking in 2005, 2006, saying everything is great, there's nothing to worry about, we don't have a housing bubble, oh, the subprime market is contained, we're not going to have a recession, right? All these assurances that he was making that we shouldn't worry, everything was fine, right? And he plays Bernanke these clips. And then he says, well, how does it make you feel, right? To have been so wrong, right? Because clearly, it wasn't contained. There was a bubble. We had, not only did we not avoid recession like you assured, but we had the worst recession since the Great Depression, right? So he's basically like, look, you couldn't have been more wrong. And here you were, chairman of the Federal Reserve. You had all this information more than anybody else. Right now, he didn't say, hey, Peter Schiff was out there saying it's a housing bubble, we're going to have a financial crisis, right? He didn't bring me up. But he's basically saying, look, you had more information than everybody, yet you were so completely wrong. Like, how do you feel like knowing you were so wrong, right? And instead of saying, yeah, I really feel kind of dumb now that I look back, God, what was I thinking? I was so clueless. What Ben Bernanke said to basically save face, his answer was, well, I couldn't exactly speak forthrightly or honestly. I can't remember if I said honestly, but I couldn't actually say, what I actually thought because I was part of the administration, right? And so as I had to kind of toe the official party line, and I'm thinking, what? This is what he just said? Because the Fed is supposed to be independent. But what Powell basically said is, look, you shouldn't believe anything I was saying as Fed chairman. Bernanke. Because I'm not going to tell you what I honestly think. I have to tell you what the administration wants you to hear, that everything is great. And so that's basically what he was saying. Look, the reason I got it wrong was because I wasn't trying to get it right. I was just trying to reassure everybody that everything was fine and there was nothing to worry about because I was part of the administration. So this is what this independent central bank, and I'm surprised that these admissions didn't get, any more reaction in the media. I mean, I'm the only one I've ever heard comment about, such a statement. Right. But I mean, he really, let that out of the bag. And I think, yes, I think that these Fed guys, the Fed chairman, they're just like, people from, propaganda from the government. And also, I think the Fed, they think that confidence is very important, right? They don't want to do anything to shake confidence. In fact, they want to try to instill confidence if they think confidence maybe is waning. Sure. And so they look at it as like, oh, we got to talk how great everything is. And even if they think that there's going to be a recession or a crisis or the dollar is going to crash, they're not going to say, gee, we think the dollar is going to crash. Because if they say that, well, then it's going to crash even sooner. Even if it wasn't going to crash, their statement warning of a crash could cause one. Sure. So I think they're very, very concerned. They don't want to accelerate the onset of the crisis they see by acknowledging that they see it. They want to postpone that as long as possible. And they think one way to postpone it is just to pretend it's not even a threat and get everybody to not be concerned, and then hope that maybe it works out better, or that maybe they're wrong, or we never have a crisis. So I just never believe anything that they say at the Fed. I mean, I don't believe what politicians say either. And so I don't believe they're any different. And I don't believe that they're truly independent. I think, yes, they want to pretend they're independent, but that's part of the bluff to instill confidence in the dollar, right? That, oh, these independent central bankers, well, they would never allow inflation to get out of hand. They're going to raise rates. They're going to force the government to cut spending. They're going to force companies into bankruptcy. They're going to force real estate prices to crash. They're going to force stock prices to crash because they don't care about politics. Mm-hmm. They want to preserve the dollar. No, I think they care as much about politics as the elected representatives who appoint them.
Sure. Yeah. Okay. And I'm with you on all that. And I think that the confidence bullet point is so critical, not just like internally with, Americans worried about a dollar crash, but foreign dollar holders, maintaining their confidence is obviously super important. But I mean, what other tools does the US have? I mean, towing the party line, making sure, we appear like everything's fine, hold the dollars, no worries. Doesn't matter how much we print. It's not actually going to affect the value. But there's obviously other like foreign policy leverage tools they have, right? Either through threatening of sanctions or other actions. Do they not, to ensure foreign dollar holders aren't dumping dollars? Are there other tools in the tool belt?
I don't think there are. I mean, I think that we risk biting the hand that feeds us. I think if we start being overly aggressive to people who have dollars, that just creates another incentive not to have them. And that also instills a greater sense of urgency to divest from the dollar and to no longer rely on the dollar as a reserve currency or for a lot of international cross-border exchanges, because, the U.S. runs that risk. I think they've already crossed that line where we've abused that privilege and we've put on sanctions to the extent that I think there's already a desire for that reason alone to get away from the dollar, to diminish the influence and power that the U.S. has over the rest of the world by virtue of its ability to deny access to dollars.
Sure.
Right? And so what it really boils down to is what we have is our military. But is that something that we actually are going to use? The Soviet Union had a big military and they collapsed. I mean, they didn't use their military to try to avoid that collapse. The whole empire disintegrated. So I don't know, are we going to tell people, hey, hold these dollars or we're going to invade you or we're going to bomb you? I mean, I don't know that we would even do that.
Right.
So, and if the dollar crashes, I mean, we got bigger problems. We can't even afford to pay the military. I mean, there's going to be chaos at home that they're going to have to deal with. So I think the only thing we've got going is the fact that the rest of the world, hasn't, come to this conclusion yet, right? I mean, they still have confidence in this system and in the dollar. And, but the question is, how much longer will that happen? Because we've already asked them to, increase substantially the amount of dollars that they'd be willing to absorb or allow us to print. I mean, we're going off the charts now with deficit spending and money printing. I mean, the government is spending about $8 trillion a year, a little over, and it's not even collecting $3.5 trillion in revenues, taxes. And that's before this $2 trillion spending bill got passed. So, I mean, we're spending money like crazy without any regard to our tax revenue. And so all of that is basically a tax on dollar holders because it's financed by inflation. And so we're asking the world to bear a heavier and heavier burden of maintaining this system of the dollar reserve status. And how much longer will they do that? And as they foster the idea in America that, hey, everything is free, like, hey, it doesn't matter. We can have whatever we want. Green New Deal, reparations for slavery if we want, government guaranteed employment. We can forgive all the student loans. We can have Medicare for all, and we're going to pay for it by printing money. I mean, the world is just not going to, go along with that.
Right.
And so there's going to be a crisis soon because we have upped the level of dollar printing to such a degree that they've got to back off. I mean, we've got to be in the final innings of this game.
Okay. Look, Peter, it's been great having you back on. I appreciate your perspectives. So thanks very much. For anybody who's curious and wants to catch up on more of your content, I'd check out Peter's YouTube channel, check out Shift Radio, and for all the products you can now offer to Canadians as well. A majority of my audience is in the US, but I'm Canadian. I'm North.
Yeah. We're all licensed and ready to go at Europe Pacific Asset Management in Canada. So yes, 100% we can work with Canadians. Finally, right. It took a long time for IROC to approve us, but it finally happened. So persistence pays off.
Yeah, right on. Okay. Well, thanks again, Peter.
Okay.
Okay, guys, that's a wrap. The Q1 wrap party is over. Thank you so much for stopping by. I hope you enjoyed this. I always enjoy hosting it. If you did, please hit subscribe. We produce content 4 times per week, always a fresh interview with the intention of making ourselves better, smarter, and wealthier investors. Thanks again.